in his best case, will get up to $150,000 per coin. That's 136% increase from where it's at today in 2024. Wow, what a bullish call. You can't believe it. Let me show you what he said.
That's right. I mean, Bitcoin's still, we think, early in an upcycle. So the idea that it could get to like 150,000 this year is still, within our base case. And
150,000 in 2024.
Yeah.
Our base case.
I own 1.4 Bitcoins right now, and I would love for Tom Lee to be right and for that value of those coins to go up 136%. We'll see how it goes. Bitcoin's had a very good couple of days. It's up almost 9% in the last few days. Let's see how things work out. Let's see if Tom Lee is right. I'm a value investor, predominantly invested in stocks. I invest in real estate. And why do I invest in Bitcoin? Well, the answer is because I think it is a part of the future. And I love learning. I love trying to invest in something that's going to be big. And Bitcoin has certainly proven that it's gotten bigger and bigger each year. My investment has more than doubled in value. I've invested $62,000 into Bitcoin and Ethereum, and my investment has gone up more than $67,000. So it's been a very good appreciating asset. And it also is a part of the future, which I'm excited about. I don't put a big part of my portfolio in Bitcoin, but I'm glad that I've invested, and more importantly, that I've learned a lot about this new asset class. Welcome back, fellow value investors. In this video, I wanted to cover Boyd Gaming. This company doesn't have the biggest casinos you've ever heard of. They're spread out across the United States, and they operate really well. They're profitable, they generate free cash, and they grow. I thought it'd be a really good company to take a look at. I'm really liking small mid-cap stocks going into 2024, and this certainly fits that profile of a small mid-cap stock. I'm going to take a look at the financials for Boyd Gaming, put them through my process, and determine whether I want to buy or not buy their stock. I currently don't own any shares of Boyd Gaming, but it is an interesting company that I'd like to tell you about. Before I jump into the analysis, please like my video and subscribe to my channel. And I'd really like to see your comments on what you think about Boyd Gaming. To evaluate Boyd Gaming, I'm going to look at three primary areas. The first one is probably the biggest area, which is the company. Do I think the company is a good company, operated well by management in an industry I want to be in? And I'm going to take a look at that and weigh that carefully. Second, I'm going to look at the balance sheet. Make sure there isn't too much excessive debt. Make sure they're less than 3 times net debt to EBITDA, and see where the balance sheet lies. Third, I need a discount. I'm a value investor. I buy stocks that are discounted. I don't buy stocks that are fairly priced, and I don't buy stocks that are sold at a premium. And based on the answers that I get, I will buy or not buy Boyd Gaming. So as mentioned in the preamble, Boyd does not own these massive casinos like a Caesar's Palace or Mandalay Bay. Instead, they own these smaller casino and hotel operations. So I think that's smart. And the other thing is they're located regionally. So the person that wants to gamble maybe on a late afternoon or maybe on a weekend that's close to home, that's where Boyd Gaming customers tend to be. So their properties, 29 properties across the country, and they serve 19 different markets. So they're not just in Las Vegas, they're scattered across the country. The other big area that they want to grow in, and their revenue growth is really high, is online gambling. They have really grown their online betting substantially. Their normal operations, the whole legacy hotel and casino operations, isn't growing very much, but the online gambling is growing quite quickly for Boyd Gambling. So looking at their income statement for the first 9 months of 2023, their overall revenues have grown about 6%. So it's good to see that. In the current quarter, they grew just a little bit. Their legacy, their traditional business is not growing very much. In fact, it contracted a slightly bit. Now, the online gambling is where the business is really taking off, and it's the right place to be. Online gambling is really growing. The whole addressable market continues to expand. So it's good to see that they have a good business in that area, both for the quarter and for the year to date. That area of the business is growing real nice. And I'm attracted to Boyd Gaming because they have a very good online gambling presence, and they don't have excessive property related assets. They have these 29 regionally located properties. They don't have massive casino properties like Caesar's Palace or the Wynn and so forth. So that's good to see. The other impressive item on their income statement is that they're profitable. So their operating income is really strong. It really supports, less than 3 times EBITDA of net debt is less than 3 times EBITDA because they produce a lot of EBITDA. So that's a strength in Boyd Gaming. Looking at the performance of Boyd Gaming based on earnings per share, they've been performing well, nice and profitable. And I'm going to use the next 4 quarters of earnings per share to value the company based on earnings per share. They have a low PE, just 10.3 if you look at forward earnings. I'm going to use 16, which is higher, but casinos can get a higher PE. And again, I really like that their online gambling business is really growing. If that continues to grow at the rate that it's growing, that's going to be a major part of this company. And I believe their multiple is really going to change if investors realize that, hey, Boyd Gaming is really in the online gambling business. I think their multiple is really going to expand. Looking at the balance sheet, the cash balance on the balance sheet looks good. It's nice and stable. It's good to see that long-term debt is going down. Very good to see it being paid off. This company has acquired other businesses, and you can see that in the intangible assets and goodwill. That usually is a sign that the company's been acquiring in the history of the company. So it's good to see that, hey, the debt is less than 3 times EBITDA. And I'll put that on the overall valuation, make sure that they do qualify to be a good investment for me because their balance sheet is in good health. The statement of cash flows, a very important statement for me because I value companies based on free cash flow as well. Cash flows from operations did go down a little bit, but it went down. It's nice to see that grow year after year, especially if revenues are growing. Looks like they had to invest more money into the business. They went from $173 million of CapEx to $279. So they probably have had to remodel some businesses, maybe invest in that online gambling business by buying technology and so forth. But it is a point that, free cash flows have gone down. I'm going to use the free cash flows that I'm seeing for the first 9 months of 2023 and annualize that number and compute what I think the value is for the company using discounted free cash flows. I believe Boyd Gaming is discounted by 9%, but that's such a small discount. I would say that they're probably just fairly priced. The current value that I have on the company is $66.64, but the stock is trading at $61. So pretty close to the valuation I have on the company. Where did I get my numbers? First, I discounted their free cash flows. And as mentioned earlier, their free cash flows for 2023 annualized are going to be about $558 million. I'm going to grow those cash flows by 6%. That's been their revenue growth rate. And maybe they grow cash flows a little quicker, but that's a good conservative rate that I'm going to use. Long term, I'm going to grow 3%, cash flows by 3%. So all these cash flows I expect in the future, I'm going to discount at 9.5. This is a small company in a riskier sector. So I'm going to go with a more conservative discount rate of 9.5%. The net present value of all those cash flows is $8.6 billion. I'm going to add the cash, but take away the debt to get to an equity value of $5.9 billion. The market cap of the company is $6 billion. So you see that there's about a 5% premium currently priced in the stock for Boyd. The earnings per share look really good. Strong earning and profitable company. I like that about them. Their PE I'm going to use is 16. I believe their PE is you're going to have a multiple expanded because as investors realize there's an online gaming component to this company, I think it'll expand from 10 up to 16. And based on that criteria, I use this formula to determine the value of Boyd using the earnings per share growth rate of 13%, a multiple of 16. And I get to a share value of $83.47. Company is being traded at $61.31. So there's actually a 36% discount if we use earnings per share. I blend the two, but I put more weight on free cash flows. And I get pretty much a fairly priced company with a 9% discount. Looking at where the stock for Boyd has been over the last 12 months, it's quite interesting. You had the stock really rise just coming out of the gate in 2023. It came back down and then it rose to pretty good levels at around $72 per share. Now, more recently, it had a pretty significant drop in share price and then a rally. So it's had really good volatility, to say the least. And that's good for a value investor. I can pick places to invest in the company. And overall, the stock price is up 12.72% year to date, and they pay a small dividend of 1%, and they also buy back shares. So to finish off the evaluation of Boyd Gaming, let me go through my process and make a decision whether I should buy shares or really just hold off from buying shares of Boyd. First is the company. What do I think of the company? I think the company is excellent. I think they're doing the right things, investing in online gambling. I like that they have smaller casino properties. I like their profitability. I really like that about the business. I like their balance sheet, very good health. I like the balance sheet, but I don't like the discount. I'm a value investor. I like seeing higher discounts. And a couple of things can change that discount level. If they come out with better earnings, it'll raise the value of the company, maybe increase that discount. Having said that, I'm going to hold off from buying any shares of Boyd Gaming. It is just a hold. If I own this stock and I owned it for a long time and I was sitting on a gain, I'd probably just hold it. But since I don't own any shares, I'm going to hold off from buying any shares in Boyd Gaming. Thank you for watching my video. I hope you found it interesting. Do me a big favor and leave a comment on Boyd Gaming. I love reading comments and I'd appreciate yours. Also, like my video and subscribe to my channel. With that, thanks again for watching and happy holidays. Banks have been doing really well in 2024, and they did great at the end of 2023. Part of the reason is that in 2023, in the springtime, there was a lot of fear around banks. Silicon Valley Bank was feared that their bankruptcy was going to extend to other banks. So it became quite concerning. The other concern out there is that commercial real estate, there's a lot of loans out there that banks are holding those loans, and that might cause some losses. But a big tailwind has been these interest rates. Banks are earning a lot of money on the higher interest rates. And I think that's going to really benefit banks. The other positive around banks is that the economy has continued to stay strong. People have jobs, people are spending money. They're spending more money because inflation's up. So there's a lot of positive tailwinds for banks going forward. I selected a really nice bank to put some money to work in 2023 in Citibank, and it really paid me back well. My stock appreciated really well, and I got paid a really nice dividend from Citibank. I chose Citibank because I thought it was better discounted than the others like JP Morgan. I've owned JP Morgan, Chase, but decided to sell it a couple years ago once I made a fair amount of money on it, thinking that it was a little too high priced. I compared all the banks and settled on the big bank that I would own would be Citigroup. And I'm glad I did so. So far, so good. We're coming up on the earnings. The earnings is this Friday. It is on April 12th. I'm recording this video on April 10th, kind of as a preview to those earnings. And just share with you the analysis I've completed on Citigroup, why I'm an investor. More importantly, what I plan to do going forward with this bank. It is a good bank, but all investments have to be reevaluated. I certainly do that. I do it twice a quarter on every investment I make. And it's time to take a look at Citigroup, see if it's a stock I want to continue to own, see if it's a stock that I want to add shares to, or maybe sell some shares, or maybe sell the whole position. I'm going to take a look and I'll share my conclusions on what I'm doing with Citigroup at the conclusion of this video. This bank is well diversified. They're not just a traditional bank. They're into a variety of businesses. They have investment banking, they have business banking, they have credit cards, they have a variety of businesses. So they're well diversified, and I will dare say they're too big to fail. Banks prove that the US government's not going to let big, massive banks go bankrupt because they would just hurt the economy too much. And this I put into the category of too big to fail. I hate saying it, but it's just reality. It's one of the realities of our economy that we have to protect certain industries because it's good for the economy. We want the economy to be good so that everybody has a job and people can make money and people can earn a living. So let's get into Citibank and look at their fundamentals. I'll look at a valuation that I've created for this bank, and I'll share my conclusions on what I plan to do with my stock in Citigroup. The Citigroup stock is doing really well. If you look at the low point in late October to where it's trading today, you're up 57% if you caught some shares in the late October timeframe. That's just a great return. That's right up there with tech stocks and so forth. And what's great about Citigroup is it pays a nice dividend. It's 3.5%, which is nice. Great appreciation and a really nice dividend. I'm not the only one that really likes banks at this time. Jim Cramer of CNBC is really commenting positively on banks. And here's a clip where he really showcased Citigroup just a few weeks ago and showed how they're on a really nice tear and that they really are setting up to really do well in 2024. Looking at the fundamentals of Citigroup, it looks really good. Year to date, it's doing 17%. And over the past year, it's up 29%. And again, I commented that if you look at the low point up until where the stock is today, it's up 57%. The market cap of the company is 115 billion and the revenue is 78 billion. So you're paying about 1.5 times revenue for the company. Really strong net income. They're doing really well from a net income perspective. Their earnings per share is going to be really good going forward. Really low PE. I love a 10 PE. This is a growing bank now, and they have a really low PE. I think it's got more upside, I believe. A lot of analysts cover this, and what's interesting is most of them have a buy rating, but their price target is a little low. It's at $60.62, and that's pretty much where the stock's at now. But it's good that they have evaluated the stock and believe that it's a good buy. Maybe that dividend is really driving them to recommend the stock. The dividend is at 3.5%. So it's nice to see an appreciation in the stock, and it pays you really nice income. It's expected that the earnings per share for Citigroup is going to increase a lot. It's going to go from $6 per share up to $7.29 per share, and then $9.18 per share in 2 years. That's really good growth in the earnings per share. I'm excited about that. If they can hit those marks, this stock is really going to go up. I run my own valuation for any company I invest in. In the case of Citigroup, I value the company using their book value, their PE value, and their earnings per share value, 3 different methods. And I came up with the fact that I think they still offer a 13% discount. And that's a 13% discount after the stock's really done well. It still has some room to go, especially if the news on the company continues to be positive. They can show top line growth. They can show growth in earnings per share. This stock, there's no reason why it cannot go up. It has proven that it wants to go up. It would just continue that path forward. That dividend is at 3.5%. That's very attractive to income investors. So there'll be more investors wanting to buy into Citigroup going forward. So should I buy more shares in Citigroup, hold my shares, or sell my shares? Well, I look at 3 main things in any investment. First, it's all about the company. In this case, it's a financial services company combined with a bank. And as I look at Citigroup, I like that they've cut their costs. I like the leadership, that they're really serious about making the bank profitable. I like those aspects of the company. I like that they're growing. They're expecting to grow their top line. They're growing their earnings per share. I really like those things about the bank. Therefore, I'm really positive on the company aspect of Citigroup. Second thing is the balance sheet is in good health. The balance sheet is in great health for Citigroup. They're not exposed to too much commercial real estate, which is good news. And they have really good earning potential on those high interest rates. So overall, the balance sheet's in really good shape. And then the third topic is a discount on the stock. Am I getting a discount on the stock? Now, first, I hold Citigroup in high regard. I think it's a good bank. It's one of the bigger banks. It's a safe investment. Therefore, a 13% discount that I calculated is a good discount. I'm going to continue to buy shares in Citigroup and continue to build an already medium-sized position that is paying me a nice dividend and is already rewarding me with really good appreciation. That's my review of Citigroup. I hope you found it interesting, and I really appreciate you watching. Keep in mind, I like sharing my journey as an individual investor in each investment that I make. By no means do I recommend you buy Citigroup or sell Citigroup. I give no financial advice. I'm just sharing my journey as an individual investor. Thanks again for watching. Some chemical companies, especially the ones tied to agriculture and food production, tend to be stable, other than being tied to a commodity of natural gas. And a company that I wanted to cover today was CF Industries. CF Industries produces the fertilizers that farmers need to grow their crops. They take natural gas and then turn it into fertilizers. It's in consistent demand year after year. The question always is, what's the commodity worth? If the commodity price is higher, CF Industries makes more money. If it's down, they make less money. This is a dividend payer. So I like that aspect of CF Industries. I also like that they've been around for a long time. They have a reasonable market cap, and all things look reasonable on this stock. I wanted to take a look at the stock. It's a couple weeks after the earnings came out, and the stock market didn't quite like their earnings. So I'm a little bit concerned of what's going on with the company. I wanted to look at their financials and their fundamentals and revalue the company and decide whether I should buy more shares, hold, or sell my shares in CF Industries. Before I jump into the analysis, let me just remind you that I'm an individual value investor and I evaluate companies, and I like sharing my analysis on YouTube. I'm not recommending you buy CF Industries or you sell CF Industries. I'm not providing any financial advice. So let's take a look at CF Industries. So to begin with, this is about a $14 billion market cap company. and they produce about $6 billion of revenue. So you're paying a little more than 2 times revenue for the company. They are consistently profitable, which is good, and they pay a dividend of 2.6%. A number of analysts cover the stock and they have a hold rating on the stock and believe that it's a little discounted. Part of the reason is because year to date, the stock is down 4.4%, which is disappointing because the rest of the market's up almost 12%, while this stock is behind by about 4%. So it's interesting that within this industry, they're not doing so well. So let's take a look at the income statement. And it looks like they've been growing year after year, but then in 2023, the revenue really went down. And I believe it's the commodity price that really fell down on CF Industries and really reduced their revenues. So that's interesting. I knew that buying into the stock, and I expected that the commodity prices would rise, especially since oil prices were really creeping up. So it'll be interesting to see the first quarter earnings and see how they performed and see if that trend is changing. This is a cash flow generation company. They consistently have driven free cash flows. Free cash flow over the previous years has really looked good, and it fell to some extent in 2023. I used a lower amount that's more consistent with 2023 in my valuation for free cash flows and for the valuation based on free cash flows. The earnings per share for the company, 15 analysts cover the stock. There's a hold rating, but they all believe that collectively, on average, that the company is discounted by about 10%. The earnings per share is 638 is expected this year, and it's not going to grow much. It's actually going to go down a little bit next year and then grow 4% the year after. So consistent earnings per share, and I'm going to use that information for my valuation based on earnings per share. When we look at the balance sheet for the debt to EBITDA, the company has a debt to EBITDA of 1.27. That's a very good ratio. That means the balance sheet's in really good health. So solid balance sheet. And let's take a look at the first quarter earnings. CF Industries released their earnings for the quarter that ended March 31st on May 1st. And the market didn't like it. The stock's been selling off and it's priced lower than when they issued out their earnings. And usually for highlights, the company puts out, the positive news on the company. You don't see revenue on any of the positive highlights. It usually means, well, that's probably bad news. So I'm eager to get to the income statement. Some positive news is they do have free cash flow, which is positive. They did repurchase some shares, which is positive. But let's get down to that income statement, which would really tell me a lot about the company and how they're going. So looking at the first 3 months of the year, sales really did drop. They dropped for the company, about 25%. That's a big drop. So that's really concerning. And the balance sheet stayed pretty solid. The statement of cash flows is good, but that drop in sales could really be a concern for me. I like companies' top line revenue. To me, tells me the company is operating well. Customers like their product or service. The business is operating well enough to distribute their product and service really well. And the drop in revenue is really concerning to me. So what do I think the stock price is worth for CF Industries? Well, I'd like to take a look at the free cash flows the company produces and look at a forecast of all the cash flows I expect the company is going to produce, discount those free cash flows to today's value. I'd also like to look at earnings per share and do a valuation of earnings per share that I expect in the future and do a valuation of earnings per share. Starting with free cash flows, I'm going to use the trailing 12 months that the company has in free cash flows, which is $1,380 million. And I'm going to grow those cash flows by 2% in the first 4 years. And then all years after year 4, they're going to grow at 2% as well. That gives me a forecast of all the cash flows that are expected out of this company. And I'm going to discount those cash flows by 10% to get to a net present value of $16 billion for all those free cash flows. I'm going to add the cash and take away the debt to get to an equity value. This is the equity value of the cash flows plus cash minus debt of $14.9 billion. Market cap's 13.9. So it offers a 7% discount if you value the company based on free cash flows. Earnings per share is expected to be $6.38. I'm going to use a PE of 12 and grow those earnings per share by 3%. I get a stock price value of $78.86, but the current stock price is $76.22. So there's a 3% discount using the earnings per share method. When I combine the two, putting more weight in the free cash flow method, I get a 6% discount on CF Industries stock. So should I buy, hold, or sell CF Industries? Well, I'm gonna look at three areas. First, I really want to buy into the company. Really feel like I really like the company. I like the management team, and I want to be a part owner. Second, I want to look at the balance sheet, make sure it's quality balance sheet. And then third, I want to look at the discount. First, the company. I like the industry. I like that it's a more stable industry within chemical. I like that, farming isn't going to go away. Food production is not going to go away. So it's always going to be in demand to get these fertilizers. The piece that I do not like is that I think the company is underperformed and it somewhat surprised the market and it surprised me, frankly. So I don't know that I'm bought into the management team. It's hard to really accept that the stock price is down when other companies similar to this are doing well and the market as a whole is going up. So I'm not completely bought in on the company. The balance sheet. Balance sheet's a really good quality balance sheet. No problems with the balance sheet at all. The discount, not a very good discount. Considering that I'm not bought into the company, I would expect a much higher discount in order for me to take the risk of buying a company where I think the management team could have done better. Therefore, I'm going to sell my shares in CF Industries and just get this position out of my portfolio and just watch the company. It doesn't cost me any money to watch a company, see if they can repair their business and get back on track with the way that they should be running their company. This is a dividend paying company, and the dividend that I get from CF Industries is $258 per year. On a monthly basis, it's about $21 per month. So not a bad dividend. The value of the stock is that I own is $9,831, but I paid $10,137. So I've pretty much have an unrealized loss of $306, about a 3% loss. I'll be selling the shares on Monday, May 20th, and just getting this out of my portfolio for the time being. I'll watch the stock and see if the company gets better. Hey, thank you for watching the video on CF Industries. I hope you found it interesting. I'd love to get your comments on what you think this company is worth and what you think about the stock overall. Thanks again for watching. Good luck investing. Chegg specializes in providing students the assistance they need to really learn a course, a topic, a subject. They've been a fairly popular application, especially around the COVID years, where students were asked to leave the classroom and learn online through Zoom classes. That's when the company had a real rise in subscriptions. Now, the company has really struggled to keep their user base high. In fact, they're losing subscribers. As a result, they're losing revenue. Is this company going to make it, or are they going to eventually be a zero value company? I'd like to take a look at this stock and see what I think is going to happen. Chegg is a well-known company to many students, and I was able to ask my son, who's a student now and actually is a Chegg subscriber, independent of my decision on this stock. And he happens to believe that it is worth having a subscription because Chegg provides really precise information to a student. I'll take his word for it and use that as part of the data set that I use as I make decisions on this company. I'll take a look at the fundamentals and try to forecast where this business is going and see if it's worth an investment. This is a high risk stock. It's been in a free fall, but it certainly is discounted. If this company makes it, it's going to reward shareholders. Now, I'll take a look at fundamentals and let you know what I plan to do with this stock. Currently own a few shares. I'll make a decision whether I should buy more shares, hold, or sell my shares in Chegg. Let's get into the fundamentals. The Chegg stock has really seen a big high, and now it's trading for $2.22. During the COVID years, it was trading as high as $100 per share. Now it's had a big drop, about 97% from the high. The company has a market cap of $226 million. The revenue is $683 million. This is pretty much a company that's, being viewed as a company that's probably not going to exist. Big threat is AI to Chegg. And I'm going to have some comments on AI as the company has really retooled and put out an AI application themselves. That might be a real big opportunity if they can make it work. Earnings per share, they've been losing money, but their forward PE is just 2. Again, this company is so discounted. Analysts believe that it's highly discounted, 168% discount. That's the highest discount I've seen on stock analysis. It's pretty amazing. But it really is a case of, most people believe Chegg is probably not going to exist. They're probably going to be replaced by ChatGPT or Google Gemini or even Meta AI or one of the other large language models. And one has to think, are those large language models going to give students the precise information they need and the assistance they need to really learn a topic and get a good grade? I don't know just yet. I do use Gemini, ChatGPT, and even Meta AI, and they do provide good information. But I would also say when you ask a precise question, sometimes it comes back with a very general answer and it's not very useful. I think if Chegg outperforms the general large language models, there'll be a real need for Chegg AI as well as the human to human based support that Chegg can provide. Those things may still be relevant. It may enable the company to begin to grow and be around. If Chegg makes it, I think it's going to be a big, big win for current stockholders who could see their shares rise because you're starting with such a low stock price. Revenues for Chegg have been declining in recent years. And if you look at previous years, they were really growing, especially the year of COVID. Everybody needed Chegg to get through classes, but they've seen their revenues decline. And unfortunately, the latest release shows that there was a significant decline in revenue and in subscribers. So I'll take a look at that more closely in the earnings. The cash flows of the business, they've been a good cash flow business, but the cash flows are also slowing down, which is concerning. They were cash flowing really well in the years of 2020, 2021, all through 2023. The cash flows have dipped in the trailing 12 months, and the most recent quarter also went down significantly. So all the things are headed in the wrong direction for Chegg. Revenues are down, free cash flows are down. Also, debt is rising a bit, and their cash balance is still good. But overall, things got to turn around soon, or this company is really headed to a point of no return, and they may have to kind of fold up at some point. 9 analysts covered Chegg, and the price predictions are all over the place. One analyst believes the stock is really worth $10 a share, and the worst prediction is at $2 a share, which isn't too bad. It's already at $2.22. Overall, on average, analysts believe it's discounted by 168%. Their earnings per share is expected to be okay. It's going to be a little over a dollar for the next 3 years. Just using that rate, the stock is highly, highly discounted just because you have a profitable company that is cash flow positive, generating earnings per share. They should get at least a 6, if not a 12 EPS. But the sentiment on this stock is so low that it's really being discounted. The earnings report for the second quarter of 2024 are out, and it does show concerns that the company revenues year over year have decreased 11%. That's not good. The encouraging thing is they're in a high margin business, gross margin of 72%. That is good. They do have positive EBITDA, adjusted EBITDA. And they did have net income. It's non-GAAP, but that's what really counts as non-GAAP net income. The subscriber growth, it was negative, and that's a problem. We look at the guidance they provided. I think that's why the stock tanked so bad a couple of days ago, is that they're actually guiding that the revenue is going to drop even further. And if they can get to a point where they can just start growing, if you compare one year to the next, I think that'll stabilize the company, if not cause the stock to rally. They do expect that they're going to have positive EBITDA. They are going to have very good gross margins. These gross margins are very good. This is an industry and a business that really drives high margins, which is one encouraging thing about the company. The balance sheet looks okay. They have a fair amount of cash and short-term investments on their balance sheet. So that's good because you're going to need that cash to get through this reimagining the company and reinventing it to be an AI company. The debt level isn't rising, which is very good. You don't want debt to rise, especially in a company like this. They have enough bad news and problems to deal with. Looking at their statement of cash flows, the company did produce positive cash flows from operations, and they did have CapEx. It's expected that they have CapEx. They're probably spending quite a bit on the AI business, which is understandable. It's good to see that they have positive cash from operations and positive free cash flow for the first 6 months of 2024. I ran a valuation on Chegg, and as you can imagine, it was a little tricky to get the right forecast for cash and really think through this one. The reason for it is the stock price is so discounted. It almost makes the numbers unbelievable. Let me take you through it. Overall, I'm showing that the company is highly discounted. I'm agreeing with those analysts that had that huge discount. The principal reason for it is they are profitable. And if I use a PE of 12, it gives me a discount of 483%, especially if they make it. And they make it and they start growing. This stock's just going to really rally up to $10 a share, if not 12, very quickly. And right now it's trading at $2.23. So it really is an opportunity. If one believes that the Chegg business is going to work, and at some point they're going to start growing, that AI business is going to become something, this might be a really interesting stock. The cash flows, they support a number as well. If I just have a reasonable forecast on their cash flows, I get a small discount of 21% if I use a 12% discount rate on those free cash flows. So overall, it's a highly discounted stock. One thing I would put out there is Chegg could be an acquisition target, another business that really wants this AI model, this AI business, and frankly, access to all those student accounts that they have, can very quickly buy the company at a very low price. Maybe one of these bigger companies that already has a big AI model, let's say a Microsoft or ChatGPT or a Google or Meta AI, or one of those big giants might acquire this company and very quickly have a lot of subscribers to the AI model. We'll see what happens, but it's a highly discounted stock. The real question is, do you think they're gonna make it? Do I think they're gonna make it? That's the big question. In general, how desirable do I believe the Chegg business is? And I prefer to have really desirable businesses that are operating in the green quadrant that I've put together. These are companies like Google that have a search engine that is unrivaled and has great competitive barriers, keeps competitors out by being just the dominant search engine. Now, Chegg does not have just an exclusive operation within this market, but it was for a while highly desirable. It's really a company that belongs in the gray. Now, if they make this AI application work, I'm going to dip them in the green a bit, but for now, they're going to be in the gray. And for a company in the gray, I really want a high discount, which they offer. Now, companies in the red are typically companies that are in old industries that have very low margins, highly competitive, and that's not Chegg. I know that AI is a big threat to Chegg, but AI might be the biggest opportunity they've seen. And if they can make that work, this stock might quickly be a 5, 10, $20 billion company market cap. If that's the case, your money would be 10x, maybe 20x. So it might be worth the risk. Having said that, I'm going to buy additional shares of Chegg on the principle that the risk that I'm taking is more than being compensated in the potential reward. The rate of return on an investment in Chegg could be really high. And I don't know that there's a ton of risk since they are cash flow positive, they are profitable. It seems like they're making the right decisions and trying to build an AI business while trying to keep their existing business active, since a lot of students really depend on it. Overall, I do like the business. The situation they find themselves in is tough, but I think they're making the right decisions. The balance sheet's in good shape. They have almost as much cash as they do debt. I don't want to see debt grow. And the discount is massive. So overall, I'm a buyer of Chegg. We'll see how things work out with this stock. So that's my evaluation of Chegg. I hope you found it interesting. Let me remind you, I'm an investor. I don't make any recommendations to buy, hold, or sell Chegg. I don't provide any financial advice. Thanks again for watching. Good luck investing in 2024. Welcome back to my channel, fellow investors. In this video, I'm going to cover Cigna. This is a healthcare payer that has been doing really well. Year to date, the company is up 17%. They pay a small dividend. And overall, I view this company as being highly discounted. I've been investing into Cigna, building up a position, and so far, so good. I wanted to analyze the company, share with you my analysis, and get to an endpoint where I decide whether I should buy more shares, hold, or even sell my shares on Cigna. I'll take a look at their financial statements, their fundamentals. I'll put the company through a free cash flow discount model to arrive at a fair value of the stock based on their free cash flows. I'll also look at their earnings per share and determine a fair value based on earnings per share. I'll combine those two to arrive at what I think the company is worth, to see if I'm getting a discount compared to the current stock price of Cigna. Cigna is a really good company. It's a healthcare payer. And about a year ago, they were trying to acquire Humana, and that acquisition fell apart. When it did so, investors really liked that. Humana was troubled, and they continued to be troubled. So that was good news that they didn't acquire Humana. Overall, healthcare is a space that I like because healthcare can weather a recession. It's always a need. Whether we have a good economy or a bad economy, people need healthcare. They need to buy health insurance, and they need to go to the doctor and get the healthcare that they need. So it's good to have healthcare companies in my portfolio so that I could have long-term growth with some stability. Now let's take a look at Cigna and look at the fundamentals, look at where the stock price has been, and then value the company. Cigna has a market cap of $99.95 billion. It's had a very nice annual return of 37%, and year to date, it's up 17%. The company pays a decent dividend at 1.59%. Overall, it buys back shares, so the stock price appreciation is where the return is for an investor. The forward PE is nice and low at 12. Really nice forward PE. There's a strong buy sentiment from multiple analysts that cover the stock, and collectively, they have a price target average that is 4.3% higher than the current stock price. Revenues have been growing for Cigna over the last 4 years, and that's excellent. This good growth rate over 4 years shows that the management team is doing a really good job, that the products that Cigna produces or provides are really favorable and desirable by consumers. Overall, I really like their growth in the income statement. It really says a lot about their business. Growth has also existed in the statement of cash flows. Cash from operations has really jumped up. It jumped up 36% if you compare 2022 to 2023. And the year before, cash flow from operations went up 20%. So excellent growth in cash from operations from Cigna. Looking at the balance sheet, the company has debt to EBITDA of 3.16, just slightly above where I like to see a company, which is 3 or under. Overall, I'm not too concerned with their balance sheet, especially since they're generating so much free cash flow. Earnings per share has been really growing for Cigna. In 2024, it's expected they're going to grow their earnings per share by more than 60%. That's excellent. And it's going to continue on. In 2025, it's expected that earnings per share will be up another 12%. And in 26, up another 11%. That's just exceptional earnings per share growth. Earnings per share will more than double over the next 24 months. The dividend is 1.59, and the dividend payout ratio is 32%. So it's nice and safe. And that's typical of healthcare payers. They don't pay very high dividends. They usually pay kind of a smaller dividend compared to other companies like a pharmaceutical company, but they consistently pay it and they consistently grow it. To arrive at a value that I believe Cigna is worth, I looked at their free cash flows closely, and that's cash from operations minus capital expenditures. This year, they have really good cash flow, so it was a really good starting point. And I grew those cash flows by about 7%. That is a nice conservative growth rate. I added the cash on the balance sheet and took away debt, and I arrived at what I believe a fair price for the stock based on their cash flows is $626. But the stock price is priced at $352. So the cash flow value of this company is much higher. It's 78% higher than the current stock price. So there's a lot of room to run if you look at free cash flows for Cigna. Looking at earnings per share, again, earnings per share are really expanding quickly, and they have a very low forward PE. Using the guidance that Cigna has provided, which is $28.25 per share, is what they expect they're going to do in earnings per share this year at a 18% multiple. I get a value based on earnings per share of $416 per share. The price of the stock's $352. So using earnings per share, I get an 18% discount. And the growth rates I'm using on earnings per share are conservative, but I think that the company could do far better than that. When I combine the two, I arrive at a 58% discount on Cigna. This is one of the reasons why I really like the stock, is that they just have a very nice discount. The markets really notice them. They're buying up the stock. And overall, it just looks like a positive situation. So should I buy more shares, just hold my shares, or even sell my shares in Cigna? Well, I'm going to go through and look at 3 areas of the company: the company itself, balance sheet, and the discount. First, let's talk about the company. I think the company is in an industry that I really like. Healthcare is one of those, steady growth, accumulating value in the stock type of industries. If you look at United Healthcare, that's a great example of how United Healthcare has really expanded value for investors. Cigna is much smaller than United Healthcare, but it's following the same path of a United. It's at $100 billion market cap. I could see it expand to $200 billion. They have the numbers, they have the revenue, and so forth. The management team's doing a great job. I guess they were lucky that they didn't acquire Humana, because based on the Humana earnings, the Humana business is in a lot of trouble. That could have just maybe spoiled the overall metric combination for Cigna if they had acquired them. So overall, I really like the industry. I think the company is in a really good spot. Management team is doing a good job. So I really like the company perspective. Now let's talk about the balance sheet. The balance sheet does concern me that they're slightly above 3 with regards to debt to EBITDA. Now, the company does generate a lot of free cash, and I'm going to give them a passing grade, but it should not get any worse. If anything, I want that debt to EBITDA ratio to come down below 3. Cigna has the cash to do that, so I expect that should happen in a few quarters. If it doesn't and it gets worse, I got to investigate and find out why. What's the reason why that metric keeps getting wrong or worse? So I'll continue to look at the balance sheet, but for now, I'm okay with it. The last item is discount, and Cigna provides a really nice discount. That said, I'm going to be buying more shares of Cigna. It's the one healthcare stock that I'm very bullish around, and I'm buying just about any day where it's down in stock price, even just trading even, I'm buying more shares to average in my acquisition price in Cigna and buy a really nice position of Cigna. A few years back, I invested in United Healthcare. This is 6 years ago. And over the course of 3-4 years, I did really well with United Healthcare. And the stock just kept going up and up and up. It got to a point where I felt like United Healthcare was selling at a premium. And I decided to switch horses and sold off my United Healthcare. Very successful investment. And I feel like this may be the same situation where Cigna really continues to grow, really go up in stock price, and really reward me over time. So it'll be good to buy into Cigna going forward. That's my video on Cigna. I hope you found it interesting, and I really appreciate you watching. Welcome back to my channel. In this video, I wanted to talk about Comcast. Comcast is a diversified media and entertainment company. Their oldest business is the movie studio. They were making movies 100 years ago. And since then, they diversified into TV stations, cable networks. I'm sure you've heard of NBC, you've heard of CNBC, MSNBC. They have a streaming business in Peacock, so they have really good growth in subscribers of Peacock. They have a lot of intellectual property, a lot of movies that they can show on Peacock. They also have a lot of TV shows, really successful ones like The Office, Seinfeld, those types of shows. They also have connectivity. They connect broadband users and have a lot of subscribers on their broadband. They have a small mobile business. Last, they have a amusement park business where they have theme parks around the world and operate those theme parks. Overall, their probably closest peer is Disney. And Disney's had plenty of problems in the last 5 years. As opposed to that, Comcast has been a smooth operator compared to Disney. Their management's really steered the company from big controversies. The performance of the company has been really consistent. I've liked that. And overall, I think it's a very well managed company. They had an earnings release last week, and investors didn't like it in general. The stock really sold off. And I wanted to take a close look at that earnings report and make my own opinion on it. What do I think about the earnings? Are there positives, negatives? More positives than there are negatives. Also look at the fundamentals and value the company based on free cash flows and based on earnings per share, and share that analysis with you. I'll arrive to a decision whether I should buy more shares of Comcast, hold my shares, or sell my shares in this company. Keep in mind, I'm sharing my experience as an individual investor. I am not providing financial advice, and I'm not recommending that you buy Comcast or sell Comcast stock. I'm just sharing my investing journey with you, and I hope you find it interesting. Comcast has a market cap of $151 billion. The revenue is about $122 billion. So you're paying maybe right around 1.5 times sales for this company. Really good net income of $15 billion. So their net income is about 10% of the market cap. They have a forward PE of a low 8.6. Wow, that's a low PE. And they pay a nice dividend of 3.25. Price targets by analysts that cover this stock, and there's a number of analysts that cover it, say that the stock is discounted by about 29%. That's a pretty good discount. If you look at the past year, the stock has been on the decline. The stock was trading at around $46 per share, and it's down to about $38 a share. So what gives? Why is the stock price down? Let's take a closer look and see what the company's been doing, and I'll begin to accumulate some of these fundamentals for my valuation. Let's take a look at the revenue. Revenue has been growing. Although in 2023, the revenue didn't grow a whole lot. In 22, it did grow. In 2021, it grew at a good rate of 12%. 2020, you can understand why revenue went down. There are amusement parks. You had COVID lockdowns. People couldn't go to them. But the growth has been there. Other than the COVID year, it's green on the screen. So that looks really good from a revenue top line growth. You look at their cash from operations over the last 10 years, it's very enviable, very high amounts of operating cash flow. And then there's CapEx. But net of CapEx, the free cash flow last year was around $13 billion. The year before that, about $12.4 billion. Just really good free cash flow generation from Comcast. If you compare this to Disney, Comcast generates far more free cash flow than Disney. Just a really consistent performer when it comes to free cash flow and growing their top line revenue. The company for 2024, it's expected they're going to do $4.36 per share, and they're going to be growing that by 17% in 24, 8% in 25, 12% in 26, 15% in 27. Very good growth expected on earnings per share. A total of 33 analysts are voicing an opinion of where their earnings per share will be in 2024. So this has a lot of coverage. So I have a little more confidence in these numbers because so many analysts are covering Comcast. 22 analysts voiced an opinion of what the stock is the price target is, what it's worth. And the average is $49.56, which is above 29% of its current stock price. So analysts are agreeing that the stock is discounted and will likely go up. The high on the price targets is $55 and the low is $43. And the 43 is still above the current share price. So overall, analysts believe that this is a good buy and the stock price should rise over time. Comcast pays a really nice dividend of 3.25%. It represents a 32.8% payout ratio, which is low. Very good. They also buy back shares. Their buyback yield is 5.79. When you combine the 3.25 and the 5.79, that's a really nice effective yield of dividend plus buybacks of over 9%. That's phenomenal. And that's one of the reasons why this stock is attractive to a lot of value and income investors. So really good fundamentals with regards to its dividend. Let me look at the earnings report that they announced on April 25th, representing the performance for the first quarter of 2024. The company grew their revenues by about 1%. Based on the stock price action that I saw, I expected that I was going to see a contraction of the top line, but actually the top line grew by 1%. They didn't set any records on that type of growth, but it's good to see the company grow. The other thing too is adjusted income went up 7.6%. That's good news. Earnings per share went up 6.5%. Good news. Cash flow up. So there's a lot of things pointing up and are favorable. They're good. That means the company's making more cash, making more money, making more profits. And this is where I think some of the negative news came out of is the connectivity. The residential connectivity went down. And a lot of people value that quite a bit with Comcast. It's probably the most stable revenue stream that they have. So I understand that's the case. And it did go down a little bit. So if it continues to go down, especially if it goes down at a significant rate, I would agree that's a big problem. But if it's just a blip and they can course correct, maybe grow their subscribers, maybe increase the cost of that broadband service and recover some of those revenues, I think we'll be in good shape. What do I think Comcast is worth? Well, I'd like to determine the value that I believe the cash flows are worth. And I'd also like to determine the value that their earnings per share going into the future, what that's worth. Those two will represent a value for Comcast. First, I'm going to start with the valuing their free cash flows. I'm going to start with the cash flows that they produced in 2023. This number is a good starting point. It'll be a little more conservative than their current run rate. Their current cash flows in 2024 are a little bit higher than what they were the previous quarter of the previous year. And I'm going to grow those free cash flows by a nice modest growth rate of 5%. They've grown them quicker than that, but I think it's a nice conservative growth rate. And terminal value, I'm going to grow by 4%. And that's going to establish all the cash flows after year 4. To discount all those cash flows and put them into a net present value, I'm going to use 8.5% as the discount rate. To get to an intrinsic value, a net present value of all those cash flows of being $273 billion. I'm going to add the cash on the balance sheet and take away debt to get to an equity value. That's the intrinsic value of all the cash flows less the net debt that exists on the balance sheet. When I compare that to the market cap of the company, the equity value is higher than the market cap, and it represents a 21% discount on the company. And that's a pretty good discount on a quality company. This is Comcast, very consistent operator. Earnings per share look good. The earnings per share are expected this year to be $4.36. I'm going to go with a conservative PE of 12. It should be higher. This is a quality company, but I'm going to go with 12 to be conservative. They're expected to grow more than 10%. but I'm going to just grow earnings per share by 10%. And I estimate that each share based on these metrics is worth $57.55. But the current share price is $38. So there's a 51% discount if we use earnings per share. When I blend the two, and I have a blend that takes two parts of the free cash flow method, one part of the earnings per share method, I get to a 31% discount on Comcast. And my discount is similar to what those 22 analysts had as an average. Their average was 29% discount minus 31. So we are somewhat in line, the analyst, in my estimations as well. Looking at the balance sheet, the company doesn't have too much debt. The net debt, which is all debt minus cash, is $90.87 billion. The company generates $38.8 billion of EBITDA, which is earnings before depreciation, taxes, and interest. And that gives me a ratio of 2.34, and I like that ratio to be below 3. So it qualifies good quality balance sheet. I think overall their balance sheet's very consistent, so I'm comfortable with the balance sheet that Comcast has. Should I buy, hold, or sell Comcast stock? Let me make that decision by looking at 3 areas. The first area is the company, second area, balance sheet, and third area is the discount. First, the company. Do I want to be a part owner in the business? Do I really like the business? Do I believe in them? Is their management team performing really well? The answer is yes to all the above. I think Comcast has really good assets in the movies they've made, the library of content they have, the amusement parks, the characters that they have in their library are very valuable. They also have really good businesses that have continued to operate well. NBC, CNBC, Peacock keeps growing. And I didn't talk a lot about that, but Peacock subscribers are really growing. They grew 55%. That's a very good growth rate for their streaming business. So overall, I really like their business. I think they have good competitive advantages. They have good moats around their businesses. And I think it's a business worth having. And their management team's doing an excellent job. They have a quality balance sheet. So their balance sheet's good. Their debt is less than 3 times EBITDA. I don't see any problem with their balance sheet. So I like the company. I like the balance sheet. And they provide a very good discount for a quality company. 31% discount on a quality company is a very good discount. And I think that's because the stock has been selling off and the stock price has been going down for about 4 to 5 months. And the stock market tends to do that. The stock market will dislike a stock for a period of time, discount it, and then investors realize it's discounted and very good value, and the stock goes up in value. I'm hoping that I'm catching this stock at the right time to buy, because I'm going to continue to buy shares in Comcast at this low share price, because I believe that over the next couple of years, this stock will be worth more. In the meantime, it pays a really nice dividend and it keeps buying back shares. So overall, I believe it's a very good investment for the next 5 years. Thank you for watching the video. I really appreciate it, and I hope you found it really interesting. Good luck investing in 2024. On this video, I wanted to talk about Coinbase. This is the only publicly traded cryptocurrency exchange, and they have a leadership position in the United States. They've been doing a lot of things that both retail customers like, and now institutional customers are really beginning to like. I wanted to talk about Coinbase, which is a new generation company that is in the new cryptocurrency economy. They sell currencies that you can buy, like Bitcoin, Ethereum, and other coins that people that want to invest in crypto can buy. They also provide new financial services within their cryptocurrency exchange. You can do staking of coins and things of that type. Now, crypto is not for everyone, but I would say that younger investors really like crypto. I'm not a young guy. I invest in crypto. I've been investing for some time, just because I really do believe in technology, and I believe the future is just going to be more digital, much better connected, and probably involve some type of digital currency like Bitcoin, Ethereum, or something that comes out of that ecosystem. I wanted to go through and share with you the fundamentals on Coinbase and do evaluation on the company. I'll share with you what I continue to do with this stock. I've been an investor for some time. I'll share with you how that investment's done, what I plan to do with this stock. Do I want to buy more shares, just hold, or sell my shares in Coinbase? Let's get into the fundamentals of this company. Coinbase is a $48 billion market cap company. They IPO'd a few years ago and are a pretty good company these days. They have revenue of $4.5 billion. So you're paying 11, 12 times sales for the company. They're profitable. They're new, they're growing, and they're profitable. They also generate free cash flow, and I'll get to that later. Right now, their PE is 36, and their forward PE is 58. Reason why it's a little high is the stock has been doing well. The 1 year has 130% return, and that's a really nice return. So it's made the PE less attractive because a lot of the gains have been priced into the stock. Analysts think that the stock is discounted by 26%. It has had a pullback in the last month. It's down about 11%. The company has been growing this in the trailing 12 months. They grew 74%. And they had a fairly flat 2023. They had a very tough 2022, which is a tough year for stocks and especially cryptocurrency investments. But other years like 2021, they just had scorching growth. This is a growth company. It's in a space that continues to expand. And this is one of the leaders in that space. So I like that they have a lot of addressable market and have a lot to go. The cash flow is good. It's rare to find a young company that cash flows as well as Coinbase. Their free cash flow in the trailing 12 months is $1.2 billion. That's really, really unique and favorable to a company like this. 2023, they had positive cash flow. In 21, they had $4 billion of free cash flow. That's incredible that a young company can do so much cash. I love cash because the most valuable companies on the stock market generate cash flow and they grow that cash flow. Just look up the top 10 most valuable companies and look at their cash flow statement. You'll see that cash is king. Forecast. So let's take a look at what analysts are saying. 18 analysts cover Coinbase, and we have a dispersion of price targets. Somebody's really optimistic with a price target at 345. Somebody's pessimistic at 145, but on average, they're saying, hey, this stock is discounted by 26%. It's all based on earnings per share, and the earnings per share this year is $7.17. It's going to be a real profitable year. It's been a good year for crypto for the most part. Now, I'm not going to use that number. It's too big. I'm going to use the number from 2025 in my valuation just to be conservative. If I use that $7 per share, it really raised my valuation. I don't like doing that. I'd rather be conservative, especially knowing that it's going to go down in about a year. So I'll use the lower number, but it's good to see that analysts are really optimistic about the company. Coinbase announced their earnings on August 1st, and the news was relatively positive. They came in at the higher end of their guidance, really showing that they continue to expand the business, especially around institutional investments. What they've done is they've partnered with some of these big firms that are offering Ethereum as an ETF, and they are actually the custodian of those Ethereum coins. So it's good to see that they're both a good retail company for retail investors, and now they're growing to serve institutional investors that want to get into Ethereum and other digital coins. So overall, I like what I'm seeing in the financials. They're guiding to complete the year fairly well. Now, one thing that exists with Coinbase is that if Bitcoin does well, Coinbase tends to do well. And the reason for it is there's more enthusiasm to buy coins when Bitcoin is up and Ethereum is up. And the king of crypto is BTC, Bitcoin. So as long as Bitcoin prices rise from this point, they're roughly at around $60,000 per Bitcoin. Coinbase is going to do well. If we have a significant drop in Bitcoin, then I think Coinbase may struggle to make their numbers because there'll be less enthusiasm to invest. Let's see how things play out. So with the earnings that they announced, they also provided new financials. So I was able to update my valuation of Coinbase. Let me show you what the results of my valuation. To begin with, the stock is fairly priced. I just have a 2% discount on the stock that's being offered. If I look at the cash flows the company is going to produce and the earnings per share, the cash flows are really good and I expect them to grow from the current trailing 12 months. I'm going to expect those to grow by 25% in the first 4 years. It may seem like an aggressive growth rate, but look at their financials and you'll see that getting to a $3 billion run rate is very achievable. They've done it before, and I think they're going to get back there again. After year 4, I'm just going to grow at a rate of 4% and discount all those cash flows by 10%. That's higher than normal that I would use on a company because this is a new industry, has more risk, and I want a greater reward from this investment. When I use those numbers and that discount rate, it gave value of those cash flows of $38 billion. I'll add the cash on the balance sheet and take away debt to get to an equity value of $42 billion. The company market cap right now is $48.7 billion. So it's about a 14% premium that you would pay if you just valued on cash flows. But I blend cash flows with earnings per share. And as mentioned, I'm going to use 2025 forward earnings per share because this year is just too good to use. It would really throw off my numbers, and I want to be conservative. So using that earnings per share from 2025, a P of 48, since they are a fast-growing company and a growth rate of 15% on those earnings per share, I'm going to get to a discount of 33%. I think that's why the analysts are saying it's 26% discount. It's discounted is that they use earnings per share, and I'm agreeing with them that if you use that number, it's looking really good. So overall, it's fairly priced. I've been buying into Coinbase and feel like it's done really well. And on pullbacks, this might be a good buy opportunity. So how desirable is Coinbase? Well, let me go through that and make a judgment call on where I think Coinbase lands on my desirability quadrants. I want companies in the green. These are companies that have really strong competitive advantages, barriers to keep out competitors. That way they can continue to grow, have lots of profit, and generate lots of free cash. Companies in the gray are just okay. Maybe they're in older industries. They have competitors, but those particular companies are still getting it done. Companies in the red are not desirable. Too much competition, not profitable, maybe even declining sales and not very much cash flow. Coinbase is in a unique spot where they're in an expanding market. The cryptocurrency market keeps getting bigger and the interest in that market keeps going up. There's more comfort level in cryptocurrencies. In fact, younger investors really want that. Bitcoin, as an example, is replacing gold as traditionally a hedge investment against the stock market, as an example. Coinbase is in the leadership position within that expanding market. They really don't have another publicly traded competitor in the United States. Therefore, I'm putting Coinbase in the green. And the reason for it is they are unique. They have barriers to keep other competitors out. They're the best recognized name. They continue to expand. Most ETFs, most institutional investors that have issued out ETFs have gone to Coinbase to have their Ethereum coins stored. That's the trust level they have with Coinbase. And that's the difference. That's how the leader catches most of the market in a new revenue stream for the company. So that's really how they are exercising the advantages they have and how they're going to continue to be the leader in this space. Having said that, should I buy more shares in Coinbase? Just hold or sell my shares. So I make my decision based on the company, if I like it, the balance sheet, if it's good, and the discount. I love the company. I know they're doing something different. I know it's something new that has some risk to it, but I really like the company. The balance sheet's excellent. They have more cash than debt, so I really like that. There's no discount available, so I really have to be picky and buy on pullbacks. So that's going to be my plan. Any more pullbacks on Coinbase, I'm going to go ahead and buy because I'm very comfortable with the stock. My investment in Coinbase has done well. I've invested $14,270. That stock is now worth $26,282. So it's about a $12,000 unrealized gain, which is an 84% return. It's been a really good stock in my portfolio. It serves a growth objective of picking companies that really grow, and you see their stock prices really appreciate. Again, they're very unique in the market, and I really like that. As the cryptocurrency industry expands, Coinbase will be in the leadership position. So that's my plan with Coinbase. I hope you found my video interesting. Just a reminder, I am an individual investor. I'm just sharing my experience with you. I'm not recommending you buy, hold, or sell Coinbase. Please make your investing decisions independent of this video. Thanks again for watching. Good luck investing in 2024. Catalyst Pharmaceutical is a small cap pharmaceutical company that has been growing really well. They announced their earnings yesterday and they continue to grow their top line revenue, expand their profitability, and generate free cash flow. I love that recipe. I also like seeing that small caps are beginning to rally. Last, I like seeing that a healthcare company is really beginning to rally as well. I think healthcare companies are going to do well for the remainder of 2024, given the economic uncertainty of the market. This company fundamentals look great. And I wanted to go through and revalue the company now that I've got fresh data from their earnings announcement. I'll let you know whether I'm going to buy more shares, hold, or sell my shares. I'll also reveal how I'm doing with this stock. I've been an investor for a while, and I can share with you the gain that I've got on the stock, how I got into the stock, and how I've added shares along the way. Let's get into the fundamentals on Catalyst. Catalyst is a small cap company with $2.18 billion in market cap. Their revenue is $434 million of revenue annually, if you look at the trailing 12 months. They're nice and profitable, and they have a very low PE for a growing company at 14.4 forward PE, and the current PE is 29. Overall, it's a strong buy according to a number of analysts who think it's 50% discounted. Holy smokes, this must be a good deal. If you look at the revenue, I love seeing green on the screen, and especially when you see these kinds of numbers. The company is a newer company that has a really good remedy for LEMS disease that patients really appreciate. This is a rare disease, and patients appreciate it. They've expanded their portfolio. They've launched a new drug. So far, so good. I think that's why the stock is rallying today, 13%, is that the new product launch is going really well. That's just going to continue to increase the revenue growth rate. Those are all good bits of good news. The balance sheet, what is there not to like? They have no debt and they have a lot of cash, total of $375 million of cash. So they can keep paying money into R&D, investing money in their business, growing their business with a stronger and bigger sales force. Cash flow, this young company produces free cash flow. That's one of the signs that they're going to be valuable. It's one thing for a company to grow their revenue, but it's another for a company to do it with profit and free cash flow. Once you see a company like that, take notice. I certainly really focus on companies like that. The most valuable businesses on the stock market generate high free cash flow. So I'm going to use these statistics, metrics, fundamentals, and put them into my valuation and see what I think this company is worth. Catalyst announced their earnings release for the second quarter of 2024 yesterday after the market closed. It was good news. Revenue increased year over year by 23%. Very good. That's what I like seeing in a company. They have patents on a few drugs that are very important for rare diseases. And one of their drugs just started to be commercialized, and the launch is going really well. So that is great news. That means the revenues are going to continue to expand. Overall, the market really liked this earnings. I really like it. It's a really sound company. It's a small business, so it somewhat flies under the radar, and it really has a lot of upside. Looking at the 5-year chart for Catalyst, you could see at one point in early 2023, the stock was flying high. It was up at $20.80, and it came back down, but you could see that the trajectory of the stock has been going up over time. If you bought, let's say, a couple of years ago, back in 2020, you'd be up on the stock 500%. I think you'd be a happy camper with that investment. I'll share with you how I'm doing with the stock. It's not 500%. I'll give you a preview of that number. But overall, I like where the stock price is headed. I think it's beginning to catch more attention, especially with the earnings that it had and the rise in the stock today. I've been an investor in Catalyst for a couple of years, and I can just update my valuation model for this company since it's something I do at least twice a quarter. Looking at their fundamentals, I value a company based on free cash flows and earnings per share. Overall, I believe Catalyst is discounted by 42%. And that's using a free cash flow forecast that is conservative. I don't take the top numbers. I take a conservative number, which in this case would be last year's free cash flow of $143 million. They're doing better than that year to date. Let me be conservative there. I'm also going to be conservative in the growth rate being 15%. They're growing their business faster than that. Let's say they have to put a lot of money into the business. So I'm going to have a conservative forecast for the first 4 years. Then terminal value, I'm going to grow at 4%. I'm going to use a high discount rate for a company like this. They have no debt. And the reason for it is they're a small business. So I want a higher rate of return from this company. Even when I have that conservative forecast and a high discount rate, I still get $2.9 billion of value from all that cash they're going to generate. I'm going to add the cash on the balance sheet, and they have no debt to deduct. So I get a total equity value of $3.2 billion. That's what the company is worth to me. Their current market cap is $2.18 billion. So it has a nice discount of 51% if we look at cash flows. Earnings per share expected to be $1.10. And they guided toward the higher end of the guidance that they had provided previously. Pretty much just saying, hey, the business is doing well. We plan on doing really well for the whole of 2024. Having said that, I'm still not going to move my numbers up very much. I want to be conservative. I'm also going to be conservative with the PE. This is a growing business. It's profitable, generates free cash, but it's a small business. So I'll go with 18. The growth rate, 15%. That's reasonable. They may grow much faster. Based on those numbers, based on earnings per share, the value per share is $22.77. Compared to the current stock price of $18.38, it has a 24% discount based on earnings per share. The blended discount is 42%. That's a nice discount on a quality company. How desirable do I believe the Catalyst Pharmaceuticals business is? Well, let me take a look at it. First, I want companies in the green. These are companies that have strong barriers of entry so that they don't have a lot of competitors coming into their market, competing with them, driving down prices, driving down profits, taking away free cash flows. Businesses in the green tend to be really valuable. And Catalyst Pharmaceuticals happens to be a pharmaceutical company with patents on drugs that they had to spend a lot of time, energy, and capital developing and getting them FDA approved. So they have nice barriers of entry. I'm going to put them in the middle of green and gray. In the gray zone, there's some competition. It's still investable, but I want a discount. The green means really advantages. Now, why aren't they completely in the green? They're a small business. They're a 2 billion market cap company. I think a big, massive pharmaceutical company like Eli Lilly, if they ever decided to compete against Catalyst, I think that would be a lot of pressure on this small company. So that's why I'm half in the green, half in the gray. But overall, it's an attractive business to me, especially with the discount that is being offered. That said, I'm going to buy additional shares of Catalyst. I've been averaging my purchase into Catalyst, and I'm sitting on a nice gain. Over time, I've tried to buy during good periods, and I've invested $20,389. But those shares today are worth $26,620. So I've got about a $6,231 unrealized gain, which is the 31% gain. That's about a 15% rate of return over the last couple of years. And I think there's a lot of upside in this stock. I could see this stock really continuing to rally. Again, I think healthcare is going to do good going forward. I think the market's beginning to recognize this valuable little company. And I think things are looking really positive for this company. So just a reminder, I'm an individual investor. I like sharing my analysis on YouTube. I hope you found it interesting. Please don't take this as financial advice because it isn't that. And please make your investing decisions independent of this video. I really appreciate you watching. Good luck investing in 2024. Welcome back, value investors. In this video, I'm going to be looking at a shoe company by the name of Crocs. You're likely familiar because these shoes really stand out. They're not the prettiest shoes, but boy, they are popular, especially among kids. I'm going to take a look at the company, value the company, see if it's discounted or if it's overpriced. And then I'll make a decision on either buying shares of Crocs or not buying shares. I don't own shares of Crocs, but I've seen a couple of investors on YouTube have a positive opinion on Crocs, and they're investors that I respect. So I did my own analysis, and I'd like to share that with you. Before I jump into the analysis, do me a favor and like my video and subscribe to my channel. And please leave comments on Crocs. Tell me what you think. I'm sure I'll get a couple of comments on the shoes and what they look like. They certainly grab a lot of attention because they have pretty interesting designs. I've developed a process over the years to use and make a decision whether I should buy a stock, hold it, or sell. And the first area that I look at is all about the company. Do I like the company? Do I like the industry? Do I see myself as a part owner in this business? And do I like the management team? Next, I take a look at the balance sheet. Is the balance sheet in good condition? And a good test for me is debt. Is debt less than 3 times EBITDA? Now, the price on the stock, I want a discount. I'm a value investor. I like buying stocks at a discount. So am I going to get a discount on this stock? And based on the answers to those questions, I'll buy, hold, or sell a particular stock. The story on Crocs is interesting. A group of guys that really like boating ran into a particular type of shoe that really did well on boats. And they liked them so much, they thought, hey, we should really grow this type of category for boaters and people that want shoes that can take a little water. So they bought the company and they renamed it Crocs. And ever since then, this has been a shoe that's really stood out. And they have the classic look of the Crocs shoe, which I'm very familiar with. I've never owned Crocs. My wife just bought a pair recently, and it was because her doctor recommended, hey, you got to try some Crocs because they're very comfortable and they're good on your feet. So doctors are recommending them. And a lot of people that I know have tried Crocs simply because they're really comfortable. They also have some really, I'm going to call unusual designs. And I think they're grabbing a lot of attention, especially among young people who really like the designs and the creative aspects of the shoe. So who am I to tell anybody about fashion? I know my strengths and weaknesses, and fashion is definitely in the weakness category. I just look at a company from their financials, and I let other people determine what is cool and what is not cool. But overall, Crocs has been a really growing company. It's been an interesting phenomenon here in the United States. And these guys are growing internationally very well, which is really interesting. So overall, really creative company. And it was really interesting to take a look at how they have grown over the years and how successful they've been. Crocs acquired a brand by the name of Hey Dude. And this company really showed really good growth when they were independent of Crocs, and now they're beginning to grow. But there was a couple of years where this didn't look all that promising to Crocs, and it held the stock back. But I think this brand is beginning to take off, which is good to see. It's not a majority of Crocs sales, but it really exists. It is good that Crocs is diversifying and looking at other brands that they can bring into the fold. This company, Crocs, reminds me of Deckers Outdoors. Deckers Outdoors started with deck shoes, and then they acquired UGG, and UGG did really well for them. And then they acquired Coupa or Kuna, which is a running shoe. That shoe is so popular now. So Deckers Outdoor really did a nice job of acquiring other companies and continuing to grow. It looks like Crocs is trying to take on that type of strategy so they can continue to have nice high growth by both growing the Crocs brand and having a new brand in Hey Dude and growing the company. Looking at the most recently closed quarter for Crocs, their revenues did really well. They grew by about 6% overall. Looking at particular brands, Crocs itself grew really nicely, overall 11%. In Asia, Crocs is really growing, which is really good to see. In North America, it's just a consistent growth. Direct to customer sales, which is interesting, really grew 15%. So establishing that relationship with the consumer is something that Crocs has been doing well. Hey Dude sales, not as good. They went down 9% overall. Direct to customer sales did go up 15%, and digital sales went up. So the Hey Dude brand needs to recover. It needs to start growing and really kind of, pull its own weight. So that way it could be a profitable category for Crocs. That'll be important to take a look at. The company repurchased shares, $150 million worth, and they're doing a nice job keeping their balance sheet healthy. Taking a closer look at their income statement, let's look at some highlights. First, revenues were up 6%, and their gross margins are expanding. Very good to see. The earnings per share grew 6%. Very good to see. If the company is growing top line at a good rate and also growing profitability at a good rate, that's a really good recipe. I like that. Looking at where sales are happening for the two brands, first, Crocs makes up 75% of revenues, while Hey Dude makes up 25%. Geographically, their main market is North America, but Asia is really growing fast. Europe and Latin America make up the last category. So it's interesting to see that they're growing in Asia. Obviously, that's a great market. So hopefully they continue to do so. Their digital penetration, 38%, and they have a direct to customer model. They sell 47% of their revenue through direct to customer. That's a very high amount, and it's a strength for Crocs. If they have a solid relationship with the customer, one, better loyalty. I think they could probably get good data back to make their company even better by designing shoes and distributing in a way that really pleases the end consumer. And overall, they could sell more products to that particular customer. So it's very good to see that their direct to consumer business is doing really well. It's one of the strengths of the company. News on Crocs. Most recently, Nike had a bad earnings and their stock tumbled. And Nike's the biggest player in the shoe market, so it brought everybody down. As a value investor, that's actually good news. If you give me a discount on a stock that has good value for no apparent reason other than a competitor doing bad, that's a good reason for me to buy. So that's actually good news for me. Analysts have really liked Crocs. As I look at the company, many analysts are saying, hey, Crocs is a good value. They're discounted, they're growing, and it's a good stock. Crocs provided updated guidance on where they expect they're going to finish the year. It looks like total revenue is going to grow 10 to 11%. That's very good growth. It looks like earnings per share are going to fall between $11.55 and $11.85. So I'm going to use those factors in determining my valuation based on earnings per share, and also use free cash flow, which is going to take into account how much capital they're going to be putting back into the business. The analysts see that earnings per share next year is going to be at $12.36. That's what I'm going to use for my earnings per share valuation on the company. It's good to see that earnings per share is rising and is expected to rise in the future. CNBC also puts the stock as a rising earnings per share rate. Their forward PE is only 8.6, which I think is unfair. I'm going to use a higher PE. I think there's could be a multiple expansion, especially if the company keeps growing their revenue and it keeps doing it in a profitable way. I think more investors are going to buy into the stock because it's a very good value proposition for an investor. I'm also going to use free cash flow, and the company has been growing their free cash flow. Very good, Crocs. And I'm going to use this cash flow rate, which takes the last 12 months, trailing 12 months. I'll use that in my valuation. I believe Crocs is discounted by 57%. And I get to that determination because I value the company on free cash flows. I also value the company based on their forward earnings per share. I'd like to take you through those numbers and get to that conclusion of the discount. First is free cash flows. And as mentioned previously, they have a good free cash flow rate. I'm going to take the trailing 12 months and grow it at 6% in the first 4 years. And then in the long term, I'm only going to grow by 3% to get to the terminal value. I'm going to use a higher weighted average cost of capital, mainly because this is a footwear company, and these fashion type companies could be great 1 year and 3 years later. They're not as popular. So I want a higher discount rate, which is going to give me a better return. Based on that discount rate and all these cash flows I expect, I have a net present value of all those cash flows of close to $12 billion. I'm going to add the cash on the balance sheet and take away debt to get to an equity value of $10.1 billion. The market cap on Crocs is $5.9 billion. So it really computes and gives me a per share value of $166.99. But the stock is being sold at $96.94. So based on free cash flows, there's a discount available on Crocs of 72%. Earnings per share next year, I'm going to use $12.10, which is a good middle of the road between CNBC and Stock Analysis, and it's $12.10. I'm going to use a higher PE than they've been trading. At 12 is very reasonable. This is a growing, profitable company, and I'm going to grow those earnings per share over time at 3%. Using this formula, I get to a per share value of $123.85. Stocks are being sold at $96.94. So it provides a 28% discount using the earnings per share method. I combine the two, but put more weight on the free cash flow method, 2/3 free cash flow, 1/3 earnings per share. And I get to that blended discount of 57% on Crocs. Looking at where the Crocs stock has traded over the last 12 months, it's down about 9% for the year to date. And I think part of it is the Hey Dude acquisition hasn't quite been as successful as I think they would have liked. So I think that's holding back the stock. I'm seeing that there was a recent rally here in the months of November and going into December. Now, a lot of stocks rallied during that time. We're in an 8-week rally, which has been really fun to watch. But overall, I think Crocs is still discounted for the year. There's a pretty significant difference between the price, the value that I calculate on the stock, and where they're being traded. So it's really interesting to see that this might be a good recipe for a value investor to pick up some shares. So should I buy or not buy Crocs shares? Let's take a look. So first, starting with the company, do I want to be a part owner in this business? Do I like the business? Do I like the management team? And it's yes to all the above. I think the company is doing really well. The management team is really hands-on and creative. I know the Hey Dude acquisition hasn't been a home run, but I really do give them credit for trying to grow the company and trying to resemble a company similar to Deckers Outdoors, which has been super successful, and that stock's really flourishing. The debt is under control, and it's less than 3 times EBITDA. They offer a nice discount on the stock. So I'm going to be buying shares of Crocs and building a nice position in this company. I currently don't own any footwear companies, and it would be good to have one so that I could have a good stock in that particular category. Thank you for watching the video. I hope you found it interesting. I'd love to get your comments on this company. Again, I think the shoes are really interesting. It's not something I wear. I'm thinking I might buy a pair just to kind of experience what the heck people are talking about, because it seems like everybody I talk to that has Crocs is somewhat of an evangelist. They kind of tell you, hey, I thought they were a little weird looking, but once I wore them, they're sort of uncomfortable and really durable and useful, that I ended up, using them, especially at home when I'm just, maybe doing some garden work or walking around the house or going for a walk. People that I talk to that own Crocs are really, they evangelize the brand. So I'd like to experience that and see what they're talking about. Do me a favor and like my video and subscribe to my channel. I'd really appreciate that. Hey, happy holidays and good luck investing in 2024. CrowdStrike had a horrible 24 hours by causing the biggest computer outage in history. Their software caused millions of computers to go down, airlines to not be able to operate. FedEx wasn't able to operate. It can go on and on. It was a huge blunder by this company. How far down will their stock price go down? I would like to talk about that in this video and see where I expect this stock to end up. To begin with, I filmed a video on June 6th of 2024 on CrowdStrike and shared my comments well before this blunder by CrowdStrike. So you can see that in that video, I had comments that basically were that this stock price was way too high. This is a very good company and they're growing, but I'll substantiate some of the comments I made in that video again and add on this blunder and what potentially could be the damage to the company's reputation, their brand. And it really opens up the door to competitors. And it really makes companies like Microsoft want to really develop their own security software and maybe make theirs stronger so they can eliminate companies like CrowdStrike out of their ecosystem. Let us not forget, Microsoft was primarily the operating system was taken down by CrowdStrike. So I'm sure there are some really disappointed, upset, maybe angry Microsoft executives. And they're talking to CrowdStrike and probably asking, what the heck happened? Now, to begin with, CrowdStrike provided a quite simple, and I would say packaged explanation of what happened. And I don't believe it. I think there's far more behind that. To cause the biggest outage in computer history, there probably was a couple things going on. There's probably more to it than we issued out a version release and the update had a bug, and that bug caused a lot of failure. I don't know that it's that simple. If it's that simple, why didn't you catch it? That would be my question is your staff that bad that you couldn't catch an error that was that simple? So that could be maybe questioned and that should be looked into and the company should explain why their staff couldn't catch a simple error. I don't believe it was a simple bug in the software. I'd like further explanation from the company. I think there's more to it and it probably won't be revealed to the public. Now, I have no information other than just my instincts as a business person and looking at the issue, looking at the magnitude of the carnage and the problems that they created, and in looking at the explanation. It's seldom that something so destructive was just one simple item. So I'd like to get a better explanation from the company, and hopefully that comes soon. I think a lot of people will be asking the same question, especially their big customers, especially Microsoft, who was really impacted by CrowdStrike's blunder. Having said that, in my original assessment of the company, I felt that the stock price was too high. Now, the stock price is not the company, and the company is not the stock price. Those are two different subjects. When I valued the stock in early June, I thought the stock was being sold at a premium, and I still believe that. In fact, I probably think that they're probably traded at even a higher premium going into next week. The reason for it is anybody who says they lost very little with regards to their reputation and brand, I'm not sure what they're looking at. They just caused the biggest outage in history. You're going to be stamped with that event for the next 5 years. Their competitors are going to use it against them over the next 5 years. Google is acquiring a company that does security software. It looks like a genius move now, and Google can compete against CrowdStrike. Google is massive. They have so many resources to develop software, make the best software on earth. They also have a sales organization that is huge. So they could package it as part of one of their cloud services. They can do a lot of things with that solution. And Microsoft can develop their own security software that is pretty close to or better than CrowdStrike. So I think there's a lot of things now that come into the picture and can really make the valuation for CrowdStrike different. When I did my valuation of CrowdStrike in early June, I estimated a premium being paid on the stock of above 30%. So you're paying 30% more than the company is worth. I just updated my analysis and using their current stock price and their current market cap. And I estimate that the way that I value the company using their free cash flows that I expect, and I give them a reasonable forecast and I haven't discounted that forecast, by the way, based on this blunder, I still estimate that they're being sold at a premium of 37%. That means that you're paying 37% more for the company than what the cash flows and the earnings per share are worth, at least based on my analysis. I'm not recommending you buy CrowdStrike. I'm not recommending you sell it. I'm not providing any financial advice. I'm just sharing with you my analysis and my conclusions. Now, as I look at this stock and think, what do I do with this stock? Well, I actually took action 2 weeks ago, and I'm glad I did. I started shorting CrowdStrike 2 weeks ago. And right now, my position has returned a 19% return on that investment in about 2 weeks. The reason I did that is I think CrowdStrike has really peaked from a valuation perspective. I think the road ahead is going to be quite bumpy, and there will be many questions. This may end up going up to the U.S. government. Maybe a congressional hearing will be asked for, and CrowdStrike will have to speak to Congress and really reveal a lot of the details behind this outage. It caused a massive outage, and I don't think that you can just quickly explain the situation and hope it goes away. We'll see what happens. But for now, I'm glad I started shorting CrowdStrike. That position looks like a good position for me. I'll probably be shorting additional shares at the right moments. I like to average in either when I buy a stock or I go into a short position. I like to dollar cost average my investment. In this case here, my short position. So I'll buy and sell based on a timeline. In this case here, I could see myself shorting $5,000 to $10,000 of CrowdStrike, and really I'm aiming for a 30% return, and then I get out. Short selling is very risky. I'm not a big risk taker, but there are certain situations that seem like a very obvious mispricing, and CrowdStrike is beginning to play out as a mispriced stock that is now dealing with a huge piece of bad news. Why would a more traditional investor be interested in cryptocurrencies? That's what I hope to answer in this video. I have historically been an investor in stocks, real estate, bonds. I've been educated in accounting and finance and have a master's, and really have been taught that stocks, bonds, real estate are really good investments. And I believe that, no doubt about it. But I started to really learn about cryptocurrencies about 10 years ago and started investing in them about 6 years ago. And it's been a really interesting journey, one where I really have grown and learned a lot of new things. More importantly, I think that I have a ability to see what truly is happening in the cryptocurrency industry. I'm not going to claim to be an expert. I'm an investor, and I'm careful with my investments in crypto. I'll share with you how I've invested and what the results have been. Overall, I'm an individual investor, and I'm not giving any financial advice. I'm not recommending you buy any of the coins I'm going to talk about. I'm not recommending you buy any of the companies that I'm going to talk about either. I'm just sharing my journey. I hope you find it interesting. So cryptocurrencies were born out of the financial crisis that happened in 2009. And as a result, the Federal Reserve had to pump a lot of dollars into the economy. And what a lot of people felt was really wrong is that they bailed out a lot of institutions too big to fail. AIG was a big insurance company. If they failed, they were going to take down a lot of other companies. And that was going to really have a dramatic impact on the economy. That certainly felt really unjust, really unfair. The smaller companies and individuals really felt like, well, if an individual goes bankrupt, the federal government doesn't jump in to help them out. But these giant organizations and companies, they get bailed out, which seemed unfair. A technologist thought, I should create a digital currency that has no government oversight, no government power to really change that currency. A government can't, issue out new dollars as an example, or new coins in the case of Bitcoin. They can't influence that currency. And Bitcoin was born in 2010. The developer developed some code that is, to this point, stood the test of time. Hackers can't hack it and take advantage of other owners of coins or the transactions of coins. He designed a distributed ledger, and this ledger exists on thousands of computers. In order for a hacker to manipulate the ledger, the hacker would have to simultaneously hack all those computers that have that ledger present in their computers and are validating that particular blockchain. The blockchain goes on the ledger. Fascinating that the technology was created. My hat's off to the developer of Bitcoin. It was a really awesome creation. So technically, I was really impressed. I think most people are impressed that, hey, he pulled it off. The person decided to stay anonymous. And that's also been interesting. Bitcoin's really seen a really dramatic rise. Early years, Bitcoins were really irrelevant. They were worth a few pennies. And now they're worth $70,000 a coin. So they have really rised up in value. Bitcoin has a market cap over $1 trillion. Amazing. So they've been around in less time. Bitcoin has been around less time than Microsoft, and it's worth over $1 trillion. Bitcoin performance for the last year, it's up 162%. Awesome performance. Ethereum is a newer coin, and Ethereum is kind of a second generation cryptocurrency, and its platform is designed to be able to better be integrated into applications. And Ethereum's done really well. It's up 100% in 1 year. So overall, the cryptocurrency market is a $2.6 trillion market. And think about in 2010, it was a $0 market. Now it's 2.6 trillion. A lot of the growth has happened recently with the introduction of ETFs for Bitcoin and now for Ethereum, the two most popular coins. And there was a lot of tension between the federal entities or federal regulators on ETFs. But what proved out is investors can make their own decisions on what they want to invest in. I don't think that anybody wants the federal government to tell us, what we should invest in and what we shouldn't. If we have the right information and can acknowledge that we're always taking a risk, no matter if we're buying the safest stock, the safest bond, we're always taking a risk. And with regards to cryptocurrencies, it should be left to the investor to decide if they want to buy a Bitcoin ETF or an Ethereum ETF. So I think free markets won the regulatory battle in that case. Now, there's been good news and bad news on cryptocurrencies. I would say the bad news that I was hearing 10 years ago was that people just completely didn't know the space. So they were almost treating it like it was evil because I don't understand it and I don't know it. Understandable. That's how people tend to protect themselves from being caught off guard and maybe surprised by something that's new. That's really faded. And really what's left is the naysayers tend to be people that have a vested interest in the status quo. They don't want cryptocurrencies to succeed because that could potentially replace their particular company, their paradigm, what they've been telling their constituents. So one person I'll put out there is the CEO of JP Morgan. And he is a very influential person. He's a very intelligent person, but he really will badmouth cryptocurrencies. And I would say that JP Morgan does not have a very strong position in the cryptocurrency industry. So he'll badmouth cryptos. And I think it's because his firm has really no vested interest in the space. So he talks bad about it. But I would say at the same time that JP Morgan has nothing going on in crypto, Coinbase is the only Coinbase is the only publicly traded exchange of purely cryptocurrencies. Its stock price is up 362% in 1 year. That's phenomenal. Robinhood, which trades a lot of cryptocurrencies along with stocks, it's up 136%. The Futu Holdings, which is represents Moomoo, it's up 85%, and they do cryptocurrencies. So the brokerages that are actively selling cryptocurrencies and ETFs to its account holders are flourishing. So it's really interesting to see, and I'll be curious to see how soon JP Morgan will get into the cryptocurrency industry. And I bet you if they do dabble and jump into the market, their messaging will change because they will have a different perspective as opposed to fighting it off because their competitors are thriving at it and they just want to badmouth it. We'll see. The good news about cryptocurrencies. So first is the ETFs are going great. I think people are comfortable in buying those ETFs. I have an old school brokerage and they provide ETFs. They also allow me to buy Bitcoin and Ethereum at no fee, which is better than what I used to get out of Coinbase. So I think I'm going to ride that horse until it doesn't make sense anymore of buying my Bitcoin and Ethereum coins through my traditional brokerage because they make it really attractive. So that's been really positive news. There's also been, what's been positive is FTX was a big disaster. It happened a couple of years ago and their CEO is going away to jail for a long time. Well, that's kind of going through the system. And I just want to point out, investors are getting their money out of their coins that they had with FTX. So the losses haven't been as big as one would think. It wasn't like everybody lost all their money. No, I think there was just a delay in getting your money back from FTX. And Binance is an international company. I believe their headquarters somewhere in Asia. They have their CEO going to jail for a short period of time for committing some fraud. And I think that's going to get handled. He's going to go to jail for a short period. I think he's already in jail right now. Obviously, that's bad press, but you can't say that all stocks are perfect, right? We have Enron, which happened, I guess, about 20 years ago, and all their officers ended up in jail. It was a huge fraud, and I could show you 25 frauds that happened with stocks. You know, when you have greed in markets, you're going to have some bad actors. There's certainly been some greed with cryptocurrencies, but there's also been some really positive things. I think Ethereum, as an example, is a really positive organization, and their coin really has a bright future. So I'm glad I'm an investor. There's also another thing of good news is that there's a new term that I learned, which was central bank digital currencies. And what these currencies referred to as CBDCs are, it's a currency that's going to help industries have a digital currency specific to the commodity they produce. And the perfect example is oil producing countries want to create a CBDC for oil. The current paradigm is you sell a barrel of oil, and that barrel of oil is pegged to the US dollar. I believe a barrel of oil, crude oil, is selling at around $76 today. And that's been the paradigm for a while. And what they are thinking of doing is digitizing it, creating a CBDC specific to a barrel of oil. It's not pegged to a fiat currency like the US dollar. It actually represents in a digital form what a barrel of oil is. That's really exciting to me. When I first started studying cryptocurrencies, I thought those use cases would make a lot of sense. They're becoming reality. That's going to take away some of the power that the US dollar is going to have over the oil industry. Because whether you produce that barrel of oil in Saudi Arabia, in, let's say, the United States, down in Venezuela, it's a barrel of oil, and it'll have a digital value represented by a CBDC. Really exciting to me. And I think more of that type of innovation is going to continue. Other industries, maybe steel, maybe copper, and other forms will be created, and it'll take this digital format. My investment in cryptocurrencies started really slow, and now it represents 7% of my overall portfolio. When I first started buying Bitcoin, it was trading at like $1,500 a coin, and now it's up to 70,000. And I was buying like $100 at a time. I just didn't know this space, and I wasn't jumping in head first. I was investing more time in trying to understand, trying to see where the use cases were. And I think that investment in time made me more comfortable, and I started investing more. I've been through a couple of peaks and a couple of valleys, referred to as crypto winters. And the winters allowed me to buy more coins and buy them at a discount. And I was able to maybe invest 2 to 3% of my overall portfolio, which is represented by stocks and bonds and cash. And that investment has grown to be 7% of my portfolio. It's not necessarily because I put 7% in, it's because the compounding and the appreciation of my cryptocurrencies have really grown. I'm not selling any coins. I don't plan to sell any of my coins. I think it's a good investment. It's a good hedge against my stocks and my bonds and cash. I like seeing innovation like the CBDCs because the more mainstream cryptocurrencies get, the more mainstream it becomes. I think the bigger it's going to get. It's already $2.6 trillion valuation of all the coins for crypto. And maybe that becomes 100 trillion at some point if you put a lot of these big industries into the ecosystem. So I wanted to share my experience with cryptocurrencies. Again, my point of view, I'm more of a traditional investor, investing in stocks, bonds, real estate. I've done wealth real estate. So these are very traditional investments, but I'm also a fan of technology. I've been studying technology, I've been working in technology, and cryptocurrencies just make a lot of sense. I would encourage you as an investor just to get familiar with it, study it, get to know it. What are the use cases? And not necessarily just read all the press headlines. I think the press really works with emotion, and it'd be, I think, wiser to focus on the facts and focus on, what is this space? What are they trying to do? And in making this video, I continue to share my experience with cryptocurrencies, and I appreciate everybody's comments. And I know a lot of people comment and they don't like cryptocurrencies; they kind of fear them, and I appreciate that. I respect it. Some of what I call friends online, they're not comfortable with cryptocurrencies, and I get that. I'm not telling anybody that you should be comfortable with crypto and that you should buy anything that I'm talking about. But really, I think it's productive when people on YouTube really do share their experience and what they're doing and what the result has been, what they've learned, what they've achieved. That's what I'm trying to do in this video. I hope you found it interesting, and I would love to hear your comments on cryptocurrencies. Before I depart, I wanted to talk about one of my sponsors, Moomoo. They were kind enough to reach out to me and begin to sponsor my channel, and I appreciate that very much. They have a new offer where they'll pay you 8.1% on cash for the first 3 months if you become a new account holder. And after that, it's 5.1. They'll also, if you deposit $1,000, they'll give you 15 free stocks. And that's pretty exciting. I'm waiting for my 15 stocks to be issued, and I'm curious to see what I'm going to get. They also allow you to buy Bitcoin, Ethereum on their platform, which is really exciting. So consider it if it's the right thing for you. I'd appreciate it if you use the link that I'm providing to get signed up. Thanks again for watching. This video is going to cover Cisco. They just announced their earnings, and I wanted to record a video. This is a stock I recently started to buy. I just saw a lot of value there for one of the historic pioneers in technology. Way back when the internet was being built, Cisco was the company that was red hot. Their routers helped build the internet, and they continue to be a leader in networking. They've diversified away from networking. They do other things around security and other aspects of technology. Overall, I still think Cisco is a real powerhouse. Although they're an older technology company, they really have a strong presence in networking and continue to drive free cash flow. The company has had a rough year and the stock was really sold off. So it provided a nice opportunity to come in and buy the stock at what I felt was a discounted price. They're expected to grow a little bit based on their earnings announcement. They're going to grow a couple percentage points. And if they can exceed that, look out. I think Cisco stocks are really going to go places. Let's take a look at their fundamentals. I'll do a valuation of Cisco, share that with you, and come to a conclusion with sharing with you what I'm going to do with this stock going forward. So Cisco is a large cap company at $182 billion in market cap. After today, they should be closer to 200 billion since their stock is up $6.29% in after hours. It's a large revenue company, 55 billion in revenue, and they pay a nice dividend, 3.5% dividend from a technology company. The PE is at 15, Ford PE is even lower at 13, so it looks pretty attractive. Analysts consider that it's a good buy, and it's discounted by 23%. Over the past month, the stock is down 4%, but if you include that 6.31%, I guess you could say they're in the green for the past month. For the year to date, they're down 10%. For the past year, they're down 15%. So this stock hasn't been going anywhere. Meanwhile, technology's just been really rallying. So Cisco's really missed out of this technology run that we've been in for 2 years. We look at their financials, their revenue has been growing. They haven't been setting any records, but the growth has been there. And they're expecting to grow from the current fiscal year that just ended, fiscal year 2024, and fiscal year 2025 should be maybe 3 to 5% growth in that year. So overall, the company is growing. That's good to see. And they are driving free cash flow. Free cash flow is one of the principal methods that I use to value the company. You can see that they have consistently driven free cash flow. Free cash flow was really good in 23. It's gone down a bit. And as you'll see in my valuation, I'm going to use a lower number just to bring down my risk in this investment. Overall, the forecast, we have 17 analysts cover this stock, so it's very well covered. There's one analyst that's really optimistic with a price target of $76 per share. I hope he's right. But on average, they're saying, hey, it's discounted by 23%. Not bad. When we look at their earnings per share, the earnings per share is $3.78, and it's going to be fairly consistent, not anything aggressively growing, but it's going to be nice and stable, growing in the middle single digit percentage amounts. So I'll use that in my valuation that I use for earnings per share valuations. So I did a valuation of Cisco using their free cash flows and then valuing the company based on the free cash flows I expect they're going to produce. I also value the company using the earnings per share. I combine the two. I put more weight in the free cash flow method. I just believe that that's a truer measure of value. And I get to about a 30% discount on the stock. And that's using the most current stock price, the after hours stock price that has been trading on. So that's a pretty nice discount on a company I think is got a lot of potential to continue to rise. It is an established company that is beginning to grow, and especially around security, that could really be a catalyst for the company to grow. The cash flows, I'm going with a more conservative forecast than maybe other analysts are using. I'm starting with the most current financials, full year minus free cash flow minus the capex, and then growing that modestly by 6% for the first 4 years. And after that, grow up 4%. The net present value is 223 billion. Add cash, take away debt to get to an equity value of 210 billion. Market cap, this is an estimate using the after hours stock price, is going to be 193 and some change billion. So they're almost fairly priced when it comes to free cash flows, a little bit of a premium, but it's in earnings per share that this is a very suppressed stock. And if they begin to grow, this is in the right space, good margins. I believe they really deserve more of a 22 PE. And that's what really drives a nice 71% discount. So when I blend the two, I get a 30% discount because I put more weight in that free cash flow valuation method. So how valuable and desirable do I think Cisco is? Well, let me go through that and give you my thought process through this decision. So I like companies in the green quadrant, in my desirability quadrant. These are companies that have strong barriers of entry to keep competitors out. They drive high growth, high margins, high free cash flow. And Cisco at one time was most definitely in the green. They've got more competition in networking and have somewhat eroded their moat to some extent. I'm going to put Cisco with a slight, slice of their business in the green, but most of it in the gray. I think they have a lot of relationships, especially with both domestic and foreign governments, that really help them sell. I think their credibility is really high. I think their security business can really ramp up, especially now that CrowdStrike really screwed up in the last 3 months. So I'm going to put Cisco there. It's important for me to get a discount on Cisco, and it's important for me to see that Cisco continues to strengthen their barrier of entry and really become stronger and stronger over time. Overall, I like the company. I think their products are really good. I think the company is a good one. I think their balance sheet's very good. They have almost as much cash as they do debt. They can pay off 60-70% of it, and they drive a lot of EBITDA. So they can really safely pay off all debt if they wanted to. They just acquired a business, and they're pretty much digesting it, getting it off their balance sheet. And that's a really strong sign of a good balance sheet. So I like company balance sheet, and I like the discount at 30%. So I'm going to continue to buy shares of Cisco and really load up on this stock. It's a company that pays a nice dividend, so nice income coming through from this stock, nice discount. And I think the best is yet to come for Cisco going forward. So that's my video on Cisco. Hope you found it interesting. Just remember, I'm just an individual investor. Just share my experience with you. I'm not providing any financial advice. I'm not recommending that you buy, hold, or sell Cisco. Please make your decisions on your investing independent of this video. With that, let me wish you the best success in 2024. And thanks again for watching. In this video, I wanted to cover CareTrust REIT, which is a real estate investment trust focused on providing short-term or long-term housing for the elderly that combines healthcare services, people that need to stay somewhere or live somewhere for a long period of time that need medical care. This is a category that's growing really well, and CareTrust has been doing really well over the last couple of years. In the United States, we have an aging population. We have baby boomers who have reached high ages and really need this type of housing temporarily or long term. So CareTrust is really working within a really good part of real estate, providing something that is in high demand, providing quality uh, properties that operators can then operate and provide really good housing for the elderly. Real estate investment trusts are a good income stock. They provide good dividends. In the case of this one, it certainly does, providing a 4% dividend to investors. Over time, this stock has appreciated. I've owned it for a while and I've done well. But I wouldn't invest in real estate investment trust. If you're looking for high appreciation, you may look at more growth stocks for that. Let's take a look at CareTrust fundamentals. Look at their earnings that they announced on August 2nd and update my valuation for the company. I'll share the results of the valuation with you. Also, let you know what I'm planning to do with this stock. Am I going to buy more shares, just hold my shares, or sell my shares in CareTrust? Let's take a look at the fundamentals. The market cap for CareTrust is 4.29 billion. The company's done well. If you look at the one-year chart, the stock's up 35% over the last 5 years. It's only up 19%. And it's provided good points in time when you could buy this stock at a really nice discount. I took advantage of that, or at least I tried to. The revenue for the company is $245 million. It's really good, consistent revenue that's been growing. The dividend on this stock is 4.17, really good. The PE is a little high at 47.96. It's expected to come down next year. Analysts really like this stock. It's a buy rating, but it is priced at a premium currently, according to analysts. Looking at the financials, the company has been growing revenue nicely. This is a real estate investment trust, and it's good to see that the revenues are growing really, really well. I don't look at cash flow for REITs because they tend to have a lot of cash flow, and it's not the right way of valuing a company. The balance sheet as well, they have to carry a high amount of debt. I just want to make sure that it's a sound balance sheet, that the debt that they have is collateralized by good properties, which is the case here. And I believe the balance sheet and the cash flow statement look okay with this real estate investment trust. Analysts cover this stock, 8 of them cover it. And in general, they have a lower price target than where the stock's currently trading. Real estate companies had a really good 30 days. If you noticed, interest rates fell and real estate stocks really rallied. That might be part of why it's being sold at a premium currently. Analysts believe it's being sold at a 10% premium if you compare it to their price targets. Their analysis is primarily based on earnings per share. The earnings per share is expected to be $1.04, and that grew substantially from last year, doubled. And it's going to grow at around 12% in 25 and then be fairly flat on 26. I'll use the earnings per share as part of my value evaluation. And also look at their dividend and see if I can get a value for the stock based on their dividend. So what do I think CareTrust is worth? Let me value the company, and I'm going to use their dividend rate as well as earnings per share to arrive at that conclusion. The dividend has been really steady, and they can afford to pay out the 36 cents per quarter dividend. They pay out 81% of funds from operations, and the dividend rate annually is $1.16. The value per share, if I use the dividend rate, is $29 per share, but the stock price is trading at $27.83. So it offers a very small discount if I value the company using their dividend payout ratio. Now, if I look at earnings per share and use their expected earnings per share this year and a PE of 24, I get a value per share of $25.96, which is lower than their current stock price by 7%. That said, when I average the two, I get a 1% premium that is being paid on this stock currently. How desirable do I think CareTrust is as a business? Well, I'd like to go through that and rank them in my desirability quadrants. I love companies in the green. These are companies with no competition. They have great barriers to keep competitors out, and they make lots of money, lots of free cash. In the gray, they do have competition, but it's a good industry. They could make good profits. The red, I try to stay away from, which is industries where there's just too much competition. Prices are going down, revenues are going down, profits are going down, and cash flows are very, very hard to find. So where does CareTrust rank? Well, I do like that they really specialize in providing the housing, the properties for the elderly that need healthcare while they stay there. I think it's a growing category. It's an expanding market. So that's really smart. They specialize in that particular type of property. So I think that expertise is going to help them in the future. They're also a very well recognized company that is operating. So operators, other businesses that want to partner with them, they really want to partner with CareTrust because they really know what they're doing. Having said that, they're not completely in the green. I'm going to say they're more in the gray than they are in the green, but they do have some barriers of entry, which is that they have that specialization within the space that attracts partners to do business with them. They have a very good model going. I don't see this model changing in the next 10 years. I think they're going to continue to do well. Therefore, most of the companies in the gray, a little bit is in the green. It is a desirable real estate investment trust for me. So I really like CareTrust REIT as a company.
I like their focus. I like their balance sheet, but there's no discount. So I'll carefully continue to hold my shares and wait to see if the stock drops and provides a discount. I'd probably be a buyer. But for now, I'm just going to hold my shares of Care Trust. Thank you for watching the video. I really appreciate it. Just a quick reminder that I'm just an investor. I'm not providing any financial advice. I don't recommend you buy, hold, or sell Care Trust. This is just a video sharing my analysis and what I'm doing with this stock. I hope you found it interesting. Thanks again for watching. Good luck investing. CVS is a well-known pharmacy company, but what people don't know about the company is they acquired Aetna a few years ago and became a healthcare payer, a health insurance company. And the insurance business is quite lucrative. You collect a lot of premiums, have that cash at your disposal, then you pay on those premiums as an insurance company should. That really changed the CVS business model. What they're also embarking on is providing health services at their locations. This could be urgent care, health services, just, ordinary things like somebody has strep throat or some condition that could be treated just by going in and seeing a doctor, getting a good pharmaceutical, and then going home. I think it'd be more convenient than going to an urgent care facility or a hospital. So overall, CVS is trying to break away from just being a retailer and really being a healthcare company. I think that strategy is a good idea. They announced their earnings today, and I wanted to go through the new information they provided, update my valuation on CVS, and then make a decision whether I should buy more shares, hold, or sell my shares in CVS. Let's take a look at the fundamentals, and then I'll go through a full evaluation of CVS. Let me share that with you. CVS is a $73 billion market cap company, and they have a lot of revenue. It's over 360 billion per year. That's a lot of revenue. And they have nice net income of 7.3 billion. They have a very low PE of 10.24, and their forward PE is even lower, under 8, which is really, really incredible. The dividend rate is pretty attractive at 4.56%. Analysts, several of them cover it, and they think it's discounted by about 28.66%. If you look at the company's performance, they haven't had a great year with regards to their stock. Year to date, it's down 26%. More recently, healthcare has seen a rise. As we head into potentially a recession, the healthcare sector is a good sector to invest in because no matter if we're in a good economy or a bad economy, people will go to the doctor if they're sick. So they've seen a little bit of a rise in their stock. After announcing their earnings, the stock is pretty much flat, hasn't really done much, which is meaning that investors are not overly excited, but they're not going to sell it off. Looking at their financials, the company has been growing their revenue, which is good to see, just year over year growth. And I'm a little surprised that the stock has performed as bad as it has, because one of the metrics that I look at is revenue and revenue growth. If revenue is growing, that means the company is doing something right. They're probably selling a product that a customer appreciates. Customers are happy with the company. These guys they have a product that's desirable or a service that's desirable. So it's a little surprising that the stock has kind of gone in the opposite direction to their revenue growth. What's made CVS attractive to me is their free cash flow. For many years, they've provided really high free cash flow, but the recent years, cash flow has dropped. That might be the reason why the stock price has been suffering. And this year, it's expected that cash flow will be quite low. And I'm going to use the low figure in my valuation of CVS. They can come back to that 13 billion plus free cash flow rate. I think the stock will really head up. I did a valuation on CVS by discounting the free cash flows I expect the company is going to produce in the future, and also looking at their earnings per share and then valuing the company based on earnings per share. I get to a blended discount of 30% on the CVS stock. That's a pretty decent discount on a very well-known name. Let's take a look at cash flow and how I got to a discount on cash flow. So the guidance for the current year, they updated it in their earnings, and I used a $6.3 billion figure, which is quite low. And then I'm growing the cash flow by 10% in the first 4 years, and then terminal value would grow by 4%. I think this forecast is really conservative. If they get back to that 13 billion plus rate, this really changes it to the better, to the upside. But I'll be conservative. I'm also being conservative with the discount rate, 9%. This is a well-known name, but their balance sheet has accumulated some debt. They acquired Aetna. They're carrying a higher amount of debt than they did traditionally. So I'm going to have a higher discount rate on CBS. I'm going to add the cash in short-term investments, and I'm going to take away debt to get to an equity value that I believe all those free cash flows are worth. And that amount is $90.7 billion. Compared to the current market cap, it provides a 24% discount if we look at free cash flows. And earnings per share was toned down a bit. I'm going to use the toned down earnings per share that we expect for 2024. Use a very low PE of 12. They've been a growing company. It is surprising that their PE is so low. It must be the sentiment on the stock is just so low. I'll use a low PE ratio, although I think they probably deserve more like an 18. And they are going to grow those earnings per share. So it gets a really nice expected value of the stock of $82 compared to their current stock price. It provides a 42% discount. A lot of analysts agree that the company is discounted, that it's a buy. So I'm right there with them. Blended, when I blend the two and I put more weight on free cash flow, it has a 30% discount, which is attractive on a well-known name. How desirable is the CBS company and their businesses? Well, let me make that decision. Ideally, I like businesses that are operating in the green quadrant, which is a quadrant that includes companies that have really strong barriers of entry to their competitors. Competitors can't come in and compete against those companies. It could be patents that keep a pharmaceutical exclusive to a particular drug. It could be software where that software is just the best and customers want it. There could be a lot of variables there, but it gives those companies huge advantages. Let's see, and in the gray, those companies are potentially good companies, but they have competitors and they have to compete every year. In the red, those are businesses that have too many competitors. They're probably on really old industries where the competition is excessive, profits are low, free cash flows are low, or maybe even negative. I don't like buying in the red. CBS is really in the gray, but I like that they're investing and have a business as being a healthcare payer and insurance company. It gives them a lot of cash to work with, and they're making themselves different. They're not just a retailer. You could say that they are more of a healthcare provider. So with that, I think they're moving a little closer into the green. So I'll give them a slight, percentage of the business in the green. If they continue to do well in having that combination of being a healthcare payer, healthcare provider, and a massive retailer and pharmacy business, they may become the Walmart of healthcare. That might be a very powerful position to be in. So I like what they're doing with their business. Having said that, I make a decision to buy, hold, or sell based on three areas: the company, balance sheet, and the discount. The company, I like what CVS is doing. I like that they're really growing and expanding beyond just being a great pharmacy business. So I like the business. The balance sheet, although they have more debt, you can account for that debt. They acquired a big entity in Aetna. They continue to generate cash flow so they can pay off that debt. So although the debt provides a debt to EBITDA ratio above 3, I'm going to give them a pass on that for now. The discount, it's a good discount. I use very conservative figures in my valuation. Having a 30% discount is, I think, worthy of me buying more shares. So I'll be buying more shares of CVS and continuing to grow my position in this healthcare company. It's not a bad time to be investing in healthcare, so I'll be glad to buy more shares. I like that dividend. That steady income will really be nice, especially as we operate in a declining market. The month of August so far has been a tough month for stocks. Stocks have gone down in value quite a bit. So that's my evaluation of CVS. I hope you found it interesting. Just a reminder, I'm an individual investor. I'm not offering any financial advice. Please buy, hold, or sell CVS independent of this video. I appreciate you watching. Good luck investing in 2024. It's a down week for stocks this week, but one sector that's doing well is the energy sector. And I own Chevron. It's one of my bigger holdings, and I'm really glad that I own it this year. The reason I own an oil company is that it's a hedge. When oil prices go up, it tends to send a lot of other assets down. And oil prices have been going up. Oil prices have hit about $85 a barrel, and that's a pretty good rate. If you look at the last 5 years, it's probably up there in the upper 80 to 90% quartile of where oil prices have been. At $85 a barrel, Chevron will be very profitable. As a result, the stock is up more than 7% year to date. if you measure the appreciation of the stock price and the 4% dividend that the stock pays. Chevron's part of my income portfolio since it pays that 4% dividend, and it's a really nice income producer for my portfolio. I'm going to go through and update my analysis of Chevron and share with you what my plans are with this stock going forward. Chevron has very good fundamentals. The stock is up 6.5% year to date. And if you add the 1% for the quarterly dividend, it's well above the 7% return. For the past year, it's actually down a bit by 6.64%. And that's because oil companies really struggled in 2023. And you notice how all other stocks seem to have been doing well. That's because oil prices were tamed last year. If you look at the market cap of Chevron, the market cap is $296 billion. It's a big cap. They have revenue of $200 billion. So you're paying about 1.5 times revenue for that company. Net income is really solid at $21 billion, and they produce a lot of free cash flow. The forward earnings per share is 12.83, very solid. And the company is very profitable. Multiple analysts cover the stock, and in general, they have a buy rating on Chevron with a target price of $180 per share, above the $159 trading price that it's currently at. The price targets vary based on the analyst that's looking at Chevron. You have some analysts that are expecting a price target of $201, $180 is the average, and some investors or analysts believe the price target should be $150. So it's not too broad of a range. And in general, most analysts have it as a strong buy or a buy rating, and then everyone else is a holder. So it's a solid company. Chevron is owned by Warren Buffett as well as other big investors. Again, because it's a good hedge. When oil prices go up, you're really glad you own an energy company. I valued Chevron based on the free cash flows I expect they're going to produce, as well as the earnings per share that they have. And I come up with a stock value of $186 per share, but it's currently trading at close to $160 per share. So I have a 17% discount on Chevron. That's a good discount on a high quality company with a quality balance sheet that pays a 4% dividend. So should I buy more shares in Chevron, just hold my shares, or sell my shares in Chevron? I look at 3 areas to make that decision. The first area is all about the company. I'm going to be a part owner in this business. Do I like the business? Do I like the industry? Do I like their management team? And it's yes to all the above. Chevron has an excellent management team. The company is very well operated. Second is the balance sheet. Is the balance sheet in good health? In the case of Chevron, the balance sheet is in great health. Their debt to EBITDA is well below 3, which is a ratio I like to have. But overall, their balance sheet is excellent. And in their balance sheet, there are a lot of reserves, a lot of properties, a lot of assets that are at book value and are really worth much more. And third, it's all about the discount. Am I being offered a discount? In this case here, yes, a pretty good discount. Really thinking about a high quality company, you're not expecting a wild discount of 50% or 100%. 18% discount on Chevron is a very good discount on a high quality company. Therefore, I will be a buyer of Chevron stock. Thank you for watching the video. I hope you found it interesting. Chevron's a high quality company, and it's always great to have it in my portfolio, especially now that oil prices are really going up. Let's see where oil prices go and where the stock price for Chevron ends up for 2024.
Welcome back. In today's video, I'm going to be covering a small cap company by the name of Danaos. This company provides ships for supply chain companies to move containers around the world. They've been doing really well for 5 years, and I'd like to take a look at their financials and see if it's a good company to invest in. I don't currently own any shares in this company. This company actually came up in one of the comments on one of the videos that I produced, and for the subscriber that provided that tip, thanks for the idea. And here I am, analyze the company, and I'm recording a video. So I'm going to get into my process that I use as I evaluate companies. And this is a very fresh company. I looked at their financials. I'll go over their financials and then get to a conclusion, which is, am I going to buy shares or am I going to not buy shares in this company? Before I move into the analysis, do me a favor and like the video, subscribe to the channel, and keep those comments coming. I really appreciate the comments on the companies that I cover, and as well as the videos themselves. I try to improve videos based on comments. So let's get into this company. So I follow a consistent process that I've developed for myself over the years. And the process involves 4 key questions followed by a decision to buy or not buy this particular company. And first, I want to make a decision. Do I want to be a part owner in this company? Do I want to be part of the industry? Do I think their management team's doing a good job and operating the business well? Is debt under control, well below 3 times EBITDA? And I want to discount the stock so that way I can make money on my investment in this particular company. And based on the answers to those questions, I buy, hold, or sell. So we live in a connected world that has a global supply chain. Here in the United States, we get so many goods from Asia, from Europe, from all over the world, and they're carried around on these big ships. And these ships carry containers worth of stuff, both into the United States as well as from the United States to other parts of the world. And other Asia ships to Europe, Europe ships to Africa, so these ships are all over the world getting goods from where they're produced over to where they're going to be consumed. Needless to say, supply chains are really important and I think are going to continue to be in high demand. Therefore, I'm really interested in a company like this that actually owns the ships and leases them out to the companies that operate them to move goods around the world. I think it's a solid business. They're going to have demand for a long time. So I like the industry. And this company in particular, I really like because they've been growing their business. And I think it's a good mindset for them to have, which is to have a very large fleet of ships that they lease out to the leading companies that operate them. Looking at their annual report for 2022, it shows that their revenue, they've done a really nice job of pretty much doubling the company. They have $458 million in revenue, but now they're close to $1 billion in revenue if they add up all the revenues for 2022. So great job in growing the business. Also, profitability has been really good for the last 4 years. Diving into the income statement for the most recently closed quarter, we can take a look at revenues, which are coming down a little bit. The last quarter that ended on June 30th was $241 million, but the prior year was close to $251 million. So it's gone down about $10 million in revenue on the top line. That's understandable. I know that inventories here in the United States, retailers and other merchants actually have excess inventory. So there's not a lot of demand for new replenished inventory, but I think that'll eventually, pick up. For now, I can understand that they had, less volumes being shipped. So understandable that the revenue did dip a little bit. What's good to know is that they are continue to be profitable, which is very good. And for the first 6 months, which is represented in this column, they are, really carrying a nice profit for the first 6 months. And I think that's going to continue through the rest of 2023. Looking at the balance sheet for this company, they've got a fair amount of cash on the balance sheet, $293 million, especially compared to the balance sheet long-term debt, which is 390 plus 27. So $417 million of debt. The net debt, when you take the debt minus the cash, is really only $124 million. Their EBITDA for a full year is approximately 374. So it's well below that 3 ratio that I'm looking for. What this means is they can basically pay for all their debt if they operated the business for about 4 months and just strictly paid off debt. So debt is under control. They have a healthy balance sheet. Looking at the statement of cash flows, it is doing well. If we look at the first 6 months, they've produced $280 million from operations. They've only had to put about $30 million back into the business to keep things operating. So overall, they have about $250 million of free cash flow. I also looked at the last 5 years, took an average, and happened to coincide with that number. It ended up being $252 million of free cash flow on average. So I'm going to use that number in my valuation using free cash flows. I believe that Danaos is discounted by 63%. What I mean by that is that each share, I think, is worth about $107 per share, but the stock market will sell you shares at $66. I get to this value by looking at free cash flows and earnings per share. The free cash flows I estimate the average for the last 5 years is $252 million. So I'm going to use that as a starting point. I actually think it's going to go down over the next couple of years just to be super conservative and expect that we're going to have this recession prolong. The amount of shipping isn't going to be as high as prior years. So just to be conservative, I'm going to have it go down for the first 4 years. After that, I'm going to have it grow at 3%, as I expect after year 4. There will be some growth, and all the cash flows after year 4 will be about $2.3 billion in free cash flows. I'm going to discount those free cash flows to get to a net present value of today's value of those cash flows by 12%, which is a nice high discount rate, making this a conservative estimate. And I get a value of $2 billion for all those cash flows. I'm going to add the cash on the balance sheet and take away the debt, which brings us to an equity value of $1,887 million of value in this company. Their current market cap is 1.3 billion. So it offers up a 42% upside using the free cash flow method. Looking at earnings per share, their earnings per share look really good. Looking at the next 4 quarters that I expect, they're going to produce about $30 per share, which is really attractive. And if I discount those that earnings per share and I value the company based on that using the earnings per share valuation method calculation here, I get to a stock price of $135.99. But you can buy shares for $66 from the stock market. So there's really a really attractive discount when you use the earnings per share method. I use the free cash flow method as most of the valuation. I use 2 parts free cash flow method, 1 part earnings per share. And I get to an average of 63% as the potential upside on this stock in Danaos. Looking at the stock over the last couple of years, it really had a nice run up at the beginning of 2021. It really went up, and obviously their strategy really worked. So the company got valued much higher. It's been hovering around between $50 and $70 per share, and their current stock price is at $66 per share. I think the company is worth 107, so it provides a nice upside potential in this stock. Year to date, they're up 23.7, so you'd be beating the S&P if you had bought shares in Danaos on January 1st. And they pay a dividend of 4.5%. So it's a nice, healthy dividend on a company that has fairly good profitability. So should I buy shares in Danaos? Well, let me go over my 4 questions that lead to that decision. I do want to be a part owner in this business. I really believe that the supply chains that we have are just going to continue to get bigger, and they're going to be more important in the future. The whole global economy, it isn't going away. I think we're just going to continue to have goods being shipped around the world, and these ships are going to be really important for all the producers to get their products to the markets that consume them. I like the company. They're operating very well. Their strategy has really worked. So their management team has great vision and has really led the company well. Debt is well under control, way below 3 times EBITDA. And they offer up a nice discount, and they'll pay a dividend too. Therefore, I'm going to begin to buy stocks in Danaos. That's my video on Danaos. Again, I want to thank that subscriber that gave me the tip on a comment that I should look at DAC. It was a nice tip. I looked at it, and it's a really good company, so I appreciate that. Please comment on this video and provide feedback on the company, what you think of the company, what you think of the video, and any other ideas that you have in this industry. Do me a favor and like the video and subscribe to my channel. I'd really appreciate that. Good luck investing in 2023.
Welcome back to my channel. In this video, I'm going to be covering DoorDash. This is a new economy company that allows people to have food delivered to their homes. And now they are branching out to other types of products, whether you want something from the grocery store or a package delivered. But they primarily serve restaurants. and they've been very successful. The company's been growing really well. They're profitable and generate free cash flow, which is the reason why I started investing in them over a year ago. It's gone well to this point. They had an earnings call and their stock really tumbled. I wanted to take a look at their earnings and see where the problem lies. What is the big concern? I've been holding on DoorDash stock because the stock had run up so much that the stock price is above the value I had previously. I want to recalculate the value that I have for DoorDash and see if now the price has come down and the price is discounted. We'll take a look at that, and I'll make my decision whether I want to buy more shares of DoorDash, hold, or sell my shares. Before I jump into that, just remember that I am sharing my individual investor journey. I am not recommending you buy or sell DoorDash, and I am not providing financial advice. I'm just providing my experience, and I hope you find it interesting. DoorDash is competing with Uber Eats and a couple of other players here in the US for the market share around delivery of food and now delivery of other products. We have really changed as an economy where, we used to go to the store and buy things, and that is really changing. It has become so convenient to have food delivered and to get our products delivered. What DoorDash is also doing is they sell a subscription where you pay a monthly fee and you get unlimited deliveries to your home, which could be quite lucrative. If you think about what you could save, gasoline, maybe you don't even want to have a car. You can have all these things delivered for $10. That seems like a pretty good deal if you get, 5 to 20 deliveries a month, delivered to your home. So it's really changing the way that we consume restaurant food, our groceries, and so forth. Really exciting. This has been a high growing stock, and they continue to grow, which is really good. I'll take a look at their financials and I'll look at their earnings to make sure that the earnings is going to continue, which is a big factor in valuing this company. Overall, I think it's a really good company, run really well by a strong CEO and his team. And I think they are really persistent on trying to get better efficiently. And that's really going to drive better profitability, which is very good. I also like that they're growing and branching out to other types of products that could be delivered. The restaurants, I think that market space has maybe been tapped into enough. There might be a little bit of growth left there, but I think they can grow in other areas. I think grocery stands to really be a good growth area because, frankly, we need groceries every week. And it's nice to have, especially if you get the subscription to DoorDash, you can have a few items delivered every couple of days, make it really convenient for yourself. So overall, I really like the business. I like the management team. And I'd like to take a look at the fundamentals next. So DoorDash is a $46.9 billion company. That's a pretty good market cap for this company. They're a young company, but they're in the right space. The revenue is $9 billion, pretty good revenue. And you're paying, upwards of 7 times revenue for the company. That's a pretty good price because this is a growth company. So it's not priced as expensive as other companies that are growing. Their forward P is really high, frankly, because their earnings per share is really anemic. This company has a lot of stock-based compensation to its employees, and the reporting rules require it to put it on its income statement. Although it's not a expense where they're writing out checks, they're just issuing out stock. So it really affects earnings per share. Now, we could probably start a good argument around stock-based compensation. Some people think it's just terrible. I happen to think that it's a good thing. You're making employees that are really important to the company part owners of the business, and likely will be working that much harder, that much more intensely to make DoorDash successful. So I'm actually in favor of stock-based compensation and don't think it's an evil thing. I think it's a good thing. And you're not consuming cash that the company has. So if you're not consuming cash, you can use that cash to grow the business. So that's where I stand on stock-based compensation. But when we look at earnings per share, you're going to see that the number is rather low compared to their free cash flows. Now, a lot of analysts cover DoorDash, and in general, they have a price target that's 7% higher than the current stock price. So it shows that there's a small discount available potentially based on analyst expectations. The stock has been going up for the past year. It's up 81%, but recently it's down quite a bit. In the last month, it's down 19.6%. So this dip, does it represent a good opportunity or maybe just taking some of the froth off of this stock? Well, we'll take a look at my valuation and I'll give you my opinion of where the stock ought to be priced. Revenue growth for DoorDash has been excellent. If you look at the last 5 years, just tremendous growth in 19, 20, 21, and it started to slow down. That's just the law of big numbers. As you get bigger, it's harder to grow and make that big percentage because they went from being less than $1 billion company up to now a $9 billion company. So their growth is the percentage has been going down, but the amount of revenue has been going up, which is very good. Just very good growth rate from DoorDash, which is one of the reasons why the stock was really working for the past year. DoorDash is in a business where they generate free cash flow, and that's great. That's why the company's worth what they're worth, is that the operating cash flow has been going up over time very nicely, and they don't have to spend a tremendous amount of capital expenditures to grow the business and keep the business operating. That said, they have really good free cash flow that I'm going to use to value the company, and it's been growing tremendously. So that's a very good combination. And I believe that's one of the principal reasons why the stock price and the market cap of this company is as high as it is for a very young company. 28 analysts cover DoorDash, and collectively they put a buy rating on this stock and believe that the stock ought to be priced 7% higher than where it's at now. The top end of the analysts believe that the stock's worth $170 per share, and the most pessimistic analyst believes the stock's only worth $51 a share. So it's pretty wide dispersion of analyst reports. I'm going to take a look at my own valuation, but again, a lot of analysts cover DoorDash, and no stone is left unturned on this company. The earnings per share is where we hit a wall with this stock. And the reason for it is their earnings per share in 2024 is really low. It's only 20 cents a share. So that's really going to calculate our super low value for this stock. I'm going to use 2025's number and then bring down the PE ratio just to, value the company based on its future. Its future looks really bright. If they can hit, the 25, 26, 27 numbers, the stock will have a really nice earnings per share within the next 3 years. But for now, this year, the earnings per share is really low. DoorDash announced their earnings on May 1st, I believe after the market closed, and the stock really went down, which was, I guess, understandable because the CEO really downplayed and felt that they could have done better. Other companies that have been really good performing stocks, like Meta is known for this, is they have a really good earnings and then they just, pour cold water on it. I think part of it is that DoorDash stock is up so much that the CEO has, the room to kind of pour cold water on their earnings so that investors don't get too enthusiastic about the stock and really run up the stock. He basically maybe set up the company to outperform the expectations going forward and just keep, the upward momentum going. That's me speaking. That's my imagination working, but that's what I'm observing. Overall, their earnings I thought were positive. The company grew their total orders by 21%. That's really good. And if you look at the overall amount of restaurant food they're delivering, that's really gone up by 21%. So excellent. Now their orders went up by 21%, but the revenue went up by 23%, which means their prices are going up. And I think that subscription model is beginning to work. So two really good things out of the top line revenue of DoorDash. Looking closer at their operations, the total orders went up 21%, just really good growth quarter over quarter. And they're comparing this year's first quarter compared to last year's first quarter. And that's just very good growth. Again, the value of what they're selling has really gone up 21%. And then revenue's gone up. Their profit is increasing. Very good. So it's important that not only are they growing the top line, but they're actually growing their profitability. Really important. Very good to see. Their EBITDA keeps growing. And EBITDA I use to make a judgment call on their balance sheet. But their balance sheet's excellent because they have zero debt and they have $4 billion cash and they have positive EBITDA. So overall, the balance sheet's in such good condition that they could operate for a long time without ever having the big fear of bankruptcy. The company provided forward guidance, and the guidance is very good. They're going to keep growing pretty much at the low 20% growth rate that they've been experiencing, providing positive EBITDA growth. Those things look really good. The stock-based compensation continues to be one of the areas of big expense. And again, I shared my views on stock-based compensation. It's actually a good thing. If you look at some of the most valuable companies, you'd be amazed at what they pay their CEOs. They pay them over their career. geez, over $1 billion if you look at like a Microsoft or an Alphabet. So it's really, I think, a good thing when you make the key employees part owners in the business. We'll see how that plays out. I'm sure over time, as they need to hire more people, that ratio will go down. So what do I think DoorDash is worth? Well, let me do the calculations and share that with you, and then tell you where I think the stock ought to be priced compared to their current stock price. So first, I'm going to value the company based on free cash flows. And the company generated really good free cash flows. They've been growing really well. So I'm actually going to take the cash flows from 2023 and increase them by 15% as my starting point as cash flow. And then I expect that in the first 4 years, it's going to grow at 15%. And then after the first 4 years, I'll be conservative and say they're going to grow at 4%. That'll set up all the cash flows after year 4. I'm going to discount the stock by 9%. This is a dynamic, somewhat small company, so it's a little bit higher than I would have used for Meta or Alphabet, very established companies. When I discount all those cash flows I expect in the future by 9%, I get a net present value of $43.7 billion. That's what the company cash flows are worth. And I add the cash, they have zero debt. So it actually increases the equity value of the company. And compared to their current market cap, it's, I would say, fairly priced. The current market cap's $45.6 billion, and it provides about a 3% discount. I'd rather call it fairly priced. Earnings per share, I'm going to use 2025's numbers because 20 cents per share would have created just a huge premium in this calculation. I am going to limit the PE. I think the PE should be higher than 24, but since I am using 25's figures, I'm going to use a 24 PE. The growth rate's really dynamic on earnings per share. It's going to grow at 20% after the 138 earnings per share figure in 2025. That drives the stock value of $39.74, but the current stock price is $113.97. So there's about a 65% premium if you look at the earnings per share value of this stock. Combined, and I put more weight on the free cash flow method, it's a 20% premium on DoorDash. So the stock has run up over the past year, and I think this business is a real good one. I think they just need to grow their earnings per share, and the stock will continue to be more valuable. They also really need to continue to diversify their business and really have a market share that they can defend and really continue to grow. They have some pretty good competition. Uber would like to replace them, and Uber is a pretty strong competitor. So we'll see if DoorDash can outmaneuver Uber, because Uber is principally a ride-sharing company. I think DoorDash, this is their focus. This is their backyard. We'll see how competitive they can be over the next couple of years. So should I buy, hold, or sell DoorDash stock? I'm going to look at 3 things. First, the company, second, the balance sheet, and third, the discount. With regard to the company, I just think the company is excellent. I think it's a company that was created by a new generation of entrepreneurs, created really well, very sound business. Technology is excellent. I think they have room to grow. Operated by an excellent management team. Their CEO is excellent. So overall, I really like the management team. I like the business. I like how profitable this business is. I like how much cash this business generates. The most valuable companies create a lot of free cash. You look at the top 6 companies on the stock market, they all generate tremendous high cash flow. And DoorDash generates high cash flow. So they're at a current market cap. I think they could really expand that market cap in the future. The balance sheet. Well, when you have zero debt, you automatically look good on the balance sheet. And I don't see any other liabilities that would worry me. They're in a really good spot where they have a very good balance sheet, plenty of cash, and are growing their business. They can grow with the cash they have on hand and the free cash that they generate. They don't have any need to, go out and get debt. Maybe someday in the future, they may need to do that. But at this time, the balance sheet is excellent. Discount. There's no discount on DoorDash. There's a 20% premium. And I already own a fairly good position of DoorDash. I'll share that with you after I make my conclusion. But I think I'm good with just holding my shares of DoorDash and just waiting to see how their business develops further, and then making a decision on whether I should continue to hold, buy more shares, or sell my shares. There's been some companies where I have regretted selling too early after making a good gain. Probably the most recent one is Amazon. I owned Amazon. I sold it in late 23. I felt like the stock had become too expensive, and I was looking at that market cap, and it was getting really high, and I did sell. I probably sold at a price that has appreciated since then by about at least 20%, maybe 30. So I missed out on that additional gain. And that's a lesson learned that, investing in great companies is a long-term mission. And at times a good company will be sold at a premium. It doesn't mean I have to sell. In some cases, I'm really glad that I sold. TSM is another example. I sold TSM pretty much near their high that happened a few years ago, and then the stock tanked. So that scenario did work. I felt that TSM was being traded above their value, and I'm glad that I sold it because I had a big position at the time, made a big gain, and then the stock went down more than 70%. So I'm glad that I'm keeping DoorDash, but we'll be continuing to evaluate it twice a quarter and then making my decisions going forward. My investment in DoorDash was $6,897, and the current value of my stock is $8,672. So the total gain unrealized is $1,775, representing about a yield of 26%. This is a little over a year of holding this stock. I started investing in it in early 2023. So overall, I'm very happy with the stock. It's done. It's appreciated really well, and I think it's an exciting company that's worth keeping in my portfolio. Hey, thank you for watching my video on DoorDash. I hope you found it interesting. Please leave a comment. Love to hear what you think of DoorDash and what you think about their future prospects and any other comments you have on this company. Thanks again for watching.
Welcome back to my channel. In this video, I'm going to be covering Dropbox. This is a growing cloud-based company that helps its customers store all files, videos, pictures. It helps many small businesses really manage all the content that their businesses need to store. It's an interesting company. It's a small, mid-sized company that I think has a good future, and the stock price has been moving up in 2023. I'm going to take a look at the company, take it through my investing process, and make a decision whether I want to buy, hold, or sell. Do me a favor and like my video and subscribe to my channel, and please leave a comment on Dropbox. I'm going to evaluate Dropbox to see if it's a good investment, and I'm going to look at three principal areas. First is the company, the management team, and the industry. Do I want to buy into all three? Next is the balance sheet. Does it have low debt and less than 3 times EBITDA? Last is the discount on the stock. I'm a value investor and I want a discount on the stock. That way I could see my investment go up in value. And based on the answers that I get from those areas, I'm going to buy, hold, or sell a Dropbox. Dropbox was founded when cloud had already come out, and they were born in the cloud and help individuals store all their documents, whether you're a creative person that needs to store a lot of pictures and videos, or you're a business that wants its employees to collaborate, work on projects together, and so forth. It's a good company. They've worked with other partners like Salesforce and Adobe to integrate Dropbox into those solutions so that a user could be in Salesforce and store a lot of content on Dropbox or Adobe or other platforms that Dropbox has integrated to. They have many users, over 700 million registered users around the world. 18.1 million are paying users, and they store more than 800 billion pieces of content, which is incredible. Dropbox was founded in the cloud era, so they grew organically by just being a really easy to use way to store your files, your content. And then those users took their preferences to the companies they worked at. A lot of companies started to buy into Dropbox. And maybe there was a couple of users within a company, and then Dropbox expands and tries to sell the entire business, more of an enterprise arrangement to have them store all their documents. So a really natural growth rate for a cloud company, and Dropbox is growing. They're really using this strategy effectively. Dropbox is growing their annual renewable revenue nicely. It's an upward trend. It's not a crazy growth rate, but it's going in the right direction, which is very good. The number of paying users has gone up very nicely. And then the average revenue per user has also gone up. So the metrics look good for Dropbox across the board on revenue growth, revenue stability. The company's long-term targets look pretty impressive and I think are aspirational. Having gross margin of 80 to 82% would be phenomenal. We'll see if they get there. Margins of 30 to 32% would be very good.
But the number that I really pay attention to is free cash flow, and they aspire to have $964 million of free cash flow by 2024. I don't see the line to get there, but it's good to know that they're aspiring to really be a high free cash flow generating company, which is very good in my book. Dropbox has been profitable for some time. Very good to see that they have hit a really good profitable era to their company. I'm going to be using the next 4 quarters of profits, which look good. And I'm going to be taking all those earnings per share and using a PE that is going to be higher than PE that they're selling at, because it is a cloud company. They're growing. I think they're a really good acquisition target. So I'm going to go with a higher PE as opposed to the one that is they're currently trading on. I think that Dropbox stock is being discounted by 34%. I think each share is worth $39.56, but the stock market's selling the stock for $29.62. I come up with my valuation by looking at free cash flows and earnings per share. Let's take a look at free cash flows first. I'm going to take the 2023 year-to-date number and annualize it and use that as my starting point. The company is aspirational. They're trying to get to the high 900 millions in free cash flow, but I'm going to use a more conservative number. I'm going to grow cash flows by 8%, starting with 759 million, and grow those cash flows in the first 4 years by 8%. Terminal value, which is all cash flows after year 4, is 17.9 billion, and I have a growth rate of 3% on that. Historically, they've had very high growth rate, 25% on free cash flow, and then revenue at 12%. But as they get bigger, those growth rates become harder and harder to match or exceed. The growth rates will constantly get smaller because the numbers that are being calculated get much bigger. I'm going to use a discount rate of 8.5 because they have a very good balance sheet and deserve a lower weighted average cost of capital. The intrinsic value, the net present value of all those cash flows discounted by 8.5% is 14.6 billion. I'm going to add the cash on the balance sheet and take away the debt, and we get to $14.6 billion of equity value in the company. The market cap currently is 10.2 billion, and I calculate a per share value based on free cash flows of $42.47, but the market will sell you shares at $29.62. So based on cash flow, the stock's discounted by 43%. Looking at earnings per share, I'm going to use a PE of 20. I think they're growing, good company in the right space, cloud technology, and I think they're a good acquisition target. I'm going to grow earnings per share by 4%, and I'm going to value based on earnings per share, all the earnings per share that I expect in the future, and come up with a value based on earnings per share of $33.76. Stock market selling stock at $29.62. So there's a 14% discount if we look at the earnings per share method. I believe in free cash flow method more than earnings per share. So I'm going to use a 2/3 weight on my blend and 1/3 weight of earnings per share to get to a blended discount of 34% on Dropbox. The balance sheet's in great shape because they have almost as much cash as they do debt. So they have net debt of close to zero, and they produce really good EBITDA. So I'm not worried about the balance sheet. It's in excellent shape. The ratio is almost zero, and I'm looking for less than 3. Looking at where Dropbox has been trading, it really shows that there was a great opportunity to buy Dropbox in the March, April, May timeframe, and you would have ridden that stock up significantly. It's up 30.6% year to date. But I think if you go from the low point to the high point, you're more of a 50% gainer if you buy shares at that point. So the company is got momentum, and I think they have more to go based on the value that I have. And there's a difference between the current stock price and where I'm valuing the company. So should I invest my hard-earned money in Dropbox or just walk away? Let's take a look. So starting with the company, what do I think of the company? I think the company's terrific. I really like companies that have focus, especially in technology. And Dropbox is trying to be the best company they can be for all of the file storage, collaboration, all those things they do very well. So I like that about them. The management team's good. In the industry, I really like. Debt is almost zero, so it's very low. And the balance sheet has less than 3 times, debt is less than 3 times EBITDA on the balance sheet. And there's a good discount on the stock. I am going to look for pullback days and buy shares of Dropbox. Thank you for watching the video on Dropbox. I really appreciate it. Do me a favor and leave a comment on Dropbox. I'd love to hear what you think of the company.
Also, please subscribe to my channel and like my video. Thanks again for watching. The Disney stock is having a bad day. It's down almost 10% today. And the reason for it is the earnings came out and the company's not doing as great as they would like. The guidance was a little weak. And overall, I evaluated the company less than a month ago and compared them to Comcast. Comcast, I thought, was a better company to invest in because Disney, I still felt, was overpriced. They don't generate a lot of free cash flow. The earnings per share are just okay, but the stock price is way above where I think the company is valued. That said, I'm going to stay away from Disney and wait for the stock to really come down before I ever consider investing, or just stay away completely. I want to buy dividend stocks while the buying is good. The current investing environment is really driven by technology stocks, especially semiconductors, pulling a lot of investments and catching a lot of the attention. Stocks like Nvidia, Broadcom are pulling in lots of investments. At the same time, people are ignoring and forgetting about these great companies that pay dividends. It's a great opportunity for a long-term investor like myself to pick up these companies at a discount and get really nice dividend yields in the process. I'd like to go over my top dividend stocks with you, share the names of the companies that I'm buying into, and tell you what the dividend rates are. All of these dividends the companies can afford, and all of these stocks are discounted, in my opinion. Before I jump into showing you the companies, just remember, I'm an individual investor. I'm just sharing my experience, my opinions. I'm not providing any financial advice. I'm not recommending you buy or sell any of the companies I'm going to cover. Also, let me introduce my sponsor, Moomoo. They are sponsoring my channel, and they're offering a really nice new account holder program that includes paying you 8.1% on cash for 3 months. And then after that, it's 5.1%. They'll also give you 15 free stocks if you open an account with $1,000 or more. Take a look at the details in the video for more information. Now let's get into my top stocks that I'm investing in right now, buying more shares to lock in a great dividend. The first company is CVS. CVS pays a 4.4% dividend. This stock has been discounted over the past year. The company can clearly afford the dividend with a low payout ratio on that dividend. They produce very high amounts of cash, and they have consistently grown their top line revenue. That said, I believe this stock is discounted by 45%. And I'm going to buy more shares of CVS to lock in a great dividend and potentially see my stock really appreciate in value. The next company I'm going to cover is CareTrust. And CareTrust is a real estate investment trust. They pay a 4.4% dividend. A little reason why it's a little bit low compared to historical terms is that the stock's really gone up. I'm up 39% on my position of CareTrust, which is great. Now, this stock, I still believe it's discounted by 10%, and they can more than afford the dividend rate at 4.4. This company has increased their dividend over time, and it's just a really well-operated company. The next good dividend-paying company is Prudential Financial. They are predominantly a life insurance company, but they also do wealth management and they sell annuities. This company pays a 4.4% dividend. They can more than afford that dividend, and the stock's appreciated nicely over the last year. I'm up 22% in the past 12 months on Prudential, and I'm being paid that 4.4% dividend. I still think there's upside in Prudential because they were a rebound story of 2023 and 2024. Their business is really on solid footing, and I think they're going to have a couple of good years in the future. Ford is the next company, and they pay 5% dividend. And this stock, I believe, is really discounted. Ford has continued to improve their business. They have a great lineup of cars. They're profitable. They're in a really good position in the market. The stock price has just really been sold off for some reason, but it's a great time to lock in 5%. And it's a dividend that the company can really afford. So I'm going to be buying shares of Ford and locking in that high dividend rate. 3M is the next company, and 3M is a rebound story. They had a rough couple of years if you look at from 2020 to 2023, but the company is really on the right path now. They're paying almost a 6% dividend, and the stock has really appreciated nicely over the last 6 months. I'm up 20% on the stock, and they're paying me 6% as a dividend. What else could an investor want? That's just a great recipe. I'm going to continue to buy 3M stock on pullbacks and continue to accumulate shares in this great company. And the final company I'm going to cover is Pfizer. Pfizer is paying a little over 6% dividend, which is a great rate. And this company has had a rough year if you look at their stock price, but their business has really been doing well. They really are growing their business organically, and they have just a tremendous balance sheet. They have so much cash on that balance sheet. So I expect two things. One, the Pfizer stock is going to go up in value. Two, I'm going to lock in that 6% dividend yield because that could really help my portfolio for many years. So those are my top dividend paying stocks. It is a great time to buy into these dividend stocks that are predominantly Dow based stocks. These are stocks that are going to be more stable than growth stocks and likely will really have a very good 2024 and 2025. But the buying is just really good right now because these stocks have been left behind. If you look at how the Dow has performed versus the NASDAQ, it is way behind the NASDAQ. But I believe that the real surge in growth stocks within the NASDAQ, it's going to come to an end. And when that happens, I think these value stocks are really going to stand up tall and go up in value and continue to pay me a really nice income. When will DocuSign begin to rise and go to the right? I've been asking that question for a couple of years now. This stock is in the right industry. They continue to grow their revenues, they're profitable, and they generate free cash flow. But their stock has seen a lot of down action recently. It's seen a lot of volatility over the last year. And I wonder when this stock's really going to catch fire and go up. I'm going to take a look at this stock, do an analysis, and see if I should buy, hold, or sell this stock. I'm currently a stockholder, so I've been an owner of this stock for some time. I'll update my valuation, which will be based on free cash flows and earnings per share. I'll take a look at what analysts are saying and overall make a decision on this stock. I look at three areas. First, the company. Second, the balance sheet. Third, the discount available on the stock. Before I jump into my analysis, just a quick reminder, I'm an individual investor, just sharing my experience on DocuSign. I'm not recommending you buy or sell this stock, and I'm not providing any financial advice. Also, I'm being sponsored by Moomoo, which is a brokerage, and they offer new account holders a pretty nice offer, which is 8.1% interest on cash for the first 3 months when you become an account holder, and then 5.1 after that. They also are giving out 15 free stocks for new account holders, which is pretty neat. If it's something you're interested in, there'll be the details in the description of the video where you can get signed up. Thanks. So first, the company, DocuSign. I really like that they're a software company. I like holding software companies. They tend to be profitable, grow, not need a lot of capital. So I really like the industry. I think DocuSign is the leader within the space of digital capture. They are the leader, but it is somewhat of a limited addressable market. It's going to be hard to grow outside that box. And I think that's what's held back the stock. So I like the industry. I think the company is well operated, but I'd like to see the company expand into other types of software services that they could offer customers. We'll see if they can do that. The balance sheet. The balance sheet for this company is really good. If you look at their debt to EBITDA, it's well below 3, and they carry a lot of cash on the balance sheet, which is very good. And overall discount. I'll get to that toward the end of the video. For now, let's take a look at where the stock's been. So over the last year, it's had a lot of volatility. And you can see that there was a move on the stock where a private equity group wanted to buy DocuSign, and the stock really rallied. So it went up quite a bit, substantially. From the low to the high, the stock went up 63%. But since that high, the stock is actually down about 18%. So a lot of volatility, but you could see that a private equity group saw a lot of value in this company and was looking at to acquire them. So it proves that there is value here. The company is a $10 billion company, so a small mid-cap software company. They have $2.8 billion of revenue. And the forward PE is just 16.7 for a growing software company. It seems really attractive to me. Other analysts say that it's a good hold, and they think the stock's discounted by 21%. Their revenue growth has been good. It's been really positive. It has slowed down. I think they're getting bigger and bigger, and it gets harder and harder to grow as you get larger. So I think that's the slowing of growth from a percentage perspective might be what is concerning investors. The most recent quarter, they grew at 7.3%, which is reasonable, especially since other software companies are showing very little growth. And some companies are actually seeing that revenue go down.
So for the case of DocuSign, they continue to go up, which is a very good thing. This is a high cash flow generating company. In fact, if you look at their cash flow over the last 5 years, it's really exceptional. I like that about this company. And their balance sheet is really strong. They carry a very high cash balance, $1 billion, and they have very little debt overall. Total debt is well below that cash balance. The company has made plans to buy back $1 billion of their shares. It's going to be really good because they're going to take shares off the market and really prop up the stock price for the company. Their earnings were good. The earnings that were announced last week showed positive earnings. The company continues to operate really well. They're trying to create some AI products. I'm not too sure if that's going to be a big product or not, but it's good that they continue to develop products. Again, it'd be nice to see them expand, maybe merge or acquire other smaller companies so that they can become a bigger player in the overall software space. So I'm going to value DocuSign by looking at the free cash flows I expect the company is going to produce and discounting those free cash flows to today's value. That is the method that most value investors use to really establish a value of a company. The second method is earnings per share. And that's a very common way that companies are valued. In fact, that's what really, when earnings are released, that's what Wall Street really focuses on, is earnings per share. So I'll use that method as well and then combine the two. Looking at the free cash flows for DocuSign, they are a very good cash producing company. And I expect they're going to produce $976 million in free cash in 2024. I'm going to grow the first 4 years by 5%. And all years after year 4 will be grown at 4%. So this establishes the free cash flow forecast that I expect from this company. I'll use a 9% discount rate. I'm going to discount all those free cash flows and get to a net present value of all those cash flows in today's dollars. And I'm going to add the cash and take away debt. So I get to an equity value of $19.8 billion. The market cap's only $10.6 billion. So it provides a nice discount of 87% based on the free cash flows and comparing that to today's value of the stock. So looking at earnings per share expected to be $3.30. I'm going to use a PE of 18, and that's because it's a growing company. It's a software company. I like both. And if this was a popular software company, the PE could be upwards of 36. But in this case here, I'm going to use 18. I'm going to have a growth rate of 5% on that earnings per share. That gets me to a stock value of $62.37, but the stock currently is at $51.82. So it provides about a 20% discount. This is similar to the discount that I was seeing on the analyst prediction of the stock. Now, looking at the blended value of both methods, I take more weight on the free cash flow method, using 2/3 of that method and then 1 part of the earnings per share method, arriving at a combined 65% discount on DocuSign. So this is a heavily discounted stock. So am I a buyer of DocuSign or a seller? Well, I'm going to look at 3 areas and just talk through my decision on DocuSign. First, it's all about the company. Do I like the business? Do I want to be a part owner? I really like software companies. I think they have a lot of advantages. For example, they don't really hold an inventory. They don't have to buy a bunch of parts, put it together, and then send it to a customer. They write code and then they sell it to many customers, as many as they can. They're very profitable. In the case of DocuSign, they've proved to be very profitable. They generate high amounts of cash. So I love that type of business. I think the management team's excellent. The only thing that's limiting the company is that they are kind of narrow in their product scope, where they do signature capture as well as agreement management and areas around that whole contracting process. It'd be nice for them to break out of that. But overall, I really like the business and would like to be an owner of this business. Second is balance sheet. Balance sheet tells me, does the company have a lot of problems? Am I going to regret buying into this company? And in this case here, DocuSign has an excellent balance sheet. No net debt, lots of cash. They're going to do a big buyback of $1 billion. And they can acquire other businesses if good opportunities exist in the marketplace. Having said that, the balance sheet is excellent for this company. The discount is really high, 65% discount on a software company. That's really good. And this company has shown that their price could be quite volatile and really go up in certain periods of time. That said, I'm going to buy more shares of DocuSign, continue to add to my position. It may take a while, but I think I'll be really happy with this investment in about 2 years' time. So that's my report on DocuSign, what I plan to do with this stock. Hope you found it interesting. I'd love to hear your comments on this company. Let me know in the comments what you think. Thanks again for watching. Welcome back to my channel. In this video, I'm going to be covering a company by the name of Dow. Dow is
is a quality company that's been around for a long time, and they make a lot of the materials, a lot of the coatings, they end up in products. So although we don't buy Dow products as a consumer, at the store or at Home Depot, they really are a part of the supply chain to a lot of manufactured products, and are a really respected chemical company. I like investing in companies like this. They tend to be very stable. They pay dividends, and again, it's a good quality company with a quality balance sheet. Dow announced their earnings last week, and I was able to update my valuation of Dow based on the third quarter that was closed in 2023, and make my best estimate as to where I think the stock is valued currently, where it's being priced, and if it's a good buy or if it's not. I'm going to get to that conclusion at the end of this video. I'll go through my process that I use and explain that to you, explain my point of view as an investor, and hopefully you find that interesting. Do me a favor and like my video and subscribe to my channel. That helps the channel out, and I'd appreciate that. And please comment. Love to hear your comments on this company, on the video, or anything else investing wise. Now let's take a look at Dow. As I look at companies, I like to follow a consistent process, and it's a process that I've created for myself as I look at companies, I invest in them, hold them, make money on them, in some cases lose money. And in both scenarios, whether I make money or lose money, I want to learn. One of the big returns of being an individual investor is knowledge and being that much better year after year, quarter after quarter. So keeping my process consistent is one of those tools and that'll enable me to just get better. And I have 4 questions followed by a decision to buy, hold, or sell. The first question: do I think it's a good company in a good industry? And that's an important question. And it's not a check the box, activity. Really understanding, where does Dow fit into the economy? How long have they been around? Have they been around, 10 days, 10 years, 100 years? Have they been a consistent company? Do they have a culture of success? Do they have a culture of really being conservative? And all the numbers that I'm going to see are going to be conservative numbers. So all those things come into a decision for me. Is it a good company? And is it an industry that I want to be a part of? And it leads into, how's the management team doing? Are they performing well? It could be a really good company, but the management team could be making a lot of mistakes, and it could really drive a company down. A good example would be Intel. A lot of bad decisions were made over the last 10 years. They used to be the clear leader in semiconductors, and now they're the clear follower in the semiconductor industry. So a lot of bad decisions led to that. And that's basically the question, which is the company being operated well by the leadership? Debt has to be less than 3 times EBITDA, and this is a score on the balance sheet. If we have a bad balance sheet, that could really weigh a company down, especially right now with high interest rates. So we got to have a clean balance sheet, good, healthy balance sheet, and a discount. I buy stocks to make money, and the clearest line for me is I buy a stock that I believe is discounted. Either the market sold off and created a really attractive purchase price, a company is misunderstood. I believe in a company is going to really do well over the next 5 years, but the market doesn't. And that's where the discount comes into play. And I want a nice discount so I can make money on the stock. And based on the answers to those questions, I'll buy, hold, or sell this particular stock. So just taking a look at the company, very high level. Dow gets into packaging and specialty plastics. So you might pick up a product at the store or pharmacy where Dow actually produced some of those materials. They have performance coatings. So the car that you're looking at on the showroom might be have coatings from Dow. And then they have industrial and infrastructure products. So they help in construction. So you might see a building and it's constructed with some components that came from Dow. So these are products that, again, they don't have the Dow brand on them when we shop at Home Depot, but they're in the supply chains. They are a very respected company that is integrated in other products that we readily buy and are a part of our economy. Overall, I like Dow. I think they have good barriers of entry into their business, meaning in order to operate the type of business they have, you have to have a huge refinery factory type operation. It takes a lot of capital, takes a lot of know-how, takes a lot of engineers. And that is a barrier for other competitors to freely come in and say, oh yeah, I'm just going to start competing against Dow. Dow will have competition, from international markets, where internationally, other companies or other countries will set up operations to try to compete against Dow. So that is one of the threats. But overall, Dow is a very respected company in the U.S., providing these types of materials, and they've been doing it for a long time. Very old company.
Most people have
that has
heard
been
of
doing
Disney.
it for a long time. Looking at the financials that were released in their quarterly update, the story of Dow is a story of the economy. Their sales are down, and principally because economic activity globally is down. So it was a significant drop in revenue that Dow is experiencing, and that's mainly because production around the world is lagging. So it's telling us that we're in a recession, going into a recession.
Most people,
the economy is not booming right now. So that's understandable. I understand that, hey, Dow cannot sell in a market where things are the
most people have
economic
heard of
activity is
Disney.
down.
You've
They're gonna
probably
be
watched one of their movies,
subject
whether it be
to the
Star
economic,
Wars, Pirates of the
head or tailwinds. Overall, it's a very well-operated company because they continue to be profitable. Even though their
Own any
revenue is
Disney
down
stock.
significantly, they've been able to have the discipline to be profitable. So that's very good to see. And they keep generating cash. I'm going to be using free cash flow as one of the key valuation metrics, and they continue to generate free cash. So that's good to see. I believe that Dow is fairly priced at this time, and there's really only about a 1% discount, meaning I think each share is worth $48.61 to me, and they're being priced in the market at $48.11. So it's a fairly priced stock. I value it based on free cash flows, and this is an annualized run rate, taking the first 3 quarters and then annualizing that number and really growing from there, because it's a low point in free cash flows. I'm growing it by 10%. And their terminal value, this is a consistent cash flow generating company, very stable, established, mature business. And in the future, I'm expecting after year 4 that they're going to generate all these free cash flows into the future. I'm going to discount by 9%, a nice high weighted average cost of capital. So I get to a value of all those free cash flows of nearly 48 billion. I'll add the cash on the balance sheet and take away the debt to get to an equity value of 36.3 billion. But the company is valued based on market cap at 33.7 billion. So using the free cash flow method, there's about a 7% discount. Earnings per share is not looking
what
great.
I'd like to do with this
It's
stock.
had
I currently
great earnings
don't
per
own
share
any
in years
Disney
past,
stock,
but
I've owned it
as
in
you
the
can see,
past,
the
but
drop in
haven't owned it in a
revenue
long time.
has caused
Now
a
let's take a look
drop
at the
in profit.
fundamentals and see what we've
So
got.
the earnings per share that I'm expecting for 24 is 285, a PE of 20, which is reasonable, conservative, but reasonable for this industry. And they'll grow that earnings per share by 4%. And discounting the earnings per share, we're going to get to $42.65.
It's been around for a long time.
Which is being sold at a premium compared to the current stock price of 11%.
Most people have heard of Disney.
I blend those two, but take more weight into free cash flow to get to a 1% discount on Dow. And my conclusion is that it's being fairly priced. The stock does pay a nice dividend. It's well above 5%. And the balance sheet is in great health. The EBITDA to debt is 2.2. So in over 2 years, they can pay off all their debt they needed to, just operating the company. So the balance sheet's in good health. Looking at where the stock has traded for Dow over the last 5 years, it's interesting that, other than the COVID year, it's been
You've probably
hovering
watched one of their movies,
consistently
whether it be
around a
Star
trading
Wars,
range.
Pirates of the
We're currently
Caribbean.
at $48
some of the-
11 cents a share is where it's priced, and my
So
valuation
Disney is
right
a
on
very
top of
large.
that. But it wasn't trading too much higher in its high point. It was
So
nearly
Disney-
70 as a stock price, and I think that the company stock tends to be stable. Year to date, it's down 5%, 5.7%, and it pays a 5.82% dividend. So I'm expecting that, this stock price, you wouldn't double your money in the next 5 years. You would see a modest rise, but you'd be hanging on for this dividend. So this is definitely a part of my income portfolio versus my growth stock portfolio. And the reason for it is it's a staple company that pays a nice dividend. All right, so should I buy, hold, or sell Dow based on my valuation, based on the earnings they just released, and everything else? Let's take a close look. So first on the company and the industry, I like Dow. I think part of my skill set is that, I've been, working for a long time and really know the industry, know the economy. And I know that Dow is a key player in the overall economy. So I like that they are very well respected. They have
So Disney
very
is a
established,
very-
mature business. And I like their industry because it's very hard to break into an industry like this. I think Dow has a lot of stickiness with their customers. So I give them a check mark on the company, industry. I think their management team's doing a really good job. And the reason for it is, the global economy, Dow can't control that, but they could adjust, and they've been adjusting their cost and maintaining profitability, which is very good. Sometimes you see companies, they have headwinds from the global economy and they go from being profitable to really losing money, and Dow didn't do that. So good job to the management team for really leading the company through this downturn. Debt is less than 3 times EBITDA, so the balance sheet's in good health, and they don't offer a discount. So based on the fact that there's no discount available, just a fair priced stock, I'm going to hold. I like the company, but I think if they could improve their earnings per
I'll
share,
use that data.
the valuation is going to go up. And as the global economy improves, the valuation is going to go up.
22
So I'll
analysts.
keep, monitoring the company and try to be a little early on when the stock's going to rise, so I can buy it at a discount and then watch.
22 analysts cover Disney, and they
But
have
for
a
now,
favorable.
I'm just going to be holding my shares. So that's my
Statistic,
analysis on Dow, as well as my investing plan for this company. Again, I think the company is a solid company.
They
this
grown
is
in the
a
trailing
company
12
that's been
months.
around for
That's
the last
very
100
good.
years.
What's
and will
also
be around
grown
for the
is their
next 100
free
years, I
cash flow.
expect.
Their free
So it's a
cash
really
flow has
good,
been
solid
growing
company.
over the 12
Pays a really high dividend
trailing 12
of
months,
5%.
and that's where I value
So that's
companies
really
based on
good
free cash
to
flow.
know as well.
So it's good to see that
I think there's
the
good
troubled
upside
company
in
that
the
only
stock
generated $1
over the
billion
next 5
of free
years,
cash flow in
but
2022
I'll have to be
has really
patient.
picked
It's
itself
not
up
one of those
and
things
has
that
now
it's going to happen
generated
overnight.
almost $8
We're in
billion
a bear
in free
market
cash.
right
That is
now,
a great
so
improvement.
stocks
Great job,
just keep getting
Disney
punished. The
team.
prices keep going down.
When we look
That's
at
a really good opportunity. A really good opportunity to buy into really good companies that I want to hold for the next 5-10 years and really benefit from
generated
the stock
almost $8
prices
billion
going up over
in free
time.
cash. That is
and
a
these
great
companies
improvement.
paying
Great
a really
job,
nice
Disney
dividend.
team.
So thanks for watching. I appreciate it. Please leave a comment on Dow. Tell me what you think about the company. And
22
please like my video and subscribe to my channel. I'd really appreciate that. Good luck investing in 2023.
Welcome back to my channel, fellow investors. In this video, I wanted to cover a healthcare company in Elevance Health. This is a healthcare payer, meaning they're an insurance company. Either through an employer or individually, you can buy a plan with Elevance and they will help you pay for your medical bills, either when your doctor submits a claim or you can submit a claim and get your healthcare covered. Healthcare is incredibly important to the US. I happen to think that the healthcare industry is excellent in the US. We get great doctors, great medicines, overall great hospitals. And I happen to be of the opinion that we are fortunate to have this industry. I wanted to take a look at Elevance Health and see if it's a good investment. I've owned Elevance Health for some time, and I wanted to evaluate it now that they've announced their earnings. They announced earnings today and have given me a fresh look at how the company is operating. In any investment, I like to look at the company, make sure that I'm buying into the company, that I think they're well operated, they have a good business plan.
Free cash. That
the
is a
industry's
great
good,
improvement.
and
Great
make
job,
sure that
Disney
I'm
team.
buying a business that I want to be a part
22 analysts
owner in.
cover Disney.
I want to look
and
at the
they have a
balance sheet,
favorable
make sure the
opinion of
balance
the
sheet
company.
is
They
in
think
good
it's
health
discounted
and not
about
riddled with
33%.
problems.
There's
And I want to
optimistic
value the company, determine
expectations
what
that
I
the
think
company
each
is going to
stock
really
is really
improve their
worth,
earnings per
and compare
share.
it to the current stock price.
Right now, the earnings
to
per
see
share
if
is
it's being sold
$4.99,
at a discount,
and
at a fair
PE
price,
is pretty manageable
or at
at
a premium.
17.7.
And then make a
They're going
decision.
to grow
Hey,
it by
should I
5%
buy more
in
shares? Should I
25, and
just
then
hold my shares
12.53%
or sell
in
my
26.
shares in Elevance?
That's pretty good forecast.
Let's
and
go
I'll use that
through,
information
make
on
that
my
decision.
valuation.
I'll make the decision for myself. With any of my videos, I'm sharing my experience as an individual investor, my journey. By no means am I recommending you buy Elevance Health
0.7.
as an
They're
investment.
going to grow it by
Please
5%
do your own due
in
diligence
25
and
and
make your
then
own decisions on
12.53%
your
in
investments.
26.
Now let's take
That's
a
pretty
close
good
look
forecast,
at
and I'll use that
Elevance.
information on my
Elevance
valuation.
stock has been a nice, consistent performer for 5 years. If you had bought the stock 5 years ago, you'd be up 101%. And it's a good return over 5 years. Over the past year,
I
the
took the
stock has
fund.
gone up 15.84%, and they pay a little over 1% as a dividend. So adding that on
I took
top,
the
you'd be up
fundamentals that
maybe
I
about
discovered for Disney,
17%
and I put
on
them
a
in
very
the
good healthcare
valuation.
company. I like that consistency in the stock price, that it continues to go up over time.
I took the fundamentals that I
usually the sign of a
discovered for
good
Disney,
company.
and I put them in
If
the
we look at
valuation
year to date
schedule
for
that I've got for
Elevance,
the company.
it's up 11.99. Very good return, especially since we are coming off 3 down weeks, especially in technology. So it's nice to have Elevance, good investment, really good consistent upward appreciation on the stock. The market cap of Elevance is 124 billion. Not too high when you compare it to United Healthcare. United Healthcare is an excellent company, but it has a very large market cap, and Elevance is a smaller market cap. So I think it has a higher chance of moving up from a stock price perspective. I like lower market caps for really well-run companies. The revenue is 171 billion. So you're paying a little over 1 times revenue for the company. It's just a solid net income from the company. Their shares outstanding, they continue to buy back shares, and this company generates a lot of free cash flow, and they use it to buy back shares. So it has a smaller dividend, 1.21%, but they actually are using a lot of the cash to buy back shares, which is a positive. And we see their consistent upward stock price. I think part of it is those share repurchases that they're making. The forward PE is only 13.91, which is nice and low. I like that the PE is low, and they're set to continue to exceed expectations on earnings reports.
3% in 26.
And that would just drive
That's
up
pretty
the
good
stock
forecast,
price.
and I'll use that information on my valuation.
The earnings for today were real
I
positive.
took the fundamentals that I just
They topped on the expectations on earnings per share and then rose their guidance. So in general, the earnings were positive. Wasn't a blowout quarter, just good, solid performance. We have multiple
Use that
analysts
information on my
analyzing the
valuation.
company. There's a strong buy
I
rating.
took the
on
fundamentals
company,
that I
and they
discovered for
have
Disney,
a price
and I
target
put them
that's
in the
8%
valuation
higher
schedule
than the
that I've
current
got
stock
for the
price.
company.
So overall, company, solid
That
company.
discount would be
I'm going
a
to call
good
it a mid
discount to get
to large
started
cap.
with Disney.
Those definitions are really moving quickly. You have mega cap stocks like Microsoft worth $3 trillion. So the definition of small and mid caps have changed to kind of keep up with the new scale of size. So I'm going to call this a mid cap company. Elevance has been growing their top line revenue. If you look at just, the last
I think
10 years,
Disney is a
it's been
terrific
positive
business.
growth
Their
year after
brand
year after
is
year.
really
Just
valuable.
excellent growth.
The movies they own.
Looking at the
are very
statement of cash
valuable.
flows, there is some
And the
concern
theme
there for
parks,
me.
they're
The most recent
a lot of
quarter,
competitive
the
advantages.
operating cash flows was really low. And I looked into it. I think there was some adjustments that were made, but free cash flows is one of the principal measures that I have on evaluation. So if their cash flow changes permanently downward, that would really change how I value Elevance. So I'm going to keep a close eye on their free cash flow for the next couple of quarters. Multiple analysts cover this company, and a couple of things that I like about the reports is, first, their price predictions are all somewhat well correlated. When you have a high of 621 per share, the low of 550, all estimations are above their current stock price. So I don't see that on every stock. It's a rare, occasion where analysts are all saying, hey, this company is probably going to move up. Even the most pessimistic analyst is saying this stock's a good one. The forecast for earnings per share looks really good. If you look at the growth rates that are expected in 24, it's expected their earnings per share is going to grow 48%, in 25, almost 12%, and in 26, almost 13%. Exceptional growth. If they hit those growth rates,
Disney.
you better believe this stock's going to keep rising.
I think Disney is a
I
terrific
value
business.
companies
Their
based on their
brand
free cash
is really
flows
valuable.
and their earnings
The
per
movies
share,
they own,
trying to get to
very
a value that I
valuable.
believe the company
And
is worth. And
At that
in the
point.
case of Elevance,
So that's
I
my
believe
video
they're
on
being
Disney.
discounted
I hope you
by
found it
14%.
interesting. And I
I
appreciate
believe
you watching.
each share is worth $611, but the current stock price is $535. How did I get there? I look at the free cash flows that the company is going to produce in the future, discount those free cash flows.
Most
today's
people have heard
value,
of Disney.
and arrive
You've
at a
probably
particular
watched one
value
of their
per share.
movies,
In this
whether it be
case, it's
Star Wars, Pirates of the
$581.
Caribbean.
And compare that to
Some
the
of
stock
their
price.
Marvel
Also look at earnings per
movies.
share,
It's a
and
quick-
that was a very impressive.
Let's take a look
set
at the
of numbers
fundamentals
that
and see
are
what we've got.
expected from Elevance.
So Disney is a
and that
very
drives a
large
value of $670 per share. I combine the two. I like putting more weight into free cash flows, and I arrive at the value of $611 per share for the company. So it's a nice discount on a high quality company. So should I buy more shares in Elevance, just hold my shares, or sell my shares? Let's take a look. I first want to really buy into the company. Do I think the company is a good company to have? Do I think the industry is a good industry to invest in? The answer for Elevance is yes. I like the stability of the healthcare industry. I like having a company that's a healthcare payer. They generate very good cash flow. It's just a very consistent company, and people really need healthcare. So I like those aspects of the company. Next is the performance of the management team. Do I think the company is operated well? In the case of Elevance, absolutely. Their performance quarter to quarter, year to year has been really good. So a very good report card on the management team. The balance sheet's in great shape. The debt is well below 3 times EBITDA. It's under 1% EBITDA. In fact, they produce a lot of cash and their EBITDA is very high. So the balance sheet is in very good shape for Elevance. They offer a nice 14% discount, which is a good discount on a great company. So I'm going to be a buyer of Elevance stock and a holder long term. Overall, this is a good stock. Although the healthcare industry has been held back in 2023 and 2024, the whole sector hasn't performed well. But Elevance has been a bright star in that particular sector. I imagine if the healthcare sector rallies, it's just going to help Elevance, the stock, go up even further. Thank you for watching the video. I hope you found it interesting. Timing when a stock has reached the lowest point in its stock price is near impossible. Really trying to see when that stock's going to reach the lowest point to make a big investment. Man, that's really tough. Some of the best investors, you see them make mistakes. A classic one is Bill Ackman, not too long ago, lost a lot of money on Netflix. He thought it reached a low and it continued to go down, and he lost somewhere around $400 million. That was a huge loss. Either finding the bottom or the top of a stock is nearly impossible. The best investors, including Warren Buffett, will tell you it's just something that is impossible to do. So how do I invest in a company that I know is discounted? Well, that's what I want to cover in this video. It's more important to be directionally correct, meaning a stock is discounted and over time it's going to go up. So it's going to go up in the direction of it going up. If one is correct, that's what's important. This is a timing deal where you buy shares, you hold them, and then over time they'll go up in value. But how do you buy them? Do you buy them all at once and expect that, hey, I'm going to buy at the perfect time? Well, in my case, I'm just not good enough, or I'm not foolish enough to think that I can find a perfect point of time to buy them. So I cost average my buys into a stock. And I wanted to show examples in real life companies that I've invested in and kind of look at the 5-year charts on these companies and show that these companies at the right time, one could have bought week after week a certain number of shares. You'd be doing really well on any one of these stocks. For example, Uber. Uber's a great company. I love the company. But if you look at their 5-year chart, their bottom was hit in the 2022 timeframe, and they're up 216% since their low point in 2022. So over the course of 2 years, you could have made over 200% return on Uber. But at what point was the low point? Well, I was buying shares throughout 2022, just continuing to accumulate shares. I accumulated them even up until 2023, just continue to add a lot of shares. And over time, I've done really well with Uber because I've bought over time. Directionally, I was correct. Directionally, the stock went up. It was really discounted. And that's an example of, hey, I didn't have to pick a perfect point in time to buy Uber. I was directionally correct that it was going to go up, and I bought over time to average my purchases. The next one that I'll talk about is Meta. So if we look at the 5-year chart for Meta, the stock found its low point in 2022. And from that point up until now, the stock is up 455%. That's another example of a high quality company that was really discounted. And if you would have bought shares really in the midpoint of 2022 up until the springtime of 2023, you would have made lots of money on that capital. And I bought shares throughout that whole period, and I was really rewarded. The stock's done incredibly well. And you could see that buying at the right time, when you know the direction over the long period of time for Meta is going to be up, and then buying and averaging your cost basis on Meta shares was a great idea. And the third and final example will be Google. And Google, like the others, over the last 5 years, it was discounted in 2022. Not as much. Google really held a lot of its value, but since 2022 to now, it's up 106%. And it's kind of a ditto of the stock really came down from its highs in 2021, and it reached a low point in 2022. The stock had gone down about 41%, and the buying in the latter parts of 2022 and early 23 was really good on Google. So I loaded up on Google. I'm sitting on a really good gain of that stock. This is a high quality company, and these companies rarely are discounted. So buying into a high quality company and trying to pick a bottom is just impossible. But knowing that that stock is being discounted and that over the course of time, that stock is going to rise, it's more important to know that that direction is going to be upward and it's worth investing. And that's what I've done with stocks that I own and will be owning for a while, is try to pick the right time to just start loading up. And then week after week, just keep buying shares and really establish a really good, solid position in these high quality companies. So that's my video on really talking about not trying to, time a big purchase of stock, either by trying to think that I could find, the bottom of a stock price or even the top if you're going to short a stock, and really trying to average it out and just being directionally correct on where the stock is going to go, up or down. So that's my video. I hope you found it interesting, and I really appreciate you watching.
Welcome back to my channel, Value Investors. In this video, I'm going to be covering Kroger, the big grocery company. And they announced their earnings today, March 7th, and it was well received by Wall Street. Their stock's up more than 8%. And there's reason for it. This is a really well-run company. They execute very well. They do what they said they were going to do. They really execute exceptionally well. It's also a steady stock, really good for my income portfolio. They pay a dividend. It's not the biggest dividend you've ever seen, but they really buy back shares. And I'd like to update my analysis based on their earnings release and a full year of financials that I've got to work with, and see where I think the company should be valued and compare it to the current stock price to make a decision whether buy more shares of Kroger, just keep the shares that I own, or potentially sell the shares that I currently own. Let's take a close look at Kroger. Understanding the Kroger business is pretty simple. It's a supermarket, and I can't think of anybody who hasn't been to a grocery store to buy food. And they've been a grocer for a long time. The company's headquartered in Ohio. This is what they've done for 100 years, and they've done it well. They continue to grow and have all the different regions of the U.S. covered by the grocery stores. What I really like about the company is that it certainly
seems and they act in a way where they're in partnership with the stockholders. They clearly communicate to stockholders the value that they're going to provide to the shareholder. They execute their business really well, and that's really a compliment to the company. They are communicating in their investor deck that they like returning to shareholders 8 to 11%. Again, this isn't like Nvidia where you're gonna triple your money in 9-12 months. It's a real steady stock and a really good stock for my income portfolio. So I like that about the company. It's my expectations of the company again are just for steady, gradual increases in the profit price and the stock price and a good dividend over time. The company is using their footprint of grocery stores to expand into fuel sales. So selling gasoline, since they already have a real estate footprint across the country, they can diversify into fuel sales. Since they have grocery stores, they can also operate pharmacies inside the grocery store, which makes it convenient for a shopper to get their prescriptions while they're picking up some groceries as well. They are also really growing on the digital side. No big surprise. Food delivery, grocery delivery is huge now. And Kroger continues to really evolve and really adapt to the way that customers want to buy their groceries. I think 10% of their sales are done in a digital format, and it continues to really grow, which is great to see. Let me review the fundamentals of Kroger. To begin with, it's a $35 billion company, and their revenue is $147 billion. So it's a grocery store, so they don't have huge margins. That's why you see that their revenue is much higher than their market cap. Their earnings per share are good. Their forward PE is 11.7. That's phenomenal. And the S&P, as an example, is at 26 forward PE. So Kroger is well below the mean on forward PE. And I think it is a signal. That's why the stock is really going off the charts today, is that investors are realizing that this is a really well-run company and their PE is super low. If we have a recession, this is the right industry to be in. Groceries, no matter if it's a good economy, bad economy, we have to eat. So, Kroger should not have a big drop in revenues anytime soon. They'll just steadily continue to grow. Over the last year, the stock's up 16%. And again, recently, especially year to date, the stock's just really done well in my portfolio. It's great to see that the stock really rally. Kroger is trying to acquire Albertsons, which is another grocer, smaller grocer, and then it'll make
Most
them
people have
larger.
heard of Disney.
I think strategically,
You've
they
probably
see
watched
that,
one of their movies,
Target
whether it be Star
and
Wars,
Walmart,
Pirates of the
they're becoming
Caribbean.
threats to their business.
Some of their
because both
Marvel
of those
movies.
companies that I named were retailers. They retailed really, consumer goods, apparel, TVs, and so forth. Now they're getting into groceries, which is really coming into the industry of Kroger. So they see that they have to continue to get larger so that they can compete against those big retailers. And that's the reason for the acquisition. Now, they've had a lot of pushback from the Federal Trade Commission, who has really argued that this acquisition could be bad for the consumer, that Kroger would then have a lot of power to increase prices and price gouge and all that good stuff that they like to, probably enhance and make it a little too dramatic. Whether the acquisition happens and they acquire Albertsons or they don't, I don't think it's going to have a big effect on the Kroger stock. I would like to see the acquisition happen because I really believe in Kroger. Their management team has been executing for decades, just a really, really well-run company. And if they believe that this is the right strategy for the company, I'm completely behind it. But would totally understand if the government stands in front of them and they have to abandon the acquisition. So be it. I think we'll move on and Kroger just continue to organically grow. Kroger is providing guidance for the new fiscal year, and they're guiding for really good earnings per share, $4.30 to $4.50. Kroger tends to exceed expectations. So as I've learned with this company is if I want to be really conservative, I go on the low end. If I want to be realistic, I go with the high end. Free cash flows, same. They guided 2.5 billion to 2.7 billion free cash flow. Last year, they guided under similar numbers.
Most people have heard of
and they ended up
Disney.
coming in
Probably
close to
watched one of their
$2.8
movies,
billion
whether it be
of
Star
free cash
Wars,
flow. So
Pirates of the Caribbean.
exceeded expectations.
Some of their Marvel,
a little bit on the upper end of that guidance.
So overall, I really believe
Now let's
these
take a look at
numbers,
the
and I'll use them
fundamentals
for my
and see what we've
valuation.
got.
I really like Kroger.
So Disney is
I
a
like their
very
story.
large
I
company.
like their
Their
management
revenues
team.
are
But a
$160
story
billion
without numbers,
per
it's
year.
just a fairy tale. We got to have numbers
Take
in order
two.
to know, am I buying
Disney's
into a good investment? So I'd like to look at Kroger and value the company based on the cash flows they're going to produce in the future, and look at the earnings per share and value the company on earnings per share.
Disney's
Have a
a
blended
large cap
valuation,
company,
and then see if
$160
the
billion
stock price is
in
currently
market
being
cap.
sold at a
The
premium
company
or
stock
at a discount. Let's take a
fundamentals and see
close
what we've
look at
got.
cash flows first.
Disney's a large
So they
cap
guided
company,
cash flows
$160 billion
to
in
between
market cap.
2.5
The
billion
company
and
stock has
2.7.
been on its way
I'm going to
down
take the
recently.
midway point.
over
I
the
think
last-
that's conservative. Again, they tend to overachieve on the numbers they put out there. Let's go conservative. And I'm going to grow those cash flows by 7%. They have grown the cash flows over the last 5 years by 12%. So 7 should be a
Great
good
job,
number.
Disney team.
After that, since it is the grocery
22
business,
analysts
I'm only gonna
cover
grow
Disney, and they
future
have a
cash flows
favorable
beyond
opinion
year 4 by 3%.
on my valuation.
I'm going to discount all those
I
cash
took the
flows by
fundamentals
3%.
that I
They have a
discovered
strong
for
balance
Disney,
sheet,
and I put them
and I
in
get
the
a value of all those cash flows of
that started with
$54.1
Disney.
billion.
I think Disney is a terrific
take away
business.
debt,
Their brand is
to get to
really
an equity
valuable.
value of
The movies-
$43.8 billion. Is the
So
equity
that's my
value
video
that I
on
see for
Disney.
Kroger.
I hope you
The
found it
market cap is
interesting. And I
36.3
appreciate you
billion.
watching.
So overall, there's about a 13% discount available on Kroger stock. Earnings per share, I'm taking the higher end of the earnings per share, going against a 16 PE and growing those earnings by 3%, which is conservative. And I get to a value per share of $61.38. The current share price is $54. So there's about a 13% on earnings per share. So blending is easy. It's 13% discount. And this is a very fair price for a very good company. So I like that the fact that the company stock price has been rising. I think stockholders are taking notice. This is a solid company, but it starts with a really good company. So let me summarize my review of Kroger and make a decision on whether I should buy more shares, hold, or sell my shares. Starting with the company, I think very highly of the company. I like the business. It's the grocery business. It's a good diversification play in my income portfolio to have a food grocer. Very stable. I like the business. And same thing with the industry. Their management team, I would argue, in the grocery business, no management team is better than Kroger's management team. Their balance sheet is very healthy. Their debt is well below 3 times EBITDA. And they offer a discount on their stock. So I'm going to be a buyer and a holder of Kroger stock. I buy on pullbacks. The stock's really run up today. It's up about 9%. And it's great to see that. It's a pretty good size holding in my portfolio. So it's great to see that big, gain for the day, but it's not a good day to buy stock. I think it'll probably settle down and I will be buying more shares on pullbacks. Kroger is a steady company, just a solid company that isn't going to cause too many problems for my portfolio. It's rare if they ever surprise me, which is a very good thing with companies. They just do what they said they were going to do. They execute really well. And I really like that. I continue to put more money into Kroger year after year. And I've built up a really big position in Kroger, and I'm glad I did so. I hope you found my video interesting, and I really appreciate you watching. In this video, I wanted to cover Live Nation. This is the leader far and away in ticket sales for concerts and live venues. They're recognized here in the United States with their flagship website, Ticketmaster. It seems that every concert that you go to, at least 9 out of 10, if not 99 out of 100, concerts and artists have to partner with Live Nation to sell their tickets. It is a dominant company within their micro industry. The US government has pointed that out and has accused Live Nation of being a monopoly. For me, I'm looking for companies that are dominant, that have competitive barriers to keep competitors out, that they have technology or they do their business in a way that their competitors cannot keep up. They win over customers and they really grow their businesses. Live Nation may be that type of business. I'd like to take a look at the company, take a look at the fundamentals, value the company based on free cash flows and their earnings per share. Compare that valuation against their current stock price, then make a decision to see if I plan to buy shares in this company or not buy shares in this company. I owned Live Nation stock in the past and made money, and I exited the position in 2023. Might be time to reinvest depending on the results. Overall, Live Nation has been caught up in the press a few times under a bad light, where if you recall, Taylor Swift would sell out the concerts very quickly. A lot of fans were left out, and they blamed Live Nation. And Live Nation pretty much took the brunt of that bad press. But in reality, just the demand for certain artists is just so high that fans, as well as professional ticket resellers, really buy up the tickets very quickly. Live Nation also has a resale business where they resell tickets. Should a fan not be able to go to a concert and they need to sell their tickets, they can do it on Live Nation's resale platform. Or, frankly, the professional ticket resellers can also use the Live Nation platform. Overall, I like the company, and I'm going to look at the fundamentals to see if it's being priced at an attractive price at a discount, see if it's a good investment. Let's take a look at the fundamentals. Live Nation is only a $21 billion market cap company. I'm a little surprised by that number because their revenue is $23.8 billion, almost $24 billion. So the company is being priced less than their revenue. Somewhat of a surprise. The PE ratio for the current year is 83, which is really high. Forward PE is going to come down to 42 if you use next year's earnings per share and compare it to the stock price. Analysts really like Live Nation. It's a strong buy, and they think it's 28% discounted. It's a pretty strong discount. Over the last 5 years, the stockholder would not be happy with the results. Only gone up 33% collectively. But you could see that coming out of COVID, there was a time to buy and hold Live Nation. It really appreciated nicely for a couple of years. But along with everybody else in 22, it really sold off. But ever since then, it's just been going somewhat sideways. Not a big appreciating stock, especially in the last 2 years. Stocks have really appreciated. What's surprising is this company has just really good revenue. And you look at 23, 36% revenue, 22, 166% revenue. If you look at before COVID, because COVID did affect live venues tremendously, they were an $11.5 billion revenue company. 2 years removed from COVID, they're up to 16.6 in 2022 and 22.7 in full year of 2023. And you look at their trailing 12 months, they're almost a $24 billion company. So Live Nation is growing the revenue. Probably ticket prices are going up. So their portion of the sale goes up as well. All those things look really attractive to me. Meanwhile, they do make money, which is very good. The balance sheet, they have as much cash as they do debt. Strong balance sheet, no debt problems. They generate good cash flow. For the last 2 full years and the trailing 12 months, they have positive free cash flow. So that's very good. I'm going to use free cash flow as one of the valuation methods, and I'll take the most recent information to put that into my model. As mentioned, analysts like the stock. There's 12 analysts that are saying this is a strong buy. This is a good company. They're saying it's 28% discounted. The principal method they use is earnings per share. Earnings per share is $1.46. It's a little low, and it causes the forward P to be quite high. But it's supposed to almost go up 70% next year and then continue to go up the year after that. So the growth of earnings per share is expected to really take off. So that's interesting that it's going to grow so quickly. I'll take that into account on my valuation. Live Nation announced their earnings for the second quarter of this year on July 30th. So I have a fresh set of financials to take a look at. The growth of revenue was 7%. And quarterly, they grew over $1 billion in that quarter. That's a great run rate. Their operating income went up 21%. Operating cash flow is up to $412 million in the quarter, and free cash flow, $456 million in the quarter. That is a very good run rate. I'm not going to use that as an annualized figure. I'm going to take the first 6 months of free cash flow, double it, and annualize it that way. But overall, their earnings show a strong business, and live venues seem to be just in excessive demand. If Taylor Swift has a concert, there just isn't enough tickets. Beyonce has a concert, not enough tickets. It seems that the public just has an appetite that cannot be solved with the number of acts that are out there. It's quite interesting. I don't see the demand slowing down for the company. I valued the stock and came up with a result that the company is being discounted by 32%. If you buy a share of Live Nation stock, you'll pay $91.87. But the value of that share
based on my calculations, is $121. I get there by looking at their free cash flows, creating a value of per share using that method, then looking at earnings per share, getting a value, then blending the two. Let's go through free cash flow. I took the first 6 months of free cash flow and annualized it and then added the growth rate that I expect in free cash flows. And then I forecasted years 2, 3, and 4 to grow at 8%. Terminal value will grow at 4%, giving us an intrinsic value, a net present value of those cash flows of $35.6 billion. The cash on the balance sheet is $6.4 billion. Total debt is $6.2 billion. So the equity value is $35.8 billion. Market cap currently from Live Nation is only $21 billion. So it provides a 69% discount on the stock if we look at the free cash flow valuation method. The earnings per share is a little low, and I'm going to provide or apply a 24 PE. I don't like going too high on PE. This is a growing company. It's great, but I don't like using high PEs unless it's a high growth company, which I don't believe Live Nation is. I am going to apply a very high growth rate because the expectations are for high growth. Having said that, I only get a $52.56 valuation using the earnings per share, and the company current stock price is $91.87. So there's actually a premium on the stock if we look at the earnings per share method of 43%. Now, when I blend the two, I put more weight in the free cash flow method because great investors like Warren Buffett, Charlie Munger, they really focus on free cash flow. You look at the top 10 most valuable companies on the stock market, they all generate free cash flow and they grow that free cash flow. Earnings per share for those companies might go up and down, but free cash flow is king. That's what sets companies apart. And that's why I give free cash flow a greater weight in my valuation. So overall, it's a 32% discount on the number one company in ticketing and live venue management. I look for businesses that are desirable, and desirable means that they have strong competitive barriers to keep competitors out of their marketplace, be able to grow their revenues, grow profitably, and generate very high free cash flows. I also like businesses that are growing, have momentum, they're profitable, they have free cash flow. And Live Nation really fits in the ideal quadrant for me because they are the dominant company in ticketing for live events. They have few competitors that rival what they can do. Their market share is dominant, showing that customers like using their service. Artists depend on partnerships with Live Nation to have their concerts. They just have a stranglehold on this marketplace. So I put them in the most desirable quadrant, making them highly desirable for me. Having said that, I really like the company. I think the company sets itself apart and can't really be replaced. It would take a lot to replace Live Nation. The balance sheet's excellent. They have more cash than they do debt. They generate free cash flow. So really like the balance sheet. And I like the discount at 32%. So I'm going to plan to buy into Live Nation and build a position. Maybe invest about $10,000, but I dollar cost average in my investment into companies. I'm not good enough to pick the exact moment when a company has hit its low. So therefore, I'll just know that I'm going to be buying into a business that I do believe is discounted and over time accumulate shares at discount levels, ideally on pullbacks. We'll see how it goes. So that's my video on Live Nation. I hope you found it interesting. Keep in mind, I'm just an investor, just sharing my experience. I'm not providing any financial advice. I'm not recommending you buy, hold, or sell Live Nation. Please make your investing decisions completely independent of this video. Thanks again for watching. Good luck investing in 2024. Mercado Libre is an e-commerce company operating down in Brazil, Mexico, Argentina, and other Spanish-speaking countries in South America. It's a successful company that's really growing their revenue. I like the growth in revenue. I also like the geographic connection to Latin America. Mexico, as an example, their economy is doing well. They're doing well. Their middle class keeps growing, and their economy is doing well. So I think selling e-commerce down in Mexico is a great idea. I'm not quite sure about Brazil or Argentina, but I have heard that Argentina's economy is improving. Having said that, I am interested in having an e-commerce retailer in my portfolio. So I wanted to analyze Mercado Libre and see if it's a good stock to buy and put into my portfolio. I'll share my analysis with you and go through my evaluation of the company, see if it's really competitive or if it's just another company. I'll value the company based on their free cash flows and their earnings per share and compare it to the current stock price. And then I'll conclude with my intent to either buy or not buy and just pass on the stock and share that with you. None of this is financial advice. It's just one investor sharing his analysis and opinion on a company. Please make your decisions independent of this video and weigh them carefully. Now let's take a look at the fundamentals of Mercado Libre. Mercado Libre is an $81 billion company, and their revenue is just a little short of 16 billion. The PE currently is 72, and they are a high growth company, so that's somewhat understandable. Their forward PE is coming down because I think their revenue line keeps getting bigger, their profit keeps expanding, which is very good. Analysts really like the company, have a strong buy, and they say, hey, it's discounted by about 20%. The stock is rallying in the pre-market. It may open about 7% higher. So that's interesting that the market really liked the earnings they announced yesterday. I'll take a look at earnings in a little bit. Looking at their revenue, this is where the company is really impressive. Just the growth year over year has just been excellent. And they already have a pretty good number, and they keep growing it, a pretty big number of revenue. And they keep growing it by really big percentages. So that's a job well done by the company. Good job, Mercado Libre. The other thing I look at is cash flow. And the cash flow for this company is positive and has also been growing. If you look at the cash flow growth, I love seeing where a company consistently grows your cash flow over time. That's a sign of a really solid business that really has the model figured out, and they're probably just going to keep expanding that free cash flow. The balance sheet, I like debt to EBITDA to be less than 3. Let's take a look at what their debt to EBITDA ratio is for Mercado Libre. And that is a 2.04. Nice. Good balance sheet, really good company in a space that is expanding. They're profitable. They generate really free cash flow, really good free cash flow. So the fundamentals look really good for the company. Let me take a look at their earnings. The earnings report came out yesterday, and the company announced they grew year over year by 42%. That is phenomenal. Very good growth. Again, their revenue number keeps getting bigger and bigger. So growing at high percentages like that is more difficult, and it shows the company has a lot of special sauce to it. The margins, 14%, which is good for an e-commerce company. And net income margin, 10%. Again, it's an e-commerce company. And if you look at Amazon, they have margins that are in that range. Other things I think the earnings were in general very good. One thing I discovered about Mercado Libre is that they have fintech. I think they're doing a lot of financial services in the form of fintech. That is interesting. It's good that they're diversifying away from e-commerce and maybe catching another industry play that can give them better margins and keep that growth going. So very nicely done that they offer fintech, which makes sense since they already have a relationship with the customer. Why not sell the customer other products and solutions? So very nicely done. I really like that about the company. Their active users of fintech has really grown. And here is the layout. I think the biggest market they have is in Brazil. Second biggest market is Mexico. And then Argentina is in third place. So those economies, I believe, are doing well, specifically Mexico. That's probably the one that I know most about. Their economy is doing quite well. My one investment in Mexico has done well because of the economy expansion. So overall, the financials on the earnings report looked really good. And that's why the market is rallying today and really supporting a good stock price for Mercado Libre. I like buying companies where possible that are really strong competitively. They almost operate like a monopoly where they have no competitors, they can set prices, they continue to grow in an expanding market without a lot of competition. There's a few companies that are like that. Mercado Libre, I'm going to put them in the ranking, but I like companies in the green, and I like to stay away from companies in the red that have too much competition and there's too much of a price battle. Margins are being squeezed. There's very little cash being produced. I happen to think the Mercado Libre is straddling the green and the gray. Gray being, it's an okay company. A lot of old industry companies are in the gray. They're good companies. They're profitable. They just don't grow a whole lot, and they have some competition. Mercado Libre does have competition. Amazon is an example. Alibaba continues to grow around the world, and I think they do have competition, but they have big advantages since they focus in Spanish-speaking countries. I think culturally, they probably cater to that market far better. Probably the customers probably feel a better connection with Mercado Libre. So that geographic advantage, most certainly, I think is an advantage. It puts part of their whole proposition in the green. So I like the company. It's not a specific monopoly, and it's an industry that's really competitive. E-commerce is super competitive, right? And the margins are not the greatest. It's not like a software company or other companies like Facebook that have just incredible margins. So that's where I rank Mercado Libre in my desirability quadrants. What do I think Mercado Libre stock is worth? I happen to think that each share is worth $2,293, but the market is selling shares today at $1,732. So it's discounted by 32%. And the way I get to that discount is I look at their cash flows and discount their cash flows that I expect they're going to produce in the future to a current value, and really work towards comparing a value per share based on free cash flows to their current stock price. I also look at their earnings per share and see the valuation based on earnings per share. And together I blend the two and I get to a discount of 32%, which is a good discount on Mercado Libre. This is a higher risk company since they are outside of my home country, which is the US. A lot of things can happen that can surprise me. So I discount them at a higher discount rate, much higher than Amazon as an example, to compensate me for the risk. So those things are taken into account. Now, overall, I think a 32% discount is a very good discount on Mercado Libre. I'll be watching this company. Now, let me arrive at the decision. Should I buy or pass on this stock? Mercado Libre has really impressed me. I think they have a really good business model, and I love their revenue growth. It's a sign that it's a strong business that keeps getting bigger and stronger. So I really like the company. They have a really solid balance sheet with debt to EBITDA at around 2. The discount of 32% is also a good discount. Therefore, I'm going to start buying into Mercado Libre. It's a little bit of a tough day to buy into them since they're up about 7%. I hate buying stocks when they pop up like that, especially since the rest of the market's pretty much selling off today. So I'm going to let things settle down, but then start dollar cost averaging my investment in Mercado Libre and build a position. The other thing that could interrupt my investment in Mercado Libre is Amazon. Its stock price is really dropping, and Amazon is the strongest player in the space. If I can get Amazon at a very good price, I would be investing in Amazon instead of Mercado Libre. Let's see how that plays out and which one I end up buying. So that's my video on Mercado Libre. I hope you found it interesting, and I appreciate you watching. Meta reported earnings yesterday after the market closed, and the earnings were really positive. The company grew their revenue, they increased their profitability, they generated really good cash, and they're investing in the business so that they can build the next big business. Meta is the social application giant, really, of the world. If you consider billions of people log into a Meta application every single day, from WhatsApp, which is a very popular international application, to Facebook, to Threads, Instagram. The company is loaded with the top applications that people like to browse on, stay current on, build communities, stay in touch with family. It's pretty incredible how many things Meta does. A hidden gem for all of this is the AI business, and I'll take a closer look later. But Meta early on was not considered a big AI company, but as I study them closely, it is a big part of their business and a big part of the future. The metaverse continues to be a part of the company. They continue to build out the metaverse, and their Ray-Ban sunglasses have been popular. And maybe that's the way that people can go into augmented reality or virtual reality and have those experiences in the future. We'll see how that plays out. I'm an investor in Meta and have been an investor for a long time. And I wanted to analyze the company now that I have fresh data, take a look at their financials, look at their earnings, and see how the company is doing. Analyze the company and see where I put them on my desirability quadrants. Are they really desirable or just an okay company? Value the company based on free cash flows and earnings per share to arrive at what I think the company is valued per share, then compare it to the current stock price in order to make a decision whether I should buy more shares, just hold, or even sell my shares. I'll go through that rationale with you. Now, everything that I share is just one investor sharing his analysis with YouTube. It is not investment advice. Please make your decisions carefully and do your own research. Now, let's take a look at the fundamentals of Facebook, Meta. Meta is a large cap company with over $1 trillion of market cap. It's 1.2 trillion. The market's expected to make the stock go up at the beginning of the trading day. It's before the market is open. So if we add that 9%, it's probably going to be a 1.3, $1.4 trillion company later on today. The company has $142 billion of revenue, which is excellent. If you consider their margins, it's just an incredible amount of revenue. The PE for the company is 27. The stock has been doing well this year. And the forward PE is 22.5, which I believe is a really good value considering that the company is growing. It's clearly the leader in their space, and I would expect a higher PE. The company pays a small dividend, not a dividend stock by any means. And analysts really like the company. They think it's a strong buy, and the stock is discounted by 13%, soon to be 4% if you consider it's going to rise about 9%. The company's done really well over the past year. It's up 30. In 2024, it's up 35%. In 1 year, it's up 49.5%. It's really been an excellent stock overall. Meta's really grown their business over time, and they've gone from being a $70 billion company in 19, and now they're trailing 12 months, they're nearly a $150 billion company. That's incredible. And you can see the real growth rate. They had one slight down year in 2022. I think part of it was in 2021, they just grew so darn much. They probably pulled forward a lot of the investments. So overall, just great growth for a very big company to be growing 20% plus on a big giant number is super impressive. The balance sheet's really strong for Meta, principally because they have a lot of cash on the balance sheet, 58 billion of cash on the balance sheet, and they have less debt than they do cash. It's $38 billion. So they could pay off all their debt immediately if they wanted to. The most valuable companies on the stock market all produce high amounts of free cash flow. They also are growing companies. They are also leaders in their particular industry space. In the case of Meta, they are great at producing free cash. When you look at their sales, if you recall, were roughly about $150 billion, and they are producing about $50 billion of free cash. 1/3 of its revenue ends up being free cash. That's a clear sign that margins are excellent. It's not a business that takes a lot of expense. And overall, it becomes a really valuable business. The earnings for the second quarter for Meta were really good. If we look at revenue grew 22%, which is excellent. And the overall profitability increased 71%. So just a double positive where you have expanding revenue and expanding profit at a greater percentage. That's really impressive. The number of users on Meta platforms has gone up 7% year over year. So that looked really good. Their cash flow is very good. And the company is guiding to have an excellent Q3 and overall a very good 2024. Meta is a leader in social applications by a big margin. There's no other company that's even close to Meta's size and number of users and really daily active users, monthly active users, and they keep expanding. For example, Threads continues to grow and take market share away from X. Now, one hidden business, and I don't think it's been hidden all that long now, is the AI business. And you consider a couple of things. One, Meta was investing in AI. They just didn't really make a big deal out of it. And they have great capacity to build their AI application to do a lot of things. I was offered the Meta app a couple months ago, and I played around with it, and it's very good. I've played around with ChatGPT, Gemini. I don't use them on a daily basis, but I would say a couple times a week, I jump over there and ask it to do something. The Meta AI app is really good. And you think about the advantage that Meta has. They could offer their AI to billions of people quite quickly, easily. That access to that many daily active users, monthly active users is unrivaled. No one else in the space, even the massive Google, which has so many Gmail users and users of YouTube, they don't have as many users as Meta. You look at ChatGPT. ChatGPT is a very popular name among people that are probably ahead of the curve on technology. But to the average person, you ask them if they know of ChatGPT, their answer is no, and their exposure isn't very high. I think they have something like 135 million users of ChatGPT. Well, compare that to multiple billions of users on Meta. So Meta has a huge advantage of being able to distribute their AI app. So first, it's a very good app. Second, Meta has the capital to really make this business work. And it could become just one more application amongst its portfolio that is incredibly valuable. So Meta is just clicking and has a great operational team, and the future is really bright with AI being well covered by Meta. So I've put together my desirability quadrants to really point out the companies that I want, companies that I want to stay away from. And I want companies in the green, companies that have competitive barriers of entry so their competitors can't come in and compete for the business and drive down margins, drive down the value of that business. And stay away from companies in the red, which are companies that have excessive competition, they don't have great margins and don't produce much cash at all. And Meta is clearly the leader in their space. Their social applications are clearly ahead of everybody by such a margin. It's hard to imagine they're going to be caught at any time soon. More importantly, they continue to invest in their business to make their applications even more desirable. They expand their applications. For example, Facebook Marketplace is a really neat place where people are beginning to buy and sell. It has a lot of potential to be almost like an eBay within Facebook. So that really has a lot of potential, and just one more example of how Meta continues to expand and keep their user base really interested in their apps. So overall, Meta is an easy company to put into the highest point of the green quadrant, making it a really desirable company for me. And therefore, I'll treat it that way as I go into the valuation. So I've valued Meta using their free cash flows as well as their earnings per share. As mentioned, Meta is just a high cash flow producing company. It's also a growing company that really makes them really desirable. Their last year free cash flow is 47 billion. They'll probably do a little more, but I'm going to be conservative in year one and just have a starting point of last year's number of 47.3 billion. I'm going to grow it by 8% for the first 4 years. And then terminal value, I'm going to grow it 5%. I'm going to discount by 8%. I could easily go to 7.5 since interest rates are dropping. But again, let's be conservative, and I'll go with 8. Really, the net present value of all those cash flows in today's value is 1.6 trillion, dollars. I'm going to add the cash and take away debt. So the equity value of Meta for me is $1.6 trillion. The market cap, it's ahead of the market open, so I'm just going to use what's on public websites, is 1.2 trillion. And I'm going to compare the intrinsic value per share against a stock price that is the stock price that it should open at, $513. So when we look at the free cash flow valuation of Meta, it has about a 26% discount on the number one player in social apps. Earnings per share look great, 20.65. That might be a little bit conservative. The PE, I'm going to move it to 30. They are trading less than 30. I think they're worth 30. And their growth of that earnings per share is expected to be quite high. I'm going to go with a 10% growth rate on that earnings per share. It calculates a stock value of $681, but the current stock price, based on where it's supposed to open, it's $513. So there's about a 33% discount if we look at earnings per share. So combined, it offers a 28% discount for me for the number one player in their space, an incredibly growing company with the AI business and everything else that Meta delivers. I think that's quite an offer to buy a stock at a 28% discount for me. So I've looked at the company, really looked at their business to see if I like the business. And most definitely, I really like the Meta business. And I really like that the company just has not really stood still. They have made their company stronger and better. They've made their products better. The experiences that their users have, making them better. They've broadened their business, bringing in an AI, Facebook marketplaces. The Threads business is relatively new and is continuing to expand, the users and the engagement on that application. So the business is just a really desirable business, really a very strong business with a strong moat. And I really like the company. The balance sheet's excellent. They have more cash than they do debt. They produce high amount of free cash and high amounts of EBITDA. So the balance sheet is incredibly strong. So balance sheet's good, company's great, and a 28% discount on a high quality company. So I'm a buyer of Meta. I've been buying Meta shares on pullbacks just because I want to continue to build my position. I have a position at $198,000. That's before the open. If it opens 9% higher, it'll be 9% higher on that amount. And I continue to add shares. It's the biggest position in my portfolio. And I am comfortable with that because Meta is such a great company. Most of the appreciation that I've seen is making up that number. I'm sitting on a good gain with Meta, and I'd like to see it grow and grow in the future. So that's my video on Meta. I hope you found it interesting, and I really appreciate you watching. "3M had an excellent day today. The stock was up 22% after the company announced earnings. 3M is a company that I've followed for many years. I've known of 3M ever since I was in college. That's 30 years ago. And I've always respected the company. They're a company that has continued to innovate and really put good ideas to work for either industrial accounts or consumers. The company started in the mining business a long time ago, but realized that they should really grow into businesses that were probably more profitable and better for their company, for their employees, and really for the economy. Overall, I'm a fan of 3M. They fell on hard times recently where they did manufacture some earplugs that ended up causing hearing loss to some servicemen and women. And that's really unfortunate. I don't think the company meant to do that, obviously, but they did have to pay a big settlement. That's behind them. And I'm glad to see that they are going to proceed forward with their business. They paid off the plaintiffs, and hopefully all the plaintiffs are going to be okay. But now that the business is going ahead beyond those problems they had, the business I thought was going to be a really good rebound business. And I'm glad that I started investing in them in 2023. Overall, the return's been really good. And I wanted to analyze the company now that they've announced their earnings and see if I want to invest more money into 3M, if I should just hold my shares, or if I should sell my shares. Did I already get enough return and I could sell the shares and make a good profit? I'll let you know that at the end of the video. Now let's get into the fundamentals of 3M and go through the valuation of the company first. 3M has a market cap of $70 billion. It really went up today. It went up really 23%. So it was a very good day. And revenue is $32 billion in revenue. They have a PE ratio that forward PE of 17, which is fairly reasonable if you consider a lot of PEs on the S&P are in the mid 20s. It pays a nice dividend, and analysts had a buy rating. And now with the stock really going up, it would be sold at a premium based on the calculations they had before their earnings. The company overall, again, it's a rebound story. They had trouble in the past. Their revenue isn't going to look great, but overall, the most recent quarter, and I'll look at their financials next, it shows that their revenue did grow just a slight bit. More importantly, their profitability really went up. Taking a look at their earnings for the second quarter of the year, their sales were relatively flat. They had just slight growth, 1.2% year over year if you look at the most recent quarter. But they did surprise, and they had better earnings per share than were expected. And I think that's what the stock market got really excited about. It really does help on a day when they announced their earnings. There also was positive economic news, which was that inflation is being tamed. Inflation, the producer price index came in at 2.5, and that surprised in a favorable way. So that combined with the good earnings really helped 3M have a great day. Overall cash flow is improving, which is excellent. That's very good to see. It'd be great to see 3M return to the glory days that they once had, where they really produce high free cash flows. Looking at their balance sheet, it looks good. I'll look at the balance sheet more closely. They're in an industrial business, automotive, consumer products. For the guidance, I want to get to the guidance. They raised their guidance. They raised their guidance on the profitability that they're going to have. They're going to be more profitable than originally stated, and they're going to have better earnings per share than originally stated. So overall, it was a positive earnings. And overall, I think I'm not the only one that thinks the 3M brand is really positive. I'm sure there's other investors who think highly of the company and really expected the company to rebound like myself. I think it's becoming reality now with these types of numbers. So where do I rank 3M in the overall desirability of this business? What's really important for me is to know what type of business am I buying? Am I buying a business that has really good competitive barriers and can keep competitors out of their market, pretty much operate close to a monopoly? Companies like Google Search, Microsoft Software, and such. And those companies would be in the green. Those are great businesses that just have really strong competitive barriers against competition. The worst companies, they have no barriers. Anybody can enter their market, compete against them, drive down prices, be overly competitive, and nobody makes any money. 3M, I think at one time was clearly in the green in their heyday. I would say that not too long ago, they were in the gray, where they were just trying to figure out how they were going to get out of these lawsuits and get ahead of these things. Now they've done that. I think they're moving towards the green. They have a lot of products that are very well liked by the market, liked by their partners. They have a very good network of customers. They have a lot of patents, a lot of good stuff there. But I wouldn't put them completely in the green. I'm going to say that they're in the gray, and an investment in the gray for me, I have to get a very good discount. And based on the discount that I was getting a year ago from 3M, it was a good investment. So that's where I put 3M. They have a medium barrier of entry against competitors. I think it's a strong, moat, but it's not very wide. It's not like an Apple that has that device that everybody wants. So that's where they sit in my desirability quadrant. It's a good company, but it's not a great company. So what is 3M worth? If I look at their cash flows that I expect the company is going to produce, as well as the earnings per share that I expect the company is going to perform. Well, let's take a look at both. First, with cash flows, I put together my own forecast. The best forecast I could put out there is, they had a good year in 2023 when it comes to cash flow. I'm just going to go 70% of 2023, which gave me 3.5 billion. They're operating towards that number, and I think it's a good number to start a forecast of cash flows for this company. They're doing better now, so I raised the growth rate to 10% from my previous valuation. That gives me a forecast for the first 4 years represented here. And then terminal value will grow at 4%, all cash flows beyond year 4. Now, the discount rate is 8.5%, which is a reasonable discount rate for this company. When I discount all those cash flows to today's value, it's $85.8 billion of value if you look at those cash flows. I add the cash and take away debt to get to an equity value of $75.4 billion. The current market cap is $70 billion. So the company now is being priced pretty close to their stock price. So it's fairly priced. It's a slight discount, but it's pretty close. If we look at earnings per share, I'm using toward the higher end of the earnings per share that they represented, and I'm using a PE of 18. They're not too far from that number. I'm going to grow those earnings per share by 6%. The economy keeps getting better. I think there's good times ahead for 3M. It gives me a per share value of $137. The current stock price is $127. So there's about an 8% discount available if I look at the earnings per share. Combined, when I blend the two, I get about an 8% discount on 3M. That's a small discount. Doesn't compel me to buy a ton of stock from this point. And remember, I have 3M in the gray. It's a medium desirable company. It's not like a Google or an Apple that is very desirable. So if I'm getting a small discount on a company like that, I'd probably take it. But a company in the gray, I have to know that I've got a better discount. It's still a rebound story. The rebound is looking really good, but it's not done. So I'm going to have to really think long and hard about buying more shares at this discount rate. Looking at where the 3M stock has traded over the last 5 years, boy, it's been a real roller coaster for the company. I don't really consider COVID anybody's fault. It just happened, and a lot of company stocks went down. 3M stock really rose out of COVID, and it went up 65%. But then came the big drop from the high point to the low point. Boy, nobody wanted this stock. It went down 58%. And really buying in 2023 may have been a good idea. In fact, it's proven to be a good idea because the stock's up 75%. So it really provided one of the premium companies in the history of the United States, I would say, especially over the last 100 years, an opportunity to buy that company that put out so many great products and, in my eyes, has a great brand, has a lot of smart people working there at a discount. And I'm really glad that I invested in the company when the investing was good. So what should I do with my 3M stock? Well, I'm glad that I bought the shares in 2023, and then I dollar cost average my investments. I'm not smart enough to pick the very low point in a stock. I just know when a stock is discounted, and I tend to buy when those prices are discounted. Overall, I'm sitting on a 49% gain on this stock in less than 1 year. So that's been great. And I'm going to hold my shares. If the stock rises anymore, I may consider selling. There's nothing wrong with taking a solid gain and just banking that money. Because you never know that maybe in a year or two, this stock can really go down. I could see myself holding this stock for a long time. It's just, I have to be smart with these gains. I like taking gains at times, banking them, and then seeing what else is out there to take advantage of, really doing it all over again, finding the next 3M that is unappreciated, undervalued, buying it at the right time, and then making a nice gain. So that's my video on 3M. I know that I got one comment on the community page asking for 3M, and this is for you, for that viewer that wanted it. I hope that you invested a lot of money and you had a very good return. And just one last reminder, I'm an individual investor. I'm not providing any financial advice, and I'm not recommending you buy, hold, or sell 3M stock. I hope you enjoyed the video, and I appreciate you watching. MPW is the stock that I get asked about quite a bit. This is a stock that could be a multi-bagger, and I think it lures a lot of investors to take a look at this stock. What also lures investors is a very high dividend rate. This is a very troubled real estate investment trust. Their principal tenant, Stewart, ended up in bankruptcy, and that created a big strain on the MPW business to the point where MPWs had to sell properties to drive up their cash flow and really stay as a viable concern. Overall, I'm all for seeing a rebound story, yet this one has been going on for a while. I can understand a rebound and giving a company 2 quarters to really show promising results or maybe showing that they're back on track. This one here is kind of stayed in the same cycle for over a year now, which is really, really concerning. I decided to completely sell my shares. I just thought that it was too much of a distraction. And before this past stock pullback, I wanted to drive up my cash position. So MPW is one of those stocks that I sold to create more cash. I'm glad I did, but I kind of felt like I was admitting defeat on a stock that I hoped would go up. I still hope it goes up. I still hope that the investors that hold MPW are rewarded for taking the chance on this company. I wanted to update my analysis on MPW and share with you how I feel about this company now that we've had a little over a year of the company trying to get out of this trouble. So MTW is a small cap stock. They're about $2.95 billion as a revenue cap, which in this day and age, that's a tiny cap. The revenue has been going down. It's $320 million per year. And I'll show the income statement and show you how revenue has gone down because they've sold properties in order to create cash on their balance sheet. Their dividend is attractive. The concern there is the payout ratio. We got to look at funds from operations, and I'll do that in a few minutes. Analysts say it's a hold and that the stock is discounted by 10%. The stock over the last couple of years, it's not a very pretty picture. The stock used to trade around $20 a share, and this is a real estate investment trust that operates in healthcare. So leasing out hospitals, clinics, urgent cares, that type of thing, to me, is fairly steady. So having your primary tenant, the biggest one you have, go bankrupt just really, really put a strain on this business. They've gone from being a $20 share per share stock down to bumping around, $4 or $5 per share. Now, stocks like these, if you buy them at the right time, and other stocks that I've seen really rebound off these lows, good example would be Zim. That's done really well because it's really risen above the low that they reached. This one, MPW, you could have made some really good returns if you really knew where the bottom was, but that's really tough. Even if you just dollar cost averaged this year, you'd probably be doing okay. I know I sold at a loss because I started investing well over a year ago and probably invested a little over $5 per share, and I sold probably around $4 per share. So the company has had enough volatility to offer up some really low prices, but is it going to pay off for investors? Well, I think it's all about if they can just get this Stewart tenant off their books and out of the business and just have a clean business, then I think the answer is that the stock should rise. The other thing I would point out is I think that you got to have a little bit a changing of the guard where management that got them into this mess with Stewart, I think there needs to be some accountability and get some new people, some new blood into the business in the management team. You see how a new CEO could really do a lot of good. If you saw Starbucks decided to switch the CEO and put in a different CEO, and the stock rallied over 20% in one day. I think it really just changed the whole theme of Starbucks. We really needed that. I think if you had a new management team, investors might think differently of MPW and feel like they really have turned the page. That would just be an idea that I would throw out there. So if they make it, I think investors are really going to be rewarded. If they stay in these cycles of just bad news after bad news and can't get this Stewart bankruptcy through their system and off their balance sheet, then I think it's going to just continue to just cycle and keep this stock down for another year or so. The revenue for the company has been going down. Understandably, that you've got your biggest tenant not paying you, and that can really lower your revenue. They've also sold properties to create cash on their balance sheet. So they've seen their revenue really go down in 2023. In the trailing 12 months, it's really gone down as well. That's really concerning. I use top line revenue to tell me the health of the business. And obviously, this business is not healthy when they're losing that type of revenue. The other item we have to look at is funds from operations. That's how, for a real estate investment trust, you got to make sure they can afford that dividend. It's very attractive, but in 2023, it was way over funds from operations. That's why they lowered that dividend. So is that just going to happen over and over again where they have to keep lowering the dividend rate because they just can't afford it? We'll see. A 12% dividend is very, very high. They could probably cut it to some extent, and it's just going to set a bad precedent again. But a 12% is very high. It's abnormal, and companies typically don't pay that high of a rate. It's principally because the stock price has gone down so much in value. We'll see if it gets cut again. I wouldn't be surprised if it does, because the company is in survival mode. They have to figure out how to survive, and it may be at the cost of reducing that dividend again. Most analysts think the stock is either priced fairly or priced at a 10% discount. And one analyst actually thinks the stock ought to be priced around $10 per share. So there's an optimist for you. Overall, there's 10 analysts covering the stock, which is pretty good coverage for a small cap of this type. I think it's gotten a lot of attention since it's gotten a lot of press around the Stewart bankruptcy. The earnings per share in 24 is expected to be a loss, but it's supposed to be positive in 25 and 26 as well. I would say that it's a tiny earnings per share. I don't know that it's going to drive much of a valuation at all. And that's just kind of another bad sign of the company. It might be that this company gets sold for its parts. Somebody buys it and kind of rebrands it, or a bigger real estate investment trust buys it and gets rid of the bad stuff and keeps all the good stuff and just operates those properties under their own brand. Who knows? But what I'm seeing is just fundamentals that are really bad for a business. And I hate saying that, but it's just reality. I'd prefer for the company to really show more promise in the immediate future. They've had a lot of time to kind of sort through these issues. The one item that I would say is the interest rates coming down are really helping MPW. If you have lower interest rates and these guys have to redo their debt, they could probably get lower rates as opposed to the higher rates that we were paying a year or 2 years ago on loans. So that's a bit of good news and a bit of good luck. Overall, I think MPW has a chance to make it. I certainly hope they do, but I think it's going to take a while. And I wouldn't be surprised if it's just another year or two of disappointing news. For me, I'm staying out of the stock. I think this type of stock just gets me in the wrong road. I'm looking for the next Meta. I'm looking for the next Uber. And I'd rather spend my time and take my chances and make my bets trying to find a company like that than waiting around for MPW to turn their business around. I hope they do, but I just don't want to be waiting around. I think it's more of a distraction than it is valuable to me. So I'm staying out of MPW. I hope all the investors make money on this stock, because I think investors deserve a good return on this stock. So that's my review of MPW. Hope you found it interesting. Keep in mind, I'm just an individual investor, just sharing my analysis with you. And I'm not recommending you buy, hold, or sell MPW. Appreciate you watching. Good luck investing.
Merck announced their earnings today, and I wanted to go through their earnings and then quickly value the company to see if this is a stock that I should be interested in. I currently don't own any Merck stock, but I've known of this company for a long time. Who hasn't? They've been a real well-known company for a long time. Now, let's take a look at their earnings. They look at their fundamentals and see if this stock presents an opportunity, a discounted stock, or maybe if it's priced fairly, or maybe it's overpriced and we expect that it might go down in the future. Let's take a closer look. Merck is a $323 billion company. That's a pretty big market cap. And part of the reason for that is over the last 5 years, the stock's done quite well. It's risen from about $70, $75 a share up to $127 a share. And likely it's because they've done well from a business. They've grown their revenues and so forth. So they probably deserve that. Their forward PE is 14, but in the current year, it's quite high at 141. They pay a dividend, and I'm sure income investors like that dividend. Analysts like the stock, and they believe that it's discounted by a little bit.
Now, earnings were announced and the stock is down 3.6%. Interesting. When we look at their revenue, the revenue historically has been good. They've grown their revenue over the last 4 years, although 2023 was a little bit slow. If we look at the quarterly, revenue is good. So the revenue has been growing nicely, which is good to see. A company that grows their revenue at this rate, I consider this a good revenue company. And you see that in 22, they had really good revenue. It really did dip. Maybe they sold forward in 23. When we look at their free cash flow, most pharmaceutical companies produce really good free cash flow, and Merck really does as well. They have historically produced really good free cash flow, and in the most recent full year, they produced $9.1 billion. I'm going to use about a $10 billion rate of cash flow, so I can get a quick value for the company. When I look at Merck's revenue, it looks pretty good. The company increased their revenues by 7%, which is very good in the second quarter for their business. Overall, positive earnings per share, and the company really operated well. Their full year guidance, they raised their guidance, which is very good on their top line revenue, and they expect earnings per share had a decrease to it. So maybe that's what's causing the price decrease for their stock. So they had to set an expectation that they're going to have a negative impact from a one-time charge of approximately $1.3 billion. That might be the reason why the stock's selling off a little bit. But again, sales did grow, which is always a good barometer of the health of the business. If you're growing your revenue, that means customers like your products, you're getting more customers, you're increasing your price. All those things are good. In general, I think their earnings were good, but as you saw from the stock price, it's been going up. So I think investors expected more, and they've been paying a premium for the stock potentially, and they expected more. So that's maybe why it's selling off a bit. How desirable is Merck as a business? Well, I like to put companies in the desirability quadrants that I've put together. The green representing companies with the strongest moats and the ability to operate almost like a monopoly, setting their own prices, really getting more demand than they can probably fill. And they're probably the most profitable companies operating out there. And then there's the worst companies in the red, which are in industries where there's just too much competition. Those competitors are constantly slashing prices, getting rid of profits, and seldom do those companies generate really good free cash flows. Merck is a pharmaceutical company, and there's a lot of desirable aspects to a pharmaceutical company. Although I'm not going to put them squarely in the green, I'm going to put them straddling the green and the gray. Gray being that there is a moat. It is strong, but Merck does have competitors in a few drug franchises that they have. They are the sole company that provides that drug, but in many other categories, they compete in the marketplace, and that tends to drive down price and profit. So it's a really desirable company, but not the most desirable company that I see out there. Now, I don't currently own Merck, nor have I done deep analysis on it, but I like to do a quick qualifier calculation to see if I would really want to dig into this company and invest my valuable time. And I have a quick valuation calculation metric where if a company has no revenue, I have a multiplier against their free cash flow, modest, good, and high. And I think that Merck has good revenue. They've been growing nicely. They have good, consistent growth. So I'm going to take their current annual free cash flow, and I'm going to use about a $10 billion figure, multiply it times 20. I get a $20 billion value for a company like that. But their current market cap is $323 billion. So I think just very quick calculation, the stock seems to be overpriced. And I probably won't invest more of my time because I'm looking for stocks that look great and present a value proposition to me where I think the stock's going to go up over time. So this one doesn't qualify, and I'll stop my analysis at this point. Merck is a high quality company, but it's not discounted. It doesn't provide a great investment option for me. So I'm going to just pass on this company and let other investors own this stock. There's a lot of choices in the market. It's not like I have to buy a specific stock to make lots of money. I have great choices out there, and I'm looking for choices where I could buy a stock and really make good money. In this case here, again, Merck is a great company, a great business, but the price is a little high, and I'm going to go ahead and pass. I hope you found my video interesting, and I appreciate you watching.
Welcome back to my channel, fellow value investors. In this video, I'm going to be covering Microsoft. Microsoft is the biggest software company in the world, and they are in just about every part of the software industry you can imagine.
whether the software is being used for personal reasons at home, students, businesses that need to run their business, store big, data sets. Microsoft is in just about every industry, government, and institution. They've been around since the 1980s and were really part of the big PC build out. They were part of the, connected.com surge, and now they're part of the AI build out. Microsoft has a couple of things going for it with regards to AI. First, it has a big hyperscaler business where that hyperscaler business can help companies build their large language models for AI. And that business is going to thrive as companies use Microsoft Azure to build out AI. They also they have a big partnership with OpenAI, so that ChatGPT is being integrated into a lot of their software products. Most definitely, Microsoft, their narrative has been really positive and gained a lot of attention, positive attention from the marketplace, and their stock price has really gone up as a result. I think their main competitor for AI is going to be Google, and Google has really been stumbling. Google's an incredible company, and I think they have a very strong AI business as well. But Microsoft has certainly been perceived as just really doing a great job in rolling out their AI business. Their narrative tends to be very positive, and if anything, just gets a lot of positive attention. So it's interesting how that's played out. In this channel, I value companies, and I want to know what I think fair price for Microsoft is and compare it to the current stock price. I'll share with you what I plan to do with the stock. I'm currently not a Microsoft stock holder, but I'd be a Microsoft stock holder if I can get a reasonable price on this great company. Now, let me show you more on Microsoft. The fundamentals on Microsoft are really impressive. The company has become the most valuable company traded on the stock market. Their market cap is $3.02 trillion. And that's incredible how valuable Microsoft has become. Their revenue is well over 200 billion and growing. They're growing at around 12% per year, which is really impressive since they're already so big. Their forward PE is 32, which I think is reasonable since the PE for the S&P is 26. Microsoft's a growing company that has a pretty bright future. Most analysts are real big positive proponents for the stock and they have buy ratings, but the stock has run up quite a bit over the past year. It's up 56%. And compared to NVIDIA, that's pretty rational. And it's funny to say that because 56% in any normal year is a phenomenal year, but NVIDIA and even Meta are just crushing their stock price. So Microsoft is interesting. It's interesting that in 24, they had a surge in January, but they've been trading sideways for about a month now, which is interesting. Maybe stockholders are pumping the brakes and seeing that, hey, a $3 trillion valuation is fairly large. How much higher can the Microsoft stock price go up? I'm going to value Microsoft based on the free cash flows I expect the company is going to produce in the future. And I'm also going to value the company based on earnings per share. Let me go over free cash flows first. Microsoft really generates high amounts of cash flow. And I expect for the next 12 months, they're going to generate $59.5 billion of free cash flow. And I get to that number by taking the most previous closed year and then growing that number by 8%. The first 4 years, I'm going to grow at 8%, which is a reasonable factor to grow those high cash flows. And then after year 4, in terminal value, I'm going to grow those cash flows by 4%. These are very large numbers. So growth in these numbers is very difficult. You're just consuming or taking over so much market share, and you're taking so much more of the customer's wallet that I feel that 8% growth in the first 4 years and then 4% is reasonable for Microsoft. This is a high quality balance sheet. So their discount rate that I'm going to use is very low at 7.5%. The present value of all those free cash flows is about $1.8 billion. They have a little more cash than they do debt. I'm going to add the cash and take away the debt to get to an equity value, which is $1.78 billion of value. Compared to their market cap of $3 trillion, the company is actually trading at a 40% premium when you compare the value of their cash flows compared to the stock price and the current market cap. Earnings per share tell a different story. Earnings per share look really favorable. The company's nice and profitable. And I'm using their forward earnings per share, which is expected to be 11.89. Their PE is 36 for me. I know that That might be a little high in other people's books, but Microsoft has a lot of momentum. I think they have growth. I think they deserve a higher PE. And I'm going to grow those earnings by 4% per year. Based on those factors, the company is actually fairly priced on earnings per share. I weigh free cash flows. The discounting of free cash flows is a better measure of a company's value. And when I blend the two methods, I get to 27% as a premium on the Microsoft stock. Now, a 27% premium is a little too much of a premium to pay on Microsoft. If it was fairly priced, I would consider buying shares depending on, if I believed in the business in their next 5 years. I think the next 5 years for Microsoft are going to be really positive, but a 27% premium is just pretty high. In summary of Microsoft, I think their business is awesome. I would love to be an owner of Microsoft, a part owner. I think their industry is great. Software is proven to just generate lots of value for stockholders. The company just has a great management team, just great employees. Their debt is it's zero debt because they have more cash than overall debt. So well below the metric that I really like to follow, which is having debt less than 3 times EBITDA. But there's no discount on the stock. And again, I'm willing to pay a fair price for a great company, but not a high premium for a great company. So I will be a seller of Microsoft stock and hold until I see a correction in the stock or things change. Maybe the company does so well that their actual fundamentals, the amount of free cash flow they generate, really goes up and it changes their valuation. But I'm going to hold tight and keep looking at Microsoft in the future. It'll be interesting to see how far, how fast, and who's going to win or lose in the generative AI space. It is a new space. A lot of things need to be determined, but most definitely Microsoft has really looked good for the last year in regards to AI. We'll see if they can keep it going and for how long. I really appreciate you watching the video. I hope you found it interesting.
In this video, I'm going to analyze Netflix and make a decision whether I should buy more shares, hold my shares, or sell my shares in the #1 streaming company in the world. Netflix has a storied history. They came out of the DVD industry. They used to rent out DVDs, mail them to you, and you'd return them in the mail. But they knew that the future was all about streaming, and they really bet the company on building a streaming business. And boy, did it pay off. They are the #1 streaming company. They're well ahead of all competitors, clearly ahead of everyone. They have the best service itself. The software functions the best. They have a great library of videos, and they have the biggest user base that is a paid user base. It's global. Here in the US, geez, I can't think of a household that doesn't have Netflix. But as you go around the world, Netflix is really growing around the world. This is a profitable company that can really turn on and turn off free cash flows as needed. They build their own content. They develop new movies. They develop new shows. Some of the best new shows are coming out on Netflix. They're even going into sports. Drive to Survive really put F1 at the forefront of the viewers' experience here in the US. It's just been a huge hit. And I think they want to continue to grow in sports. Overall, Netflix is clearly the leader. And is this company well priced currently at their stock price? Is it priced at a premium or at a discount? I want to find out. I'm going to do my own analysis and get to that decision. I'm going to go through the fundamentals of the company, show that to you. Then I'm going to go through my process of making a decision whether I'm going to buy more shares, hold, or sell my shares in Netflix. The Netflix stock is up 32.94% year to date. It's a really nice return for 2024. In 1 year, the stock is up 87%, a really nice return. If you look at the 5-year chart, you can see where the stock was really discounted in the 2023 timeframe, and it really rose 255%. And there's a correction on that. It was in the 2022 timeframe that it rose 255% if you go from the low point up to where the stock is trading today. It still hasn't reached the peak that it got to. It's down from that peak about 9.7%. You could see where you could have picked up Netflix at a really good price not too long ago. The fundamentals of Netflix. The market cap for the company is $269.5 billion. Pretty big market cap. This is a mega cap stock. Revenue for the company is $33.7 billion. So you're paying about 9 times revenue, which is really good for the #1 streaming company that is growing. They have solid net income at $5.4 billion.
And they have a forward earnings per share of 35.4, which is reasonable for a growing company. They have lots of analysts covering the stock, and they have a buy rating on the stock. And they have a price target of $578, which is below the current stock price of the company. The company has been growing the revenue really well. In 23, they grew 6.67% on a very big number. In 22, about the same amount. In 18, 18% growth. So company is a growth company. They're growing globally, and they can also increase their prices, which would really drive top line growth for the company. The company's really grown their cash flows. Their cash from operations went from being negative to being very positive. You can see that in 19, they were cash negative on operating cash flow. But since then, they've been positive on operating cash flow. And this past year, they had really good free cash flow because they had a lot of cash from operations and very little CapEx. So that just really looks good that the company is really profitable and beginning to generate really cash flow, similar to Alphabet, Meta, and all the other technology-based companies that make a lot of money and return a lot of cash back to shareholders. Analysts cover Netflix, and their price targets are a little dated. This company, the stock price has been moving up so fast that it's moved beyond most price targets. The average price target is $578, and stock price is trading at $622. The high target is $765 per share. But you can see that analysts put these price targets maybe 3 to 6 months ago, and that the stock has been moving up so fast that it's really gone past those targets. The balance sheet looks really good for Netflix. They have a lot of cash on the balance sheet, and they have a reasonable amount of debt. Their debt to EBITDA is 0.68, and I require that it be below 3. So it's well below my benchmark. So it's doing really well with regard to its balance sheet. Earnings per share look great. The company's really growing earnings per share. The company is expected to do $17.52 per share in 2024. But as you go into the future, you can see that it's really going to grow 23%, 19% in the next couple of years. So this is just going to continue to drive that stock price higher because the earnings per share is really moving up for Netflix. I calculated the value for Netflix using their free cash flows and also using their earnings per share. And I came up with the fact that this company is currently selling its stock at 8% premium, meaning that I believe that the stock is really worth $601, but the stock price is being sold at $622. Again, this is a really well-operated company, number one in this category. A lot of investors like it, which is why the stock price is really high. So should I buy more shares in Netflix, just hold my shares, or sell my shares in Netflix? Well, let me go through my scorecard and make that decision. First, do I really like the company? Do I like the industry they're in? Absolutely. I think Netflix is in a great industry. I really like it. I like the fact that they're number one, and the company is really well operated. They really are ahead of the pack when it comes to their industry. They continue to invest in the business, making it better, making it bigger, making customers even more happy with Netflix. The debt is well below 3 times EBITDA, really looking good. All those things look great, but there's no discount on the stock, which is kind of a bummer because that's going to cause me to just hold my shares in Netflix and see how their fundamentals change, which might change the valuation of Netflix. Or maybe the stock price comes down a bit and it becomes at a good price to buy additional shares. Netflix is one of those companies that actually created the industry that they're in. Streaming, it was really Netflix that really built this business. And now all other media companies are trying to catch up. You see Disney with Disney Plus, Apple with Apple Plus, and Peacock from Comcast, and all the other players are trying to catch up to Netflix. But Netflix is really a pure play streaming company that's really going to focus on the business. I like that a lot about the company. Overall, it's just a great company, and their stock price has really run up. It's not time to buy more shares for me, but I'm going to continue to own these shares and really continue to evaluate the company to see if there's a better entry point in the future. I hope you found the video interesting, and I really appreciate you watching. Nike is the dominant athletic footwear company in the world by a wide margin, and their stock price went down 20% on last week's trading at the end of the week after the company announced their earnings. Wow, 20%. Is it time to cut bait and get out of this stock? Or is it time to buy more shares and buy into this company since it's being discounted? That's what I want to answer in this video. I'm going to analyze Nike, go through my whole process of looking at the company, and then I'll make a decision whether I should sell the shares that I currently have, buy more, or just hold. Let's get into it. So first, I'm an individual investor. Nothing of what I do or say is investment advice. I don't recommend you buy Nike. Don't recommend you sell it. Don't recommend anything related to financial actions around Nike. I also have a sponsor, Moomoo, who sponsors my channel, and I appreciate that. They're offering new account holders a really nice offer where they'll pay you 8.1% on your cash that you hold with Moomoo. They'll also, after 3 months, that's an introductory rate, they'll pay 5.1. They'll give 15 stocks to new account holders that put in more than $1,000. And that's a pretty good offer combined with an 8.1 and then 15 free stocks. Take a look in the details of the video if you're interested in that offer. Now, Nike. So Nike clearly is the dominant company when it comes to athletic footwear. You can look at any sport, just about most of the athletes wear Nike. They have the strongest brand, and the margin between the value and power of their brand compared to Adidas, which is probably in second place, or Puma. There's some brands out there that they're recognizable, but nowhere near the power of Nike, especially here in the United States. But I imagine it's the same around the world. So the company is recognized, and their shoes are held in a higher desirability, I think, category than typical shoes, let's say from Adidas, Puma, and others. So that's one recognition, is that Nike has clearly a brand like a Coca-Cola. It's very recognized, and it gives them an advantage. Retailers want to carry Nike in their stores. Online companies want to carry Nikes on their websites. Athletes, they want to be endorsed by Nike. Their whole network effect is quite powerful compared to the other brands. And they had a movie come out recently. Matt Damon and Ben Affleck were the actors in that movie. And I really liked the story they told. At one point, Nike was small, and they really had to fight hard to be relevant in that case, basketball. And they certainly became relevant because they signed Michael Jordan, and they created the Air Jordan line of shoes, which have become just a huge, huge success for the company as well as Michael Jordan. So the company really got to where they're at by having great shoes, a great product, and having great partnerships, and really just being more creative, and probably just hungrier, harder working than their rivals. So the advantages that Nike has as a business are really desirable to me. I think it's a company with a strong, wide, competitive moat. Companies cannot compare against Nike. If Nike were to falter for 5-10 years and another company really performed really well, maybe at that point you could see that their moat would be threatened. But as so long as Nike continues to do what they do, which is really dominate the professional sports endorsement game, dominate, the retail shelf space that they command, dominate online sales, dominate direct sales to their consumers, I don't think their moat is going to be threatened. So I really like the company, and I really like their competitive moat. Their balance sheet. Their balance sheet's excellent. They have almost as much cash. Actually, they have more cash than they do debt. So they can pay off debt immediately. And EBITDA, they make almost as much EBITDA as they have of debt. So they could pay off debt in almost 1 year. So that's a very strong balance sheet. On their earnings, they announced that they reduced their inventory. So that's just one more element of making their balance sheet even stronger. Because the lower the inventory a company has, the lower the risk of that company having a write-off of their inventory for inventory that's become stale and less desirable. So all things are good with the balance sheet. So really good company, good balance sheet. Now let's talk about the discount of the stock. And I value Nike using two methods. One is using the free cash flow method, meaning look at the free cash flow that I expect the company is going to produce in the future, discount those free cash flows, get to a value of what that company is worth. The other is to look at earnings per share, value the company based on the earnings per share that I expect the company is going to provide. Free cash flow looks really good. Their trailing 12 months, a free cash flow is $6.9 billion. And I'm going to grow that by 10% because they have been just performing really well. They are putting more cash on the balance sheet every quarter, very profitable. They have certain products that are very mature and they generate a lot of cash. So next 4 years, I expect they're going to grow free cash flows by 10%. And then after year 4, grow at 4%. It's a really strong company. So I'm going to discount all those free cash flows that I expect by only 8%. I get to a value of all those free cash flows of nearly $190 billion. I'm going to add the cash on the balance sheet, which is $11.6 billion, and take away debt, which is $8.9 billion. You get to an equity value of the company of $192.5 billion. The current market cap of the company is $113.7 billion. So there's a 69% discount if we look at the company based on free cash flows. So that's a really strong discount. The earnings per share. First, a lot of analysts cover Nike, and it is a stock that they believe is discounted. I'm going to use the forecasted earnings per share for the current year, which is $3.79. I'm going to give them a PE of 24 and a growth rate of 4%. It gives us a value per share of $94.60, and the current stock price is $75. The discount using the earnings per share method is 26%. So both methods provide a discount, and the free cash flow method provides a greater discount. Now, I put more weight in free cash flows because I believe that's the truest measure of the value of a company. I put 2/3 weight on free cash flow method, 1/3 on earnings per share. When I combine those two valuations, I get a 55% discount on Nike. It's a very attractive discount on this company. Let me add a few more fundamentals that I like to track. First, momentum. The momentum is not with Nike. Their stock is down 20% in the last month. Part of it is this past week. It was really a bad week. So momentum is against Nike. I think the stock may continue to drop. The business risk for the company is low. The return on invested capital looks really good, 19%. That's exceptional. The earnings yield is very good, 5%. The free cash flow yield is very good at 6.1%. Now, as I look at Nike, I like owning premium companies, and you get them at a discount when times are tough. And times have gotten tough for Nike. This past week, a drop of 20% is really substantial. I read through the earnings, and yes, the company did not grow much. They grew a tiny bit in this most recently closed year. They just closed their fiscal year that closed at the end of May. So having said that, it's a premium company. I love the company. I love the strong competitive moat. I love their balance sheet, and I love the discount. So I'm going to continue to buy Nike shares, and I'm going to buy in good quantities. I could see investing $50,000 to $100,000 in Nike because it is one of those companies where this may be the time when it's discounted, and we may not see it discounted again for another 5 years. So I want to take advantage of the current times and really load up on Nike. So that's my video on Nike. I hope you found it interesting, and I really appreciate you watching. I wanted to provide an update on my NVIDIA short position. As you might recall, if you watched any of my other videos, I started shorting NVIDIA 3 months ago and have provided a video updating where the stock's moving and the status of my short position at the end of each month. And we are at the end of August, so I wanted to provide a new update. This past week, the biggest story out there was the NVIDIA earnings. There was actually some watch parties that people got together and watched. I know why. I certainly got together with a group of people on stonks, and it was really fun. It took a lot of energy, by the way. It seemed like the predictions and the analysis really hit a peak. Now, the company, I'd like to go through it, evaluate it, value the company, and then share with you what I plan to do with my short position, plan to do with this stock. And as always, this is not financial advice. I don't recommend you short NVIDIA. I don't recommend you buy, hold, or sell NVIDIA. Now, the company is still a very large cap company. It's $2.93 trillion of value. That's a lot of value. Looking at their revenue, they're a $96 billion revenue company. Now, I happen to believe that semiconductor is cyclical. I think a lot of people would agree. Some people would argue that NVIDIA is not going to be that way, that they're going to keep growing because they're going to build out the AI universe. And that might be the case, but it would be a rarity. And I think it's beginning to show up that their growth is really going to plateau and I believe decline. And I'm going to show that a little later. They are very profitable. This is a very a likable company, very valuable company because they are growing, they're profitable, and they generate free cash. That is most definitely the case. Their P is a little high this year at 55. Next year, it's supposed to come down to 35, which is still quite high. But since they're growing, I think they deserve it. There's a strong buy by analysts, but it's a little bit of a group think that's going on out there. It just seems like, especially 6 months ago, 3 months ago, the whole kind of media universe was so in love with this stock. But the stories are changing. What I've heard over the last few business days is, media personalities like Jim Cramer really pump the brakes on NVIDIA. He's already saying that the stock's overpriced, which is really incredible because he was one of the biggest cheerleaders of NVIDIA. But if you go through other media personalities, I think the NVIDIA is incredible, and we think it's going to be worth 3 or 5 times more. Story has really faded. We'll see how the media treats this company over the next few weeks. I happen to think that as we go through the next 2 to 3 weeks, how the stock behaves is going to determine the next year. Because if some large investors leave the stock, it's really going to open up the floodgates. If a few large investors enter the stock, I think the stock could really rally. So the next couple of weeks would be really interesting. We'll see how it goes. When we look at them financially, they're just an excellent company at the moment. They have really grown their revenue. Their growth has just been incredible. But it's not about where you're growing now, or I should say for the past 12 months. It's what are you going to do over the next 12 months? So I'm going to address that. I have got a forecast of the revenue that I'm going to show a little later. And their balance sheet's excellent. They have more cash than debt, a lot more cash than debt. They're going to buy back shares, which is a positive thing. Now, on the buyback, it's always positive for companies to buy back shares, but they tend to do it when it's getting later in their product cycle or innovation cycles. And here's my point is if you had another great idea coming, you would keep that cash because you're going to need it to build that idea. But once your current idea is pretty much kind of playing out, you start returning that capital back to investors in the form of buybacks. A great example is Apple. Apple hasn't created a new product in a long time. I think the Apple stock is undesirable to me for that reason. That what's next? You're going to keep making the iPhone a little prettier, change the colors, have new commercials, and that's it. It seems that that's the case with that company. And a signal is that they buy back shares to prop up their stock price. NVIDIA buying back shares, I think, is actually a sign for me that no, that's not what you should be doing if you're an incredibly high growth company. You should keep that cash and keep the growth going. So that was interesting to me. Cash flow is excellent. As we look at cash flow, the margins on their product are really high, and I put that into my evaluation. Analysts have been in love with NVIDIA. 38 analysts cover it. Who doesn't cover NVIDIA? And they say that the stock is discounted by 21%. The market disagrees, and the market has marked down the stock recently. But there was, over the last, I would say, 2 to 3 weeks, there was an upward run that has since faded. It faded a little bit this week, actually a lot this week. But for a couple of weeks, I saw the stock really rally. The current year, it's expected that they have earnings per share of $2.79. It really grew from last year. And if you look at previous years, this is what I talk about in the cyclical nature of this industry is not too long ago, they weren't making a whole lot of money, and they may return to negative growth, which is the case in 2019. It's a cyclical industry. It wouldn't be a surprise that a lot of these hyperscalers bought too many GPUs and they say, hey, we're not going to buy for a while. And you see a negative growth year, maybe in 25 or in 26, and it really changes its valuation. I'm expecting that. I can't tell you if it's going to be 25, 26, or 27. One of those years is going to have negative growth, maybe 2 consecutive years since there were so many GPUs bought from NVIDIA. We'll see, but I'm going to take this into account into my valuation. At the current stock price, I believe that NVIDIA is still priced 37% too high. It's being priced at a premium of 37%. And I get to that conclusion by setting up a cash forecast that I expect from NVIDIA and then getting a net present value of those cash flows to today's value. I also look at earnings per share, do my own calculation there. I primarily use free cash flows as the valuation method, but earnings per share is a strong influence. Now, when we look at cash flows, I wanted to point out that I'm starting with their first half of 2024, and I'm multiplying that times 2, and then I'm growing it by 25%. I still think that they're going to have growth in free cash flows in the next 6 to 12 months. And I'm setting up a favorable forecast. I want this to be as positive, favorable for NVIDIA because I'm shorting. I don't want to start with the expectation that it's super overpriced and my numbers give me a number that proves that. No, I actually want to try to prove the other, which is, hey, could this stock really be worth what it's worth and maybe worth even more? So I'm growing year 1, year 2 aggressively by 25%, which is a very high free cash flow growth rate. But I'm expecting the company's going to plateau their revenue and actually have competition with alternatives, especially as the hyperscalers have bought many of the GPUs they need. And at that point, they don't have to buy anymore. So maybe they're buying for other use cases that could use AMD technology. It could use competitive technologies, even from the likes of Intel. So I'm expecting competition to enter the picture, sales to plateau, and I actually expect for cash flows to come down in years 3 and 4 by 15%. Again, they're going to reach a very high watermark of free cash flows in year 2 in my forecast. All these cash flows look great. The amount and terminal value is going to be pretty high. I'm going to grow terminal value by 4%, which is a high growth rate because, again, I believe that semiconductors are cyclical, but I'm still going to be as optimistic as I can be in this forecast. I'm going to discount by 8%, which is very reasonable quality balance sheet. And the current net present value of all those cash flows is $1.387 trillion. I'm going to add the cash on the balance sheet, take away debt. I only get to $1.4 trillion of value, but the market cap is 2.9 trillion. So based on cash flows, this stock is priced at a premium of 52%. Earnings per share get us to a 7% premium on the stock. If I base it on a PE of 36, the growth rate of 10%. Again, those are optimistic numbers. I could easily say the PE should be 25 or 24 because I'm going to show you that their growth rate is actually going to decelerate and it's going to plateau and eventually you'll see some negative growth. In the next 2 to 3 years, I expect negative growth. When that happens, holy smokes, look out. The stock's going to drop. So having a combination of the two, I put more weight in free cash flow. I think that free cash flow always yields the true value of a company, and earnings per share is a strong influencer at 1/3 of the weight. I get to a 30% premium on the stock. How did I get to that cash forecast that I just showed you? And what is my expectation for NVIDIA's revenue going forward? Those are really the pieces of information, or I guess the projections that are really going to dictate where the stock price is going to go. What I've taken is the historical information data that NVIDIA has provided. The most recent quarter is Q2 of their fiscal year 2025. They have a fiscal year, I believe, that ends January 31st. So this is the quarter that just ended is in their fiscal 2025. And they reported that they had $30 billion of top line revenue, which was, if you compare that same quarter to the same quarter the year prior, 122% growth, phenomenal. But it's a sequential growth from the previous quarter was only 15. When you compare those numbers to where they were at previously, when they really just caught fire a year ago, the numbers were quite drastically different. The sequential was 88%, 100% moving to 200%. And you see how sequential growth is really coming down. Now, the company guided, this is a number from NVIDIA, 32.5 billion is going to be their Q3 revenue number. So when we put that number into this little spreadsheet, we see that year over year growth is going to drop down to 79% from 122%. That drop may be psychologically difficult for a lot of investors. Whoa, what happened to growth? How come it's dropping so quickly? Sequential growth is only 8%. Again, this is NVIDIA's number. So as investors get their heads around, they're sequentially growing only 8%. I expect that Q4 of their current fiscal year is going to be in the neighborhood of 34 billion. And that's probably a little optimistic. Again, their year over year growth would drop to 54, sequential growth 5%. Q1 of 25, which would start on February 1st of 25. I think their revenue is going to be around 35 billion. And again, the growth rate keeps dropping, sequential growth 5%. And I believe that in the middle of 25, they're going to plateau. They're going to stop growing sequentially. They'll still be able to show a growth rate in that quarter compared to the prior year. But I think by this point, investors will see that, hey, this is just going to be a normal, high, large technology, moderate growth stock. And a lot of I would say the fantasy valuations will leave the room. It'll now be based on, okay, cash flows are probably not going to grow anymore. And maybe the cyclical nature of this industry will begin to show up. So that's what I'm looking at from an information perspective. This section of the spreadsheet is completely my expectation, but this section of the spreadsheet is provided by NVIDIA. So these are numbers that are real. These are the numbers that I've estimated based on my best prediction. And this is a realistic prediction. I think it's very realistic to see them plateau. And I think it's realistic to see that they're going to have negative growth in 12 to 24 months. And psychologically, that's going to be really tough on investors. We'll see how the stock behaves at that point. The desirability of the NVIDIA business is really high, and that's never been in question. NVIDIA most definitely is a company that has very strong barriers of entry. They have the best accelerated computing technology in the marketplace, and they're in high demand. That's most definitely the case. I've been a semiconductor investor for a long time. I think it's a very desirable industry. Semiconductor companies have their technology patented, and then it prevents other competitors from duplicating what they do. And that's the case for NVIDIA. They're definitely a very desirable company. It's never been about that. The company is not the stock price, and the stock price is not the company. Those are two different things. And the company most definitely is a great company. If you value a company above $1 trillion, it's a great company. There's no ifs and buts about that. My only point that I made with my shorting is the stock price is unrealistic. It's just completely unrealistic, which is why I shorted. And I also shorted the stock so that I could put capital at risk and really put myself in a position to learn something. If I lose money, I paid a price for that lesson. If I make money, I gained, and I got a lesson out of it, which is, I'm seeing the analysis, I'm seeing my best estimate, and I'm going to trust it. And I'm probably going to be able to calibrate and sharpen my skills as an investor as a result. So let me go over where I'm at with my short position. I started the short position at the very end of May, and it's roughly around this point that you're seeing on the graph. And this is the stock price. It's currently trading at $119 per share. My average cost base is $115 per share. So the current the stock price since I shorted the stock has really moved. When I first shorted, I thought, whoa, I really nailed it. It went down a little bit, but then it rallied up. So I was like, oh boy, here we go. I've got that 30% maximum, right? So if it goes up more than 30%, I'm going to get out of the position. It's just something that it was a wrong thesis that I had. Get out of it. Tip my hat to the stock market. Thank you for the lesson. And I'll make another video and share that with you and say, hey, this is how I was wrong. And this is how much money I lost. But at a certain point, it really went to the downside. And I think the next couple of weeks are going to tell us what is it going to do. The last earnings call was a little ahead of this number, or this point where I shorted the stock. So they actually announced their earnings like a week prior to that. And I think over the next 2 to 3 weeks, we'll see where the stock goes, if it goes up or if it goes down. Right now, I'm sitting at a 3% loss on my short position. I actually chickened out going into their earnings. I was hearing a lot of, I think, optimistic, bullish comments. And I took a few shares and I closed them out. And I took about $1,200 of capital off the table, and actually about $2,000 of capital off the table, and lowered the amount of capital at risk. So it's kind of funny, but hey, I'm still got a short position out there. Maybe I'll add some shares going forward. I don't know. I'm not ready to make a decision just yet. But I think the story on NVIDIA is still the same to me. It's a stock that is incredibly exciting. But if you study the fundamentals, it's overpriced. The stock price is overpriced. The company is great, exciting. Stock price is a different thing. It's overpriced. The last time that we saw this scenario was with Cisco. Cisco most definitely had the best technology in the time when we were building out the internet. And the market just got carried away. It was just so in love with Cisco. And the stock price, it became the most valuable company in the stock market. And it rose from not really being anywhere near the top of the stack not too long before. Does that sound like a familiar story we've heard recently of NVIDIA adding pretty much at this point 2.6 trillion dollars of market cap? Now, Cisco continued to grow, continued to operate really successfully for years. It kept growing, but the stock price collapsed. Stock price is separate from the company. The company continued to operate. It was a very good company. Their technology was the best. It was clearly different than the rest of the marketplace. The world had to build out the internet. So revenues kept growing, but the valuation had gotten too high and the stock price collapsed below its value. But investors, once bitten, twice shy, they didn't want to touch the stock because it had caused so many losses that I'm sure these big hedge fund managers just didn't want to touch it because they had to explain to their investors how much money they had lost on Cisco. So for a long time, Cisco just was undesirable, untouchable from, many investors, and it just didn't go anywhere. Eventually it did rise, but it's never gotten to the stock price that it originally attained. What's Nvidia going to do? I don't know. For all I know, it's going to keep going up. That would be incredible, but the stock's already been incredible. So they're in the incredible zone. But if they do fall off a cliff, it will become a falling knife, because especially the big investors, once they start leaving, they are not going to return. And big investors pour big capital into these stocks. You don't get to $3 trillion of valuation with just retail investors. That's just not the case. You get there with big institutional investors putting big bets on these stocks. They certainly have been doing that with Nvidia. As soon as those start leaving, I think a large number of them will leave, and the stock price will really have a hard time staying at $119 per share. These are all things that we'll have to let time tell us which is going to happen. Is it going to go down or is it going to go up? I'm going to keep my position open on Nvidia. I think the story that I was seeing 3 months ago, I just feel more comfortable, confident that that's the story that I was seeing, and that's the story that I see today. And I think there's more evidence that this stock price is going to have to get corrected at some point. I think more and more experts in the media space are beginning to cite that, hey, this stock price has gotten carried away. And we'll see how the next 2-3 weeks play out. This is my update on my Nvidia short position. I hope you found it interesting, and I'll record another one in a month's time. We'll see what happens in the next month. For all I know, it'll go up 30% and I'll sell, or it'll go down substantially. And maybe I'll sell because I just want to take the gain and move forward. My last 2 shorts have gone really well. I made 52% on Super Microcomputer, and that stock's really, really hurting. It's a falling knife. And I saw similarities there as NVIDIA, but it's different. They're a different industry. They're not as profitable as NVIDIA. They don't control IP like NVIDIA. And the other one was CrowdStrike, which I thought was price for perfection. If they would have one error, the stock price would go down. And boy, did they commit one error. They created the biggest computer outage in the history of computing. So they got the championship belt for making the biggest blunder in the security space by providing a very poor update. And that ended up being a 42% gain over the course of 10 days, which was great. We'll see where I end up with NVIDIA. I may end up with a loss. I may end up with a gain. But it's certainly been a really interesting play on NVIDIA. For the most part, I'm a long-term investor. I like buying great companies and holding them for a long time. I like to see those investments double in value every 5 years or less. No problem with a stock doubling in 6 months. But I'm a long-term investor. But I analyze companies, and I'm putting the analysis that I had on NVIDIA, and I've tracked NVIDIA for a long time. I was an investor in NVIDIA years ago. So I'm putting that analysis to work, and I'm putting capital at risk. I know that my analysis is going to either produce a gain or a loss, and it's going to give me an opportunity to learn something. So that's a part of why I'm shorting this stock, and I've shorted other stocks. Shorting stocks is not the principal investing idea or discipline that I follow. It's really long-term investing. So I hope you enjoyed the video, and I really appreciate you watching. I'd appreciate comments on NVIDIA and see where you're at with the stock, what you think is going to happen. I'd really appreciate if you could provide a comment there. Good luck investing in 2024. We're on a nice rising market with the stock market in a rally where shares have gone up in general. The S&P has gone up for about 7 days, and it's really climbed quickly. We had a pretty good pullback about a month ago, and we've almost come back to the highs on the S&P. It's been pretty incredible. Every market will provide opportunity. We just have to know, which way the market's going and what we can do as investors to really monetize that opportunity. I'm going to talk about selling put options and how I'm using them to get extra income in my portfolio on stocks that I would love to own, and I'd love to own more shares of. The three stocks I'm going to talk about are Amazon, Allstate, and Live Nation. These three stocks are really good companies. I've made videos on all three. I believe that they're all discounted. I'd love to own more shares of these stocks, and they have been going up in price. Now, selling a put option gives me the opportunity to buy shares at a lower price if they were to go down in price. I sell put options roughly a month into the future. I feel comfortable with that term. I try to stay away from some of the pitfalls like not having a dividend event or an earnings call, because you never know what's going to happen with earnings. For example, today I had one stock go up 18%. I'd hate to be in a put option when a stock either goes up or goes down that much. Having said that, let me go through three examples and show you how I'm generating $495 more income in 1 month by selling put option contracts to buy shares at a discounted price compared to what they're selling today. Let's start with Amazon. I don't think I need to convince anybody that Amazon is a great company, and I would love to own more shares of Amazon. I've been buying into the company ever since they had a pretty good dip after their earnings. Not sure why the market sold them off so much, but the stock is really rising. I've bought into the stock as fast as I could during that low point. But what I also did is I sold a put option to buy 100 shares of Amazon on September 13th if the stock goes down to $160 or less. Right now it's $178.22. Now, whoever bought that contract paid me $178. So I get that in cash. If the stock stays above $160 per share, I get to keep that $178. And if it falls below $160, I get to buy Amazon shares. I win either way. Heads, I win. Tails, I win. Thank you very much, stock market. So I was glad to sell that put option on Amazon and see if it's going to go ahead and trigger and get to the strike price and enable me to buy more shares of Amazon, or if I'm just going to keep the $178. Overall, the way I calculated that $178 really gives me a yield of 13%. How do I calculate that? Is I have to put up the collateral, which is the money that would buy 100 shares, and that money's locked up, can't go anywhere. So I'm taking that as being the basis of my investment, and the yield is $178. So if it stays above $160 per share, I'm going to get a yield of 13% on this put option. Not a bad month's work, considering that I do have a good amount of cash right now, and it's earning 4 to 5%. So this is a better yield on that cash. The next company that I want to accumulate shares in is an Allstate. And this company is in insurance. It's been doing really well over the past year. It's up 71%. So I'm very glad that I own this stock. I've done really well in appreciation. I'd love to own more shares. The stock has been going up recently, and I sold a put option contract to buy 100 shares of Allstate if the price comes down to $170 per share or lower. And the person who bought that contract paid me $168 for the right to buy those or to sell me those shares at the price, which is fine. If the stock price stays above $170 per share, I get to keep the $168. If it comes down in price, I get to buy Allstate stock. I win either way. Heads, I win. Tails, I win. Thank you very much, stock market. If I calculate the yield on that put option, I'm making 12% on the money that I have to put up as collateral for those 100 shares of Allstate stock that's going to be locked up for a little over a month. So that's the second stock that I've put a put option in place, that I've sold it and created some income. And the third and final stock that I've sold a put option contract on is Live Nation. This is a company that I think has a lot of value compared to its stock price. And I've completed a video recently. You can see it on my channel if you like. You can see that the stock's been very volatile. And I've been buying into this stock, but I also sold this put option contract. Basically, if the stock comes down to $90 per share or lower, I get to buy the stock at that price. And if it stays above $90, I get to keep a premium of $149 that I got from selling this contract. In either case, in all three scenarios, I get to keep that premium. But you would hate to see a stock like this one really come down. Let's say there was some really bad news and the stock, crashed down to $60 per share. I would have to buy the stock at $90. That's the risk. But the benefit right now in a rising stock market, I think, is pretty clear. I get to generate income, in this case here, $149 from a stock that I would like to buy. All things being the same, I would love to buy Live Nation at $90 a share if somebody would want to sell that to me. And we'll see how it plays out. All three contracts have a duration of roughly about a month. That's the time duration that I'm comfortable with. And again, I try to stay away from earnings calls, dividend events, because those could really move a stock one way or another. In all three scenarios, generated some income, $495. I just started doing this since we have a rising stock market. I feel like the market is probably going to go up from this point. Chances are, right? Nobody can predict it. But we had a pretty good correction about a month ago. And I think that's kind of given the market the medicine it needed to kind of bring down some prices. I wouldn't be surprised if we go up a little higher from this point through the end of the year. So I might double up on the put option contracts that I sell and create a little more income. Maybe get that income stream up to about $1,000 a month. We'll see. So that's my video on selling put option contracts to get additional yield and additional income in my portfolio. Hope you found it interesting. Thank you for watching. Welcome back to my channel, fellow investors. In this video, I'm going to cover a small ocean logistics company by the name of Pangaea. You probably have never heard of this company. They're tiny, small cap, under $1 billion in value, but they've had a really nice return in the last 5 years. I'll show that later. I've been a long-term shareholder of Pangaea, and I wanted to update my analysis since the company announced their earnings today. Pangaea, they specialize in shipping particular types of aggregates, loose materials like cements, sand, gravel. They also do things like grains, beans, and ship them from one continent to another. They also specialize in the northern route above North America. In certain parts of the year, the ice breaks up, or they're able to break through the ice and cut the shipping route considerably between Europe and China, which becomes much more affordable for companies to take that route versus having to go down to the Panama Canal, which costs money, or even go down further around the tip of South America, which would really be a long voyage. The company announced their earnings today. So with their new financials, I'm able to update my analysis and value the company. I'm a current stockholder. I've been a stockholder for some time, and I'll need to decide whether I'm going to hold my shares, sell my shares, or buy more shares. It'll be based on the valuation as well as how the company is doing. Let me tell you more about the company. Let me go over the fundamentals of Pangaea. Their market cap is small, $382 million is their market cap, and it should be down because, again, after their earnings, the stock went down quite a bit. We'll see where it opens tomorrow, where it trades. The company has a forward PE of just 7.5, very low PE company. Historically, they pay a really nice dividend. Right now, it's at 4.8%, and historically, they paid up to 8%, 10% dividend, while their stock has been appreciating. If you look at the 5-year chart, especially from 2020 up until now, it's really gone up. It's gone up 143% over the last 5 years. And more recently, if you look at the last 5 months, it's up 55%. So it's been a really nice stock to hold. Overall, it's only covered by one more analyst, and he has a hold rating. This is a tiny company, so I don't expect many analysts to cover it. And there's been really good investors that buy these small companies, hold them for a long time where there's really good value. And I think I may have found a company. It certainly paid me back. I probably have already sold enough shares to recover my full investment in Pangaea since I started buying in the year 2020. I'm going to value the company by first discounting the cash flows that I expect the company is going to produce in the future and getting a current value of those cash flows. And then value it a different way, which is looking at the earnings per share and trying to get to a stock price based on earnings per share. Let me start with free cash flows. So they had positive free cash flows in the full year 2023 that just closed. I'm going to have that as my starting point of $27 million. I'm going to grow those cash flows by 4%, which is very reasonable since the economy should be picking up soon. And this company tends to really get more premium shipping rates and do better than most other shipping companies. In terminal value, I'm going to grow those cash flows by 4% as well. And that should give me a nice conservative forecast of the free cash flows I expect from the company. Keep in mind, over the last 5 years, they've grown free cash much faster than that, but I want to be conservative. I'm also going to be conservative with my discount rate at 11%. And I'm going to use that to discount all those free cash flows to get to a current value of $350 million. The company has $87 million of cash, $121 million of debt. So the equity value of the company is $316 million, but their market cap is $383 million, which means the company is trading at a 12% premium. And in my book, that's pretty close to fair value. If I really like the company, I'd be willing to hold
and maybe even buy shares on dips. Because if I really like a company, I just think they're going to continue to grow their earnings per share and grow their free cash flows. So that's within reason of evaluation. Earnings per share value, I'm going to take their expected earnings per share for 2024, which is $1.10 per share, go times a 12 PE. It's expected the company is going to start growing now. They command a good shipping rates, and they should grow in 2024. I'm going to grow their earnings per share by 4%. And I'm going to use this formula here to determine the value based on earnings per share. And the value based on earnings per share is $11.27. Current stock price is $7.74. So you have a discount of 46%. I combine the two, and it has about a 7% discount on Pangea, which I think is more fairly priced versus any big discount offered. So should I buy more shares, hold my shares, or sell my shares in this company? Well, let's take a look. Let's start with the company. Do I want to be a part owner in the business? Yes. I think it's a really well-run company. I like their specialization. They differentiate in the market. And it's an industry that has really high highs and really low lows. We're getting through one of the lows, and I think the best is yet to come for this industry. The balance sheet is in good shape. Debt is less than 3 times EBITDA. So the balance sheet's in good shape for this company. And they don't offer a discount. I think it's fairly priced. So I'm going to hold my shares of Pangea, see the company operate for a quarter or two. And if the valuation changes, then I can decide whether I want to buy more or sell my shares. I hope you found my video on this really small company interesting. I really appreciate you watching. Good luck investing in 2024.
Pfizer announced their earnings this morning, and the earnings were positive. This company has been a rebound story, and it's hard to believe because this is traditionally a very strong pharmaceutical company. They were the company that stepped up and found a vaccine for COVID, and they did really well for a few years. They generated upwards of over $60 billion of free cash flow in those 2 years when they generated vaccines to help the world get over COVID. But since then, the revenues really dropped, and so did their stock price, and it became a rebound story. Pfizer's always been a high dividend paying company, and it's certainly the case now with the stock. I wanted to take a look at their earnings and see what's going on, see if we're headed in the right direction or if this stock's going to continue to really struggle. I'll take a look at their earnings, and then I'll look at their financials. I'll run a valuation and then determine if I should continue to buy shares of Pfizer, just hold my shares, or sell my shares in Pfizer. Now, none of what I am sharing is financial advice. I'm not recommending you buy Pfizer. I'm not recommending you sell it. I'm just sharing my analysis. I hope you find it interesting. So overall, Pfizer is a very well-known pharmaceutical company. And what's good about the company is they haven't stood still. They've continued to create new drugs and treatments. They're going to help a lot of people, which is good. It's also going to refresh their portfolio, which is very good. I really like their long-term vision of reinvesting in the business. They took all that cash as well as some debt they took on and acquired some businesses to make their portfolio even stronger. And I think the next 5 to 10 years, the company should be growing. Now let's take a look at their earnings. So it's July 30th, 2024, and Pfizer announced their earnings. The really good news is for the quarter, they've begun to grow their revenue. That's really good. And the reason why the revenue has been going down is they had a temporary sale of COVID vaccines. And that temporary event was really good to build cash, but it was not going to stick around forever. But now they're beginning to have compares where they can start growing. I think that's really going to change the perception and psychology around this stock if you see the stock grow. Again, I really like their forward opportunity with all the different drugs that they're going to come out with and the companies they've acquired. So I think that's a really, really good milestone for the company. Overall, they continue to drive really good free cash flow. They pay a really nice dividend, and I'll get to that in a few minutes. Overall, they improved their guidance. They increased the revenue guidance by $1 billion, and their earnings per share, they improved as well. So they beat and raised their guidance, which is a very good sign. After announcing their earnings, the stock in the pre-market has gone up 0.75%. So a modest little rise to the stock. The stock overall is $174 billion in market cap. They do about $55 billion in revenue. They their forward PE is really low at 12.15%, 12.15. And I like that. If I look at the fact that if they can start to grow, that PE should double. It really should be an opportunity for this stock to really go up. The company pays a 5.47% dividend, which is a really high dividend rate. Analysts believe that it's a buy and that it's discounted by 12.3%. So that looks good. Historically, when we look at the stock price is traded close to $60 per share. Now it's down to 30. So back to my comment on the PE can double, the stock price can double, in my opinion. But as you can see from 2021, when it was deemed that, hey, COVID isn't going to be around forever, we're not going to need vaccines forever, the stock really sold off, and it never hasn't really had a long-term rally for a while. Another thing I would point out is this company is bigger and has more cash. It's just stronger than before 2020, before COVID. But in those days, the stock was trading upwards of $37 a share. Now you're getting a bigger company 4 or 5 years later at a discount. So I think it's an opportunity to look at Pfizer. When we look at their financials, you can see where the COVID years really pretty much doubled the size of the company if you compare it to 2019. And now the company still is bigger. If you look at 2023, they're much bigger than they were in 2020 and 2019. But those COVID years are what throw their financials off and probably throw investors off. The piece that I'll point out that is really interesting is I really look at free cash flow. In this company, when you look at the cash flow they were producing before COVID, they were producing about 10 billion, 12 billion in free cash flow. Once COVID came around, they developed the vaccine, they produced a lot of free cash flow. They produced a whopping $56 billion of free cash flow. And they did good things with that. They took it and invested in the business, which is really good to see. They acquired a big business that is going to help with certain cancers. And I think that's going to generate really good cash flow, future cash flow, and really good revenues for Pfizer. 12 analysts cover Pfizer, and they believe it's a buy and that it's discounted by 12.3%. I'm willing to bet that they're going to probably increase their price targets because the company beat on earnings, raised their guidance. So that should raise the price predictions of these 12 analysts. But at this point, before they've had a chance to update their information, they're showing that it's probably discounted by 12%. And as we look at their earnings per share, their projection this year was 2.37, and I believe Pfizer raised their guidance, so it's going to be above that. And then next year, it's supposed to grow 16%, 6%, and then 4%. This guidance looks okay. I think it's going to be better than that because Pfizer has a really strong portfolio of drugs that are just now becoming sellable, and they're going to have additional drugs and treatments approved by the FDA in the next couple of years. So overall, they're going to have a really nice growth trajectory in the next couple of years. So I think they're probably going to surprise to the upside on earnings per share going forward. I like to look at a company and determine how desirable is that company? Do they operate in an industry where they operate like a really strong monopoly and can command their own price, have very high profits, and have free cash flows? Or are they subject to excessive competition and therefore revenues go down over time, profits go down? It's just really tough to really make free cash flow in those industries. So let me make that decision around Pfizer. Pfizer is a pharmaceutical company. And what I like about pharmaceutical companies is that they do the science to then discover a drug that's going to help people, and they earn a patent. They also have to go through FDA approval, and that takes a long time. So both the patent and the FDA approval, and then really becoming mainstream, that has a network effect. So pharmaceutical companies become really, really valuable. That's why Pfizer has a big market cap. And you have other companies like Eli Lilly with even a larger market cap. So Pfizer, I don't put them on the upper part of the green quadrant, which is the most desirable. I would put them kind of like straddling both the gray and the green. And the reason that I give them a combination is that in certain markets for pharmaceuticals, Pfizer definitely has a lot of power, and they have new drugs where they're the only ones selling that drug. So people that have an illness or a condition will have to buy it from Pfizer. That's really strong. But in other markets, they have a lot of competition. For example, they're getting into the weight loss drug market, and that part of the market, there's already a couple of competitors. So when they enter into that market, they'll probably just have a drug that competes with others. It'll probably make some money, but not as much as where they're the single drug that really helps patients with a particular disease. So I'm going to put them there. It's still a desirable company for me. They have, I would say, a moderate to wide moat, and the strength is really strong. I like that Pfizer's been putting a lot of capital into their R&D to develop and discover better drugs, new drugs to help people and really grow the products that Pfizer has to sell to the marketplace. Now I'm going to value Pfizer by looking at their free cash flows and getting a net present value, all the cash flows they're going to produce in the future. I'm also going to look at earnings per share and value the company by using earnings per share. To start with free cash flows, I think that a good starting point for this company based on their historical information is to start at $9 billion and then grow by 10% for the first 4 years. Terminal value, I'm going to grow by 4%. Those are all cash flows beyond year 4. I'm going to use a discount rate of 8%. And the intrinsic value of all those free cash flows based on that data is $246 billion. I'm going to add cash on the balance sheet and take away debt to get to an equity value of $188.6 billion. And the market cap currently is $174 billion. So there's about an 8% discount on Pfizer if you look at free cash flows. Now, this is a conservative forecast. If the drugs that they've taken to market work out, you could see 50% more free cash flows, and that's really going to change the valuation. But I think it's good to be conservative and have a good starting point. Looking at earnings per share, the company just guided up. They just moved their guidance up. So using the lower end of their guidance, which is $2.45, and raise their PE to 18 since they're beginning to grow. I think they deserve an 18. Eventually, I think they're going to get to 24. The growth rate is going to be 15%. And I get to a estimated stock based on earnings per share, $50.72, but their current stock price is $30.72. So there's about a 65% discount using earnings per share. When I combine the two, put more weight on free cash flow, there's a discount available on Pfizer of 27%. I think this is a conservative valuation and a good one. And I think that it really gives me a reasonable discount on what I think is a very good company. So should I buy more shares of Pfizer, just hold my shares, or even sell my shares? Well, I think I'm getting a very reasonable price on a very good company that has a lot of upside potential. So I'm going to buy more shares of Pfizer. I really do consider them a very good company to own long term. I think it's been misunderstood. I really like that the stock sold off so much and the price has really come down. I think it really presents a very good proposition for me as an investor. So I'm going to keep buying shares in Pfizer. I hope you found my video interesting, and I appreciate you watching. Welcome back to my channel, fellow investors. In this video, I'm going to be reviewing Palantir. This is a software company that deals in big data. They try to find patterns in that big data, which will then give their clients the ability to pick up on that intelligence and act on it. One of their big customers is the military. They use big data sets and try to pick up on patterns that help them keep the country safe. They're trying to move over to the commercial space and sell their solution to businesses who could also use their software. Of course, they're a software company, so every software company now says they're an AI company, and Palantir is doing the same. They are claiming that through AI, they're able to work with large language models and bring value to that customer as well. I'm going to take a look at Palantir. I'm currently not a stockholder of Palantir, and I'm going to value the company, and I'm going to decide whether I should start buying shares in Palantir or hold off from doing so. Let me show you more on Palantir. Let me go over the fundamentals on Palantir. To begin with, this is a $55 billion company, and they're a new company. They've been around publicly traded since 2020, 2021. And if you followed the company, they IPO'd at around $10 per share, and then they really went up in value, up around the $35 range, but really went down. And you could have picked up shares of Palantir under $10 in 2023, at the beginning of 2023, and at the end of 2022. If you had picked it up at the very low point of the stock, you'd be up 300% from that stock price up to where it trades today. So stockholders, especially the ones that bought in late 2022, early 2023, are likely really happy with that return. Overall, this is a high growth company. They're growing at about top line revenue, about 20% per year, but their cash flows are growing much faster.
which is really impressive for a company to have free cash flows this early in their young history. Forward PE is 73, which is a little high, and I think they'll need to grow into that PE. But I'll value the company using free cash flows as well as earnings per share. I'm not going to use a 73 PE. I'll use something lower and tell you what I think the company is worth. Most analysts are saying to hold on Palantir. I think the stock price has gotten pretty high and pretty expensive, but I'll see where I value the company, and I'll let you know what I'm going to do with this stock. I'm going to value Palantir by discounting the free cash flows I expect the company is going to produce in the future. And I'm also going to value the company looking at their earnings per share and determining what the stock price ought to be based on their earnings per share projections. To begin with, on the free cash flow side, the company produced really impressive free cash flows. And I'm going to have a beginning point of the 2023 year, and then I'm going to grow that by 25%, which is a pretty fast growth rate, but they did grow their free cash flows over the last 3 years by 47%. The first 4 years, I'm going to grow at 25, and then years after that, I'm going to grow at 5%. It gives me this particular forecast of free cash flows that I expect in the future. Now I'm going to discount those free cash flows by 10% as a weighted average cost of capital. This is higher than what I would use for like a Microsoft, but this is a small company. They are new. A lot of things can happen. A big competitor can come into their space and take them out of business or really limit their growth. That said, with a 10% discount rate, the net present value of all those free cash flows is $31.2 billion. I'm going to add the cash, $3.6 billion, and they don't have debt. So it increases the overall value to an equity value of $34.9 billion. The market cap is $55 billion. So the company is trading with a 34% premium. That's a pretty good premium on this company. Looking at earnings per share, the earnings per share is a little small. It's 34 cents per share, and their growth rate isn't going to be all that great, but I think they can really improve on it. I'm going to grow their earnings per share by 10% and give them a PE of 60, since they are a pretty exciting company. They are saying the right things with AI, and I think a 60 could be something I could substantiate. Based on those factors, I get a value of $17.39. Current stock price is $25 a share. So there's about a 30% premium if I value the company based on earnings per share. If I combine the two valuations, I get to a blended 33% discount on Palantir. That's pretty high premium that I'm paying on Palantir. And, it causes me to pause. If it was closer to fair value, I might consider it. And definitely if it was a discount, especially with the execution of their business and the profitability and the free cash flows, I'd definitely be interested in Palantir. Now it's time to decide whether I should buy shares of Palantir or not buy shares. And I'm going to base it on 3 factors: the company, the balance sheet, and the discount. To begin with, I think the company is really exciting, and I'd be happy to be an owner in Palantir. I think they're an industry that I have invested in for a long time and have done really well in. And the company's operated really well. There's no debt, so it's well below 3 times EBITDA, and the balance sheet's in very good shape, but there's no discount on the stock. So you saw where the volatility of this stock has gone. And I think at the right points, this stock may come down to a better valuation and a better entry point. Therefore, I will not be buying Palantir. I'd be a seller of this stock. Palantir is an exciting company. They're in a space where they're really doing well. They've grown very quickly, which is impressive. And we'll see if they can keep that growth rate up, especially on the top line. That's been growing at 20%. If they begin to slow down, then it's really going to affect their valuation. We'll also see if they can keep growing that free cash flow at the rate that they've been growing. It'd be impressive if they do. And their valuation will go down if they don't. I hope you enjoyed the video. I hope you found it interesting. And I really appreciate you watching.
Welcome back, fellow value investors. In this video, I'm going to analyze Perdoceo. This is a small cap company that focuses on higher education. What makes them different is they do a lot of distance learning for their students. For people that have full-time jobs and have to go to school part-time, or make it convenient, they have to educate themselves without leaving their homes. Perdoceo's been really offering a lot of curriculum for that student and giving people a way to get educated, earn degrees, and improve their lives. It's a company that's also making money and generating a lot of free cash flow, and that really caught my attention. I'm going to evaluate Perdoceo, let you know what I think the company is worth. I'll also let you know if I'm going to intend on buying more shares, if I'm just going to hold the shares that I own, or if I'm going to sell the shares in this company. Do me a favor and like my video and subscribe to my channel. And also, please leave a comment on this company. I'd love to hear what you think. I'm going to evaluate this company looking at 3 principal areas. Most importantly is the company. I don't want to invest in a company that I don't believe in. I have to like the business. I want to be a part owner in the business, and I want to know that I like the management team and I like the industry. So a lot of attention to the company, its industry, its management team. I want to look at the balance sheet, make sure the debt's under control and less than 3 times EBITDA. And I want to discount the stock. I'm a value investor. I buy stocks when they're discounted. And based on the answers that I get, I will buy, hold, or sell this company. A lot of industries have to really change. They have to innovate. They have to adapt to the modern times. And I would say that higher education might be a little slow to adapt, especially these big universities, big state universities. These are really big institutions. And don't get me wrong, I think they're great. I think they educate a lot of people. And I was educated here in California by the Cal State system. So I'm very fortunate and grateful that they educated me. But there's a lot of people that would rather go online and earn their degree. There's also people that have to work, and it makes it very hard for them maybe to drive across a city or maybe drive an hour to get to school and then go home, do their homework, and then go to work the next day. So it'd be far easier if they can do it at home or somewhere where they have a high-speed internet connection. And Producio has been really focused on distance learning. So it makes it very modern to the student that wants to do it over the internet. It also makes it less expensive, more profitable for the company that's actually providing the education. So all those factors, I think, benefit this company and make them, I think, more competitive than their rival institutions that are very big and really serve predominantly on-campus students. The company has 2 big divisions, Colorado Technical University Division, and then the American Intercontinental University System. The bigger of the 2 is the Colorado Technical University System. It has brands like Colorado Technical University, Hippo Education, and Coding Dojo. This is really focused on technology-based education and getting people to take jobs in technology. Very good. It's the bigger of the 2 different divisions. They have 25,900 total enrolled students. They have 2 on-site campuses, but most of the education is done online. So it makes it convenient for the student, less expensive for the university. The other university division is the Intercontinental American University System, and they have 4 different schools within that division. This is the smaller of the 2. They have 12,100 students, and again, primarily online. This particular company likes to educate people and get them ready for a particular job. So most of what you get educated in this system prepares you to be a nurse, to be an IT professional, to be able to code and work somewhere developing software, or maybe even AI. So I like their curriculum. I like that they do primarily online, which fits the modern times. And I like that they really focus on what is being demanded by the workforce, by students, and that's what they focus on educating students in. So let's take a look at the type of student that attends their college typically. Students tend to be a little older, 68% of them are over 30 years old. And then there's a category of 21 to 30. So a majority of students are adult students. It's not people that are just graduating high school and going straight to college. Most of them are earning a bachelor's degree, 68%, and some are earning an associate's degree. The types of degrees that are being earned, business studies and information technology, as well as health education, so nursing and so forth. So these are very occupational related degrees. So people are going to better their earning potential. Maybe students are using their employers' continuing education benefits that a lot of employers provide, and you use those resources to attend one of their colleges here and earn a degree online. So I think they're really tapping into a population within the United States that wants to be educated, but they just need it done a little differently, done online, done at their pace. And this is a more an older audience that is going to their colleges. So I think this company is different. It's not just like any other university. They are different. They really want to be primarily an online learning university. They want to be flexible. So mostly their students are adults. So they have families, they have jobs. They use a lot of technology. Now that's probably similar to most universities, but these guys go that extra step doing online education, and now they're going to bring in artificial intelligence. And they really focus on what's marketable. Let's educate these students so when they get done with their degree, they have a job waiting for them in business, in IT, or in healthcare. Let's look at their investment thesis. First, they want establish a growing online platform. So they really want this online business, this online education business to really thrive. That's their principal goal. I like that. They're going to be using AI, who isn't, to really enhance the education process. That makes a lot of sense. I think if they provide AI to students so they can ask a lot of questions around particular topics, that student can learn much faster if they get the answers that much quicker. And if the company builds a large language model around the subjects that students need help with. They have a strong balance sheet and really focus on the return of invested capital. Very good. And no debt. They carry no debt on the balance sheet. That's very good. They also want to partner with the stockholder by buying back shares and paying a dividend. Now, one item of concern is they had to basically bring back their previous CEO because the existing CEO resigned. I don't think the person was working out. And that's a concern because they had a change of the guard. That person didn't work out. The CEO that was previously in the role came back, but he's probably not going to be there permanently. They're probably going to need to find another CEO to take over. So we'll see how that sorts itself out, but it is an item that concerns me. Producio has been growing their revenue. I'm looking at the trailing 12 months, and you can see that their revenue is growing. Not a ton, but it continues to grow. I like that. The other thing I like is they're profitable. Profitable with some growth is excellent. I'd like to look at earnings per share. That's another metric that I use for valuing the company. And one website, stock analysis website, stockanalysis.com, has their earnings per share next year at $2.14. And CNBC has it effectively at $2.06, not too far apart. So I'm going to take the middle point of the two. I'm also going to look at the forward PE for Producio. I'm not going to take the forward PC that's listed on CNBC. That's too high. But I'm going to go way above the 8 that they have done for the trailing 12 months. I think they deserve a higher PE. They're growing, they're profitable, and they generate free cash flow. And their cash flow is really good. They generate really good cash flow. Free cash flow, trailing 12 months, 131 million. So that's very good for a company their size and their market cap. So I'm going to use that free cash flow in the valuation of the company. I take two techniques, free cash flow and earnings per share, to value this company. Looking at some of the ratios, they have a very low PE. It's 8.22, and I think that they deserve a higher PE. I'm going to use a higher price to earnings ratio. I think they deserve a higher price to earnings ratio. It is a small, mid-sized cap company. Their debt to EBITDA is really low. They have low debt and they produce good EBITDA. So that's very good. Their return on assets is good, 14.8%. Return on equity is 18.8%. I believe Producio is heavily discounted and it offers a discount of 83%. I get there because I value the company based on the earnings per share that they're going to produce, seeing how much the company is worth based on that factor. And I also look at the free cash flows that I expect they're going to produce and then valuing those free cash flows and determining a net present value. The free cash flows for the trailing 12 months, 131 million. So that's going to be my starting point. And I'm going to grow these cash flows by 4%. And then terminal value, I'm going to grow more modestly by 2%. These are really low growth rates. I think they could do better than that, but I'm going to be conservative. The weighted average cost of capital is 9%. Interest rates are down. This is a small company, so I'm going to use a higher rate than normal. I'm going to add the cash, but there's no debt to take away. So the equity value ends up being $2.4 billion for the company. The market cap for the company is 1.1 billion. So the free cash flows just look fantastic. 113% discount if you look at how much cash this company produces. The earnings per share, I took the midway point between the two websites I visited. So it's $2.08. I'm going to use a PE of 12. It's a growing company, profitable, generating free cash. So they deserve a 12, if not higher. And then just a conservative growth rate of 3% on those earnings per share. When I take those factors and put them through my calculation to determine a value of a company using their earnings per share, I get to a value of $21.29. Current stock price is $17.45. So just using earnings per share provides a 22% discount on the stock. I blend the two, but I believe in free cash flows more than earnings per share and use 2/3 of that as a weight and 1/3 from earnings per share to get to the blended 83% discount. The debt to EBITDA is super low, so it's well below the 3, and I'm very comfortable with this company's balance sheet. Looking at where the company is traded, year to date, they're doing well, 25.63% return year to date. It's had a really nice run up at the end of the summer. Their earnings came out and investors recognize, hey, this company's valuable. It has been trading sideways, which offers an opportunity for an investor like me to come in and take a look at these shares. They pay a dividend of 2.5%. And overall, they offer a nice discount between where they're currently priced and where I value the company. So let me determine if I should buy, hold, or sell this stock. First, let's take a look at the company. Do I like the company? Do I think it's well run? Do I like the industry? And the short answer is absolutely. I really like that they're primarily online. They really focus on what types of careers are people getting jobs for, and really making the education process valuable for the student that graduates. So that's all things are good. The one small thing about management, they did replace the CEO. Now, that's not totally bad news, but it is a concerning item that I'm going to keep an eye on. The balance sheet, very low debt, well below 3 times EBITDA, and they offer a nice discount on the stock. So I'm going to be buying shares of Producio. Hey, thanks for watching the video. I really appreciate it. I'd love if you could leave a comment. I'd love to read your comments on the company. I'd love to hear what you think of the company. And please like my video and subscribe to my channel. I'd really appreciate that. Good luck investing and happy holidays. Now, I need to update my stock price on Prudential before I could give you a full review of Prudential. So $109.46. Over the last 30 days, it's pulled back 8%. Year to date, it's up 5%. 1 year, 14%. Pays a nice dividend of 4.75. So one thing that Prudential has going for it is it produces a lot of free cash flow. When you look at their cash flow, it continues to expand, and the insurance industry, there's a reason why, like, Warren Buffett loves insurance companies, is you sell policies and you sell them at a policy rate. Your policyholder pays you in advance. You have actuarians that are trying to calculate, hey, for that type of insurance product, this is what we want to price it at. This is where we want to sell it. Therefore, our payouts will only be 80%, 90% of what we're selling the policies for. So you're somewhat mathematically expecting to make money on the policy, and better yet, you get to take that cash and invest it and make money on it. With the higher interest rates, they were certainly making a very good return. As interest rates come down, I think it's going to erode some of that profit, but it's still a pretty good dividend environment. It's not like we're going back to, the days when, interest rates were near zero. So it's still going to be a decent area. I had Prudential discounted very, very well. And as we look at, the path forward for Prudential, I don't see anything being a threat to the company where, well, as we have declining interest rates, what will that do to Prudential? Well, I think it's going to be okay because it's not going to be a zero interest rate environment. So they're still going to make that cash. I think insurance continues to be, and have good, strong demand because people want to insure their life. They want to buy into annuities because they're intimidated by investment.